Good morning, everyone. Welcome back for one last time to CA Intermediate. Today's plan is to have a group one quick revision of the topics that we have. So the agenda is this way. We're going to start with module 2 and module 3. So this is a quick plan. We're not starting on time, but we'll try and do as much justice as possible to the plan that was made and shared to people in yesterday. Got that? So let's quickly get started with chapter 4, unit 1, financial statements. This is a base chapter and we can't do any chapter in module 2 before doing this chapter. We have to start with this. Reason being, financial statements, what financial statements to prepare, how to prepare, what disclosures to make, everything has been told in chapter 4, unit 1. Only based on this is what we can do bonus issue, right issue, financial statement preparation, or debenture account by financial statement preparation, or what to say in redemption of preferential post redemption balance sheet. And without doing this chapter, you won't be able to do your group 2 accounting also, because all the company related chapters in group 2 other than liquidation, you would have to prepare schedule 3 financial statements based upon this. So though you are not rating group 1 or you've cleared group 1, if you're still doing group 2, you have to still revise this topic before you write your group 2 exam. So talking about financial statements, there's a lot of theoretical understanding that one needs to have. So the entire chapter for our discussion, I'm dividing it into 3 parts. These are the 3 varieties of questions that you will get in the examination scene also from this chapter. Part 1 or topic 1 is schedule 3. This is where they would expect you to prepare financial statements, statement of profit or loss and the balance sheet. And the topic 2 is dividend. So when the company wants to give dividend, you would read in law as to how exactly are the provisions relating to dividend. Here we're going to see the accounting side of it, but still the questions might seem like it's a law-based question and not an accounts. What is the maximum permissible dividend amount that can be given is the accounting that they won't ask you to pass journal entry to pay dividend, but the questions will be as to how much dividend can be given, can this much dividend be given, from where can this dividend amount be given, and other things. And the last topic that can be questioned from the chapter of financial statements unit 1 is managerial remuneration. How much of managerial remuneration can be given is the, or they'll tell the amount and they ask us whether this amount is fine with law or not, or how to compute what is the maximum permissible managerial remuneration. So these are the 3 topics. Let's start with the first one, that is form and content of balance sheet. So we all know that part A or part 1 talks about balance sheet and part 2 talks about statement of profit. Unlike schedule 6, revised schedule 6 and schedule 6, the first part spoke about statement of profit or loss and the second part spoke about balance sheet. So whenever there is a question in the examination requiring you to prepare financial statements, both balance sheet and P&L, should always prepare balance sheet first and then P&L. You would say that, sir, without preparation of statement of profit or loss, I will be able to close reserves and surplus in balance sheet. I will be able to close the balance sheet. Presentation will be balance sheet first, P&L next. But preparation will be P&L first. After closure of P&L all by itself, we'll be able to close our balance sheet. So whenever there is a question on preparation of balance sheet, write your balance sheet format completely. Write your P&L format completely. Then go to prepare notes to accounts. You will first finish your notes to accounts, then finish your P&L, and then finally your balance sheet. And unlike your PU based examination, there is no need to write all the items. For example, in a specific question, there is no long term borrowing. There is no debentures in the question. Should you be writing this in the format? Not required. However, if you are not able to judge, let's say you need to finish this, it's a 15 marker question. You kept yourself a target of 20 minutes to finish the question on financial statements in the examination. You sit, read the question 2 times, check what items are there, what items are not there, and you are not very confident with regard to the aspect as to which whether that item is there or not. Then blindly write everything. If you think so, then blindly write everything. It's still fine. And note numbers can be changed. If long-term borrowings is not there, then note number 1 will be share capital. Note number 2 will be reserves and surplus. This you would have never seen in your life in any of the balance sheets that you've done. Very rarely would see it in your practical life also. So 1 and 2 will go to this. If long-term borrowings are not there, your note number 3 will be deferred tax liability. And if deferred tax liability is there in the question, it would be a straightforward item again. You don't have to prepare notes to accounts for it. You will skip note number for this and then straight away write note number for long-term borrowings. Other long-term liability. Hope you got that. So I hope I shouldn't be wasting the time making people read the format of balance sheet. Should I? Should I? I'll quickly tell you certain disclosure requirements what you should keep in mind. Can we get started? So you know the format of balance sheet. You know that the trial balance will be given. From the trial balance, you will post the items to balance sheet. What we need to remember when we're preparing balance sheet is item wise. I'll go on telling the disclosure requirement. Starting with shareholders funds, share capital. Whenever shares are issued for a non-cash consideration, That might be in the process of amalgamation, or that might be in the process of bonus issue, or that might be for any asset acquired and consideration given in non-cash format. That is by way of shares or debentures or preference shares being converted to equity shares during the year. If any of these things have happened during the year, after you disclose your paid up capital, it is your responsibility to write it in the notes to accounts that out of the above mentioned 10,000 shares, 2,000 shares were issued for non-cash consideration. That is by way of capitalization of reserves bonus issue, or by conversion of debentures to equity, or by conversion of preference shares to equity shares, or in exchange of plant and machinery which was acquired. So you should disclose it whenever shares are issued for non-cash consideration, or during there if any shares are bought back. Any shares are bought back. Again, you would have to mention that out of these many shares were bought back. And you should always disclose authorized capital called up, issued, subscribed separately. And in majority of the questions, if authorized capital is given, you would write it. If it's not given, still write authorized capital as heading. Don't write any amount. Draw two lines and then start the rest of it. If in case you write authorized capital, remember when you take the total for share capital, you don't include the authorized capital. Got it? And it is again a mandatory requirement that whenever reserves and surplus notes to account is prepared, every item that is coming into reserves, every item that is going out of reserves should be disclosed. Appropriation of reserves should be openly disclosed. Let's say during the year, there are some shares forfeited, out of that you made profit, and that is transferred to capital reserve. You should mention what was the balance of capital reserve at the beginning, how much of money is transferred to capital reserve during the year. Let us say security premium or capital redemption reserve is received during the security premium is received, or capital redemption reserve is created. You should tell how much was the opening balance, how much was created during the year. If in case any part of CRR, security premium or capital reserve or P&L balance is used for bonus issue, again you need to show that deduction from that in your notes to accounts. Guys get this? And usage of security premium, you know it is limited. It can't be used for everything and any purpose that you want. It is limited to the purposes mentioned under section 50. Close that window. One's washing clothes. I feel like syncing the words that I say to the beat in which they are talking, beating that. So money received against share warrants, so you'll never come across. Share application money received pending allotment. If only if it's mentioned in the question, we'll consider it as a part of our balance sheet. But majority of the times you would never. And long-term borrowings will always carry your debenture portion. Whenever there is anything other than debentures in long-term borrowings, any loan taken from statutory financial corporation or any NBFC or bank, there might be some adjustments in the question which would say that interest is accrued, interest is outstanding. Don't include interest with loan. Interest has to be disclosed as a separate item. I hope you remember that there are certain questions where in the adjustments they would say interest of so much is outstanding. This is because when you compute interest on the loan, it will not be compound interest, it will be simple interest. If in case by mistake you include the interest into the loan amount, next period when you compute the interest will be computed on the loan amount plus interest amount. That for that reason we need to disclose the interest separately and the loan separately. When you're dealing with liabilities, the point of doubt that you will get is whether to disclose a liability as a non-current liability or to disclose a liability as a current liability. Sometimes they'll very evidently tell you that it is debenture or it is a long-term loan taken, or sometimes they will just tell term loan taken. So whenever there is ambiguity, there is no clear-cut information whether a particular liability is long-term or short-term. That is left to your professional judgment at that point of time. Because in a realistic scenario, you'll talk to the client, get to know the information, and then write. In the examination, you can't question the examiner. So all you would have to do at that moment is take a brief step, write it as non-current liability, and then go on. If it is short-term, they would have to mention that it is short-term. So I would recommend you to take it as non-current unless they mention that it is current. Sir, would it be wrong if I take it as current? Not wrong at all. If you want for your comfort, this is not required. If you want for your comfort, at the end of the entire question and after you finish all the notes to accounts, to mention that loan from state financial corporation or short-term loan from this person, as they have not mentioned whether it is current or non-current, it is assumed to be not repayable within the period of 12 months and assumed to be non-current. Your balance sheet will still tally at the same amount. Sometimes it might so happen that ICA study material may they have taken a specific item as non-current. A similar question, same name, what is available in RTP or MTP or suggested answer, they would have taken as current. So don't let that confuse you, because suggested answer what is given to you is not the suggested answer what is given to the person who will correct the paper. The person who's correcting the paper, there will be more than one correct answer given. Either of the correct answer, if it is written by you people, you will get full marks. So throughout whatever preparation you've done, believe it and trust it. Don't let last minute some suggested answer trick you people and then put your entire confidence low and question your preparation. So after that, deferred tax liability again, if it's only available in the question, we'll do write it. Other long-term liabilities and long-term provisions again. If it's there, we'll write. Otherwise, we don't. And if there is any liability which is from related party or which is from any subsidiary or holding, it should be disclosed separately as a separate line item. We can't mix them all together and then write. They just say loans, long-term loans, and they'll give 1 lakh rupees. In the adjustments, they do mention out of that loan from related party is 10,000. Loan from this particular cooperative society is this much. So if in case they give such specific detail, you would have to show that separately in your notes to accounts, and you can't write it all together. And MSME and non-MSME trade payables should be disclosed separately. Similarly, when you talk about trade receivables, outstanding for greater than 6 months, outstanding for lesser than 6 months has to be disclosed separately. And talking about non-current assets, property, plant and equipment, we need to disclose the original cost of the assets, accumulated depreciation till the date of which the financial statements are prepared, and the closing balance separately. Hope you got that part. And if there is any capital asset being under construction, that has to be disclosed separately. And any items like preliminary expenses, miscellaneous expenditure, share issue expenses, or expenses are not considered to be intangible assets. I hope people are slightly aware of age 26, para 54, conditions and criteria to decide whether an item is intangible asset or not. So if there is any such accumulated losses, P&L account debit balance, preliminary expenses, share issue expenses, any of incorporation expense, any of these, there is no place for those items in the balance sheet asset. They would have to be deducted completely from our reserves and surplus. What if reserves and surplus is insufficient? It's totally fine. Reserves and surplus is one item in the balance sheet which can appear in the negative form. So you can write reserves and surplus as minus 10 lakhs. Totally fine. But any of such incorporation expenses or preliminary expenses should be written off in the very first year of incorporation, irrespective of the fact whether there is profit or got it. From what do you deduct? Let's say there is preliminary expenses. From which amount do we deduct? There are some 3, 4 reserves. Which reserve do you deduct from? Write all the reserves. No, there only you write this item also as minus and then show it. Don't have to specifically try and show which item it has to be deducted. You have inner column, outer column. In the inner column, you'll write balances of all the reserves. Write this item as negative item. And then outer column will become negative. Yeah. Don't try to take a call there and try to mess up your and talking about inventory. Inventory, you need to specifically disclose how much of inventory is in raw material form, how much in work in progress form, how much is in finished goods form, and how much is stores and the spares consumed. Talking about trade receivables, we did talk. Cash and cash equivalent. Cash and cash equivalent definition that is given under Schedule 3 as well as under Accounting Standard 3 are not same. They are very different. So don't try to merge them. Whatever is cash and cash equivalent as per AS3 is not this. They are different. Here it includes cash balance, bank balance, and everything else. When you write bank balance, if in case it is so mentioned in the question that any balance which is there in the bank is not in a nationalized bank. It is not in a nationalized bank. It is not in a bank which is, it is not in a scheduled bank as per RBI. You need to disclose it separately. You cannot write all the bank balances together. All the scheduled bank balances, all the unscheduled bank balances has to be shown separately. Then that's it. And we all know the P&L format. So P&L format, you will have revenue from operation, other income. And then expenses side will have cost of material consumed. And I would say purchase of stock in trade, changes in inventory. Changes in inventory is always opening minus closing, not closing minus. If you do opening minus closing, it becomes negative. It is totally fine. Write the amount as negative in the amount. Okay. This expense side is like the debit side. This is like the income side. So sales and income will come on the credit. Opening stock purchase will come on the debit. Closing stock will come on the credit side. So when we write changes in inventory, this is debit side. So closing stock is moved from the credit side to debit side. So when it is moved from credit to debit, that will become negative. So we will be writing this changes in inventory as opening minus closing. So this is one part where you might do a very silly mistake to make your entire profit go wrong, because of which your reserves and surplus is wrong and your balance sheet. That then employee benefit expenses is anything related to employees. Finance cost is all the interest based expenses. Depreciation and amortization expenses. If in case there is a question wherein you are supposed to do balance sheet as well as PL, for this specific item you won't prepare a separate note. You would have already prepared a note for tangible assets, and in that tangible assets, that accumulated depreciation is there. That accumulated depreciation, you'll write the opening accumulated depreciation, depreciation made during the year, closing accumulated depreciation. There, the depreciation for the year's total column, whatever exists, that same amount you will straight away post it here. So remember that you don't have to prepare a separate notes to accounts for depreciation column. This would be eaten away from there. And any other expenses which you don't know to put under any of these categories should be written in other expenses. One simple item that can be tested when it comes to other expenses. Tell me, where do you write director's salary, director's fees, or sitting fees, or managing director's salary? Would you write it in employee benefit expenses or would you write in other expenses? Director is acting like an employee of the organization if he is managing director. Otherwise, you should write it in other expenses. Sitting fees, other expenses. Managing director's remuneration or salary given. Managing director is an employee to the organization. Full-time director is an employee to the organization. If they just say director, other expense. If they say just say director, it is other expense. If they specifically mention managing director's salary, managing director's remuneration, write it in employee benefit expenses. Getting it? If in case they say manager, there can be a manager now without being a director. He has equal powers as much as a managing director. In that case, where do you write? Manager is an employee. By employment agreement, he gets the post. So then you write it in employee benefit expenses. In this chapter, when the question comes, it's not based on computation. It's only based on presentation. Balance sheet tallying is very easily possible. If in case a specific item which is supposed to be shown in this category is shown under a different category, though your P&L is giving the same profit and your balance sheet is tallying, you will still lose 1 mark or 2 marks. So this chapter or this unit in this chapter is based on presentation. It is not based on computation. So when you're practicing problems on this chapter, don't solve problems. This is one chapter what I can very confidently tell. Look at the answer. Look at the answer. Try and place whether this item am I able to place it at the right place. Once you understand where to place the right item, you are done with this. So don't waste time practicing problems on this unit of the chapter the day before the exam or the week before. For this part, preparation of financial statement. Yeah, got it? Let's go to the next part. So do you want me to solve a problem on financial statements? I initially had a plan. Now if something has to be skipped, I thought I'll skip preparation of financial statements. I hope that's fine with you all. Let's go to the second topic that is there in this chapter. This is on dividend. So with regard to dividend, we will not be questioned on accounting how to write the journal entry for dividend. Previously, there used to be questions on grossing up the dividend and computing the part. But right now, the question will be whether it is legitimate and as per law or not. So section 2 subsection 35 talks us about dividend, and dividend says that definition says dividend includes interim dividend. So there are two types of dividend. One is the final dividend. The second one is the interim dividend. Final dividend is the dividend which is declared in the general meeting. There, the recommendation is made by the board, the approval and then declaration of dividend is done by the shareholders. However, interim dividend is authorized, declared, and completely decision is taken by the board of directors. This is happening between two AGMs, between two annual general meetings. So there are four items which are discussed in the annual general meeting, which are called as ordinary business. That is ADDA, accounts, directors, dividend, and audit. So other than this, anything else that is supposed to be discussed will become special business. These four will become ordinary business. So before this general meeting, there will be a board meeting where the financial statements will be adopted, accepted, audit report will be accepted, and board of directors will decide. In that particular meeting, they will propose or recommend dividend. This will be declared in the can be declared in the general meeting at the same rate or can be slightly decreased. You're getting this? We all know that the dividend is declared out of the profits of the organization. Whenever organization has profits, we give a part of it to the shareholders as dividend. But can a company give a profit which is not earned as dividend? Maybe because they've accrued the profit, the contract is due for any market condition to impress the investor, to ensure that the belief system in the market about the company in the shareholders' mind is not tampered. Can they still issue dividend? The answer is yes. It is allowed as per the provisions of the act, but there are certain restrictions. I put little bit of parts what is there with regard to dividend part also in this version. I'll be sharing this sheet to you all later so that you can read the context what is required here. So section 123 tells how to give dividend. Dividend will be given only after paying depreciation. If you have not provided for depreciation expense, you can't provide dividend. And what to say, current year, previous year dividend has to be given, or it can be given out of the profits which is received as subsidiary from the government. If in case a company is a company which is taking up only government contracts and the money has to be released by the government at the specific completion of the project. So if the company has accrued profit but is not able to give dividend because the government has not given us enough money, in that case government will allow some special subsidy using which directors can be paid salary, using which shareholders can be paid dividend. One of the best examples is the case of ILFS, which used to take all the infrastructure development projects of the government. So there's a beautiful case law, what you can read after your exams are over. So you would understand the theoretical and very practical approach to this part. So using that, when the dividend has to be declared, it is fine when you have profit. The point comes to be where when the dividend, I will skip these parts. I would have discussed this in detail, but I'm rushing. I hope this speed is fine. It is fine. Let's quickly get into that part wherein we'll discuss how to declare dividend. Yeah, this is the important part. How to declare the dividend when there is no sufficient profits. So declaration of dividend is out of the profits, current year profits or previous year profits, or the profits received or the subsidies received by the government for that purpose. If in case there is inadequate profits, company can still declare dividend, but it has to comply with certain provisions given under section 125 and dividend declaration rules 2014. What does okay, not 125, dividend declaration rules 2014. What does it say? Four conditions. Condition number one, the rate of dividend cannot exceed the average of the last 3 years. The last 3 years, whatever dividend is given, you add all of them, divide by 3. Then whatever rate you get, that is the maximum. Let us say out of the last 3 years, dividend is given in only 2 years. Then what do? You take only those 2 years. Denominator will be 2, not 3. Denominator will be 2 and not 3. So that is how we compute the rate of dividend. This is and conditions. This is not or conditions. You have to comply with all the conditions. The second condition is, no matter what you do, even if that average rate is still high, still the amount of dividend that you give cannot exceed 1/10 of paid up capital plus free reserves. And for this purpose, when you say free reserves, it is only P&L account balance. It doesn't include security premium. It will include P&L and general reserve. And that concept of security premium inclusion, if in case you're getting confused, security premium is not free reserve. Security premium is considered as free reserve only and only for buyback. That we'll discuss in tomorrow's class in advanced account. So does security premium form part of free reserves? No. General understanding is free reserves is such profit which is available for distribution of dividend. And section 123 says no, dividend can be given out of current year profits or previous year profits. So you can take P&L account balance and general reserve, nothing other than that. If dividend equalization fund is there and it is not restricted to specific class, then such dividend equalization fund also is included in free reserves. But however, don't expect such high-fi questions in examination. That wouldn't. And the third condition is amount withdrawn for the purpose of dividend. No, that whatever that 1/10 we take no here from this. From that, first we should pay off the losses that is there in the current year. After that, what is left over only can be used. I'll show this to you with the help of numbers right after I finish this concept. I'll repeat once again. When we do 1/10 of paid up capital plus free reserves, we get no 1/10 of the funds that can be used for dividend issue. You can't straight away issue it as dividend. From that, first you should make good the current year losses. After you make good the current year losses, what is left only can be. And the last condition is, after you pay dividend, your reserves will decrease because you're paying it out of the accumulated profits. When you pay dividend out of the accumulated profits, after payment of dividend, such a decreased reserves should be minimum 15% of the paid up capital. Be minimum how much? 15% of the paid up capital. And when you say paid up capital and all of this, we are not considering shares application received pending allotment, money received against share warrants, all that is not considered. Only number one, share capital, paid up capital will be considered. What about calls in arrears? Paid up capital is after deduction of calls in. No, called up minus calls in arrears is paid up capital. What about calls in advance? Will it be included? No, that will also be not included. The reason? Very simple. Calls in advance is not part of it. We have not called. They paid before we called. That's the reason it's called calls in advance. On that calls in advance, we won't give dividend. On calls in advance, we give only interest. Get this? Paid up capital doesn't include calls in advance. And does it include calls in arrears? No. From called up, after we deduct calls in arrears only, we get paid up capital. This is very much foundation topic, but can affect you a little here. Such questions are again very, very rare, but can come that adjustment. I hope you understood that. At any point you don't understand or I don't make sense of what I tell, you can easily ask me and ask me to repeat and I'll surely do it. Shall we quickly see illustration number 21 from our material? How many of you are not from Yashas Academy? You don't have the material? How many? How many? How many? You don't have to worry at all. I'll show the question here on the board. You can just look at the board and then you'll see the question. I'll see the question. I'll show you the question on the board. I'll underline it and then show. And rest of you are lazy also. You don't have to worry. You don't have to. How many of you didn't get? Few of you didn't get your book, or few of you don't want to open your book. Also, you can sit back, relax, and then stare at the board, and I'll show it to you here. If you can help me, just tell me the page number. That will be very helpful. 21st question. It's around 50th page. 55. I'm almost there. Yes, there we are. Can you all see the board? Can I start with question number 21? So they've given some information wherein X Limited provides you that equity share capital is 100 lakhs, free reserves is 20 lakh, loss during the year is 1 lakh. So current year they have not made profit to give dividend. So can they still give dividend? Yes. But they would have to comply with the issue of dividend rules 2000. They have given the rates of dividend in the previous years. Rates of dividend for the past 8 years is given. So you take the recent 3. You take the recent 3 years. Management recommends a dividend of 8%. So in this question, they've told us 8%. And they're asking us whether 8% is okay or not okay. Sometimes what happens, they won't tell this 8%. They will ask us how much is the maximum permissible dividend rate. So either of the questions, our approach is same. If in case they tell a specific percentage, after we do every condition, we should check whether 8% amount, is it within limits, not within limits. We should be comparing. If in case they don't give 8%, it is very nice. Under each of the conditions, you compute the rate of dividend and then take whichever is less. That is the maximum permissible dividend that they can. Are you getting it? If in case they specifically mention a rate, compare each of the conditional dividend with that rate of amount that they have mentioned. If it fulfills all the conditions, yes. If it doesn't fulfill, then no. If in case though they don't mention the rate, under each of the conditions you compute the maximum permissible dividend rate, and out of all the conditions, whichever is less is the rate of dividend that we should be issuing. Got this? You should still continue to do other conditions. Yeah, yeah. It is there is no precedence of one over the other. Even if one condition doesn't satisfy, you cannot do. But they'll give you 4 marks. So you'd have to do other conditions also. And this is not, there's no specific rule that first condition will be satisfied only, then we'll go to second. Just 4 conditions. We'll check all 4. And we'll mention the reason why we do 2, 3, 4 is, let us say first condition is not satisfied. Let's say the fourth condition is also not satisfied. And the limit under fourth one is much lesser than first one. So you would have to mention what is the maximum permissible dividend rate. For that, we'll do all that. So let's start. The first condition is rate of dividend cannot exceed average of the last 3 years. So what is the average of last 3 years? 9, 10, 11. So 9 plus 10 plus 11 divided by 3. You would have to little bit of, you would have to write few sentences also. You cannot straight away start your answer, please 9 plus 10 plus 11 divided by 3 is equal to 10, tick mark. And then second condition. You would have to write condition number 1, dividend rate not to exceed average of last 3 years. You would have to write that statement. And then take last 3 years dividend. And then say average dividend of the last 3 years is 10%. What are they proposing? 8%. Is it within the limit? Yes, it is within the limit. First condition is satisfied. Shall we see the second condition? What is second condition? Amount to be utilized for the purpose of dividend should be 1/10 of paid up capital plus free reserves. So how much is paid up capital in this case? 100 lakhs. And free reserves is 20 lakhs. When we take 100 plus 20 and then do 1/10 of it, we'll get 12 lakh. From that 12 lakh, we have to deduct that current year loss of 1 lakh before we go ahead. Don't do 100 plus 20 minus 119 into 10% 19. Your answer will be incorrect if you do that. See, distributable dividend now is 11. If you do 100 lakh of paid up capital plus 20 lakh of free reserves minus 1 lakh, you will get 119. Then you will do 10% of it. No, that wouldn't work. You would have to take the previous year's reserves, excluding the current year loss. You would have to take the accumulated profits. On that, you take 1/10. I'm going to say paid up capital plus free reserves into 1/10. Whatever you get from that, you deduct the current year loss, whatever is there. After that, what is remaining on that? Sorry, no, first you do 1/10 and then you deduct the previous year loss. That is the distributable profit. And based on that, you can compute the rate of dividend that you can. There are 2 ways now. Once you compute this 11 lakh to be the distributable dividend, either you can deduct this 11 lakh by paid up capital of 100 lakh. You will get the percentage. What is 11 lakh divided by 100 lakh? Into 100 also you should do 11%. But dividend rate that they're recommending is 8%. It is fine. This is one way. Other way is you already have 11 lakh no here. They've told 8%. Do 8% of 100 lakh and compare it with 8 lakh. Are you getting it? So here, distributable dividend, you have it in amount. You compute the amount that they're proposing, 8 lakh. See, is it within limit? Or you convert this distributable dividend 11 lakh. If you want to distribute 11 lakh for 100 lakhs of paid up capital, what percentage will it become? 11%. So 11% is the maximum distributable dividend. 8% is what they're proposing. It is within limit. So compare percentage with percentage or amount with amount to whatever is comfortable to you. There is no specific guideline. You would have to do like this one. But do a pre-decision as to what will you. Okay? Then you want my recommendation. ಏನ್ ಬೇಕಾದ್ರೂ ಮಾಡಿ ನಿಮ್ ಇಷ್ಟ ಬಟ್ ಮಾಡಿ ಅಷ್ಟೇ. Okay, then the third question is amount withdrawn should be first utilized to write off the current loss. That's what we did. And then the last condition is balance in reserves after such withdrawal should be minimum 15%. Now let's say we are distributing 8%. How much is 8% of 100 lakh? 8 lakh. When you distribute 8 lakh out of the free reserves, when you distribute 8 lakh out of the free reserves is how much? 20 lakh. From 20 lakh, current year loss will be minus 1. It will become 19. If in case you issue 8% of 100 lakh, that is 8 lakh. So 20 minus 1 minus 8. What will we be left with as balance? 11 lakh. So 11 lakh is the balance. Is it 15%? Minimum 15% of paid up capital. It is not. Paid up capital is 100 lakh. On 100, when you compute 15%, it comes to 15 lakh. But what will be available is 11 lakh. So it doesn't satisfy condition number 3. Can we issue 8% dividend? They have not asked in this question what is the maximum permissible limit. They've just told very generally comment upon the management decision. So they are not asking you what is the recommended percentage. Your answer will stop at the point telling where 8% is not possible. But sometimes they expect you to tell what is the maximum permissible dividend. So then you should continue. What is the maximum permissible? So according to first one, there is huge limit, no problem. Second condition, no problem. Third condition, out of 20 lakhs, how much should be still there? 15 lakh. How much is accumulated loss? 1 lakh. So 20 minus 1. How much is it? 19. In 19, 15 should be there after you give dividend. In 19, if 15 should be there, how much can you give? 4 lakh. 4 lakh out of 100 lakh is 4%. So maximum permissible dividend rate is 4%. We have to write such recommendation. Are you getting this? How do we find maximum permissible dividend? Free reserve 20 to be maintained 15. So what do we get? 5 lakh. In that current year loss of 1 lakh, if I deduct, we get 4 lakh. 4 lakh divided by 100 lakh is maximum permissible limit is. I hope this is clear with you all. If in case you want, you take this loss here only. Free reserves less free reserve to be maintained less loss, and straight away take 4 lakh and divide by 100 lakhs. Service it's okay. Or no? I don't have enough time to solve the question from the detail and then write. So I am running you through the answer and covering the concept. Or I should skip all the questions and teach only concept, which will make you doze off by 1 hour and 12 o'clock ke baad to no one will come. I feel like so sleepy, sir. From 15 days because of exam tension, I'm not getting sleep. Today I attended the class. I feel so nice that I went back home and slept. Huh? Let's get started with the next part. The third topic that is there in your unit 1 of financial statements is managerial remuneration. Managerial remuneration is the contract between the manager or that managerial personnel and the company. So company and between them, they can decide how much money to give in the form of salary, how much in the form of any allowance, any perquisite, any ESOP, anything. Companies Act doesn't tell how to give, what breakup to give and everything. Companies Act is only telling the maximum permissible limit. This is the maximum limit. This is the maximum limit. Just to avoid oppression and mismanagement by the board of directors over the shareholders, the Companies Act will tell you the maximum limit. Maximum limit is given as percentage of profit. These percentages what are mentioned are per annum and for all the managers together. It is not per manager and per month. Company can give always very less amount, very amount which is much below this, but it cannot give beyond this. That's the point. When you talk about managerial remuneration, here the word remuneration tells anything that is given to the manager in the form of any allowance, any perquisite, or even if you give ESOPs, it's part of this. Now let's talk about managerial person. Who are managerial person? So managerial personnel can be directors, but need not be only directors. Can be directors, but need not be only. Other than a director who's called as a managerial person is a manager. And detailed definition is there. CEO, CFO, COO, when are they part of managerial commission? When are they not part of this? There is a separate discussion which is not required as of now. So I'm not doing it. Talking about managerial personnel and talking about directors in specific, directors can be classified into two categories. One, part-time directors. Second one, full-time directors. Part-time directors, full-time directors. So when some person is a part-time director, the percentage is different, maximum permissible percentage. When person is a whole-time director, the percentage is different. Then you might start questioning, sir, what about managing director? Managing director is also a whole-time. Managing director is also a part-time director is a director who's interested in the company only for sitting fees. He'll come, sit in the board meeting, take the sitting fees, give discussion, finish the discussion, give sessions, and then leave. Full-time director is like an employee to the organization. He visits the organization. He works 9 to 5. He has certain rules. He has certain responsibilities. He gets salary and not just sitting. You're making out the difference between them. If in case a part-time director has to resign, just have to resign. Just throw a resignation letter and then leave. Whereas rocket resignation, like make a resignation letter, make a rocket, throw and then leave. Are you getting it? Whereas a whole-time director can't do that. Whole-time director's resignation has to be accepted because he's an employee. The rules of regulations that will apply for an employee will apply for a whole-time director. Hope you're getting this. So if in case there is an organization where there is no whole-time director, all the directors are part-time. They themselves have to run the entire show. Then the percentage of remuneration that they'll get. Yeah. So the remuneration that part-time directors will get when there is neither any whole-time director nor any managing director is 3%. Why? Their involvement in the organization is more because there is no whole-time director. However, if there is no whole-time director, if there is no managing director, then the part-time directors, though they are part-time, they would have to actively take part and take lot of decisions for the organizations. They might contribute for time much more than just board meetings. So they'll be eligible for 3%. If in case there is whole-time director or there is managing director, their work will be slightly less. So they'll be eligible only for 1%. This 1% and 3% what I just mentioned is for all the part-time directors together per annum. All the part-time directors together per annum, and this percentage is on profit. Percentage is on. Now we understood how much will part-time directors get when whole-time director is there. How much will part-time directors get when there is no part-time director? Sorry, when there is no whole-time. When they are there, 1%. When they are not there, 3%. Now how much will they get? Whole-time director, managing director, or manager. Whole-time director, managing director, or manager. All of them, if there only or if there is only one of them, there is only one whole-time director or one managing director or only one manager, they'll get 5%. If in case they are more than one in number, then they'll get 10%. Then they'll get, if any combination may you see, no, it cannot exceed 11%. Cannot exceed. Sir, what if there is 10 and 3? 10 and 3 is not possible. Why? The moment there is a whole-time director or managing director, more than one in number. So here this part-time directors won't get 3%. They'll get only 1%. It will be 1 and 10. Sir, can't it be 10 plus 5? No, not possible. No? When there is 2, 3, 4, 5 managing directors, or 2, 3, 4, 5 whole-time directors, 5% is not there. It's only 10%. It is not 5% per person. It is not like one whole-time director is there, 5%. Two whole-time directors, 10%. Three whole-time directors, 15%. And 20 whole-time directors, 100% of profit will go to directors. What will shareholders do? So that isn't possible. So it is 5% if they are one in number. If it is more than one, 10%. And manager is also entitled to 5%. Manager is also entitled to is part of this very pool. And remember, a company cannot have manager and managing director. Company can have either manager or managing director, because managing director or manager is the ultimate authority in the company who can take all the decisions. There can't be two people who will take all the decisions. There has to be only one person, and that person will be that one person will be the manager or managing director. So they take all the decisions. So there has to be either manager or managing director. Only difference is managing director is a director, whole-time director who went on to become a managing director. However, if whole-time directors believe that none of them are competent enough to take the ultimate authority, they'll appoint someone who's not a director as the manager of the organization. So he's not the director, but he'll be controlling all the. Get that? So that's with regard to this table. You have this table in three different blocks in material as well as in law. So you put it all to one simple box. If you see this one single box, what is the maximum percentage that can be given? 11 lakhs. Sorry, 11%. 11%. There is little bit of law also I put. If in case this is contravened, what is the percentage of fine and everything? What is related to this? I put it here. So let's talk about profit. Whatever profit we talk here is not the profit that we compute as per Schedule 3 Part 2. The profit for the purpose of managerial remuneration should be computed separately. Like in taxation, every time they say the word salary, the definition is not same. In each context, the salary definition is different. So here, whenever they say percentage of profit, 3%, 1%, 5%, 11%, such percentage is different. You need to compute the profits separately. So usually people don't understand this. What they do is you do some 4 5 questions to get a hold of what should be considered, what should not be considered. I have tried to list out the items, what is allowed, what is not allowed. First, let's talk about debit items. Or generally, if I would have to tell, without showing you this table, normal operating expenses, working expenses, revenue expenses are allowed. Are you getting this? Capital expenditure, notional expenditure which are voluntarily paid are not allowed. You get this? And incomes, revenue income, operating income, what is usually earned is allowed. Capital income, notional income, revaluation income, or anything like share, to say, shares are issued at premium and then security premium is collected. All that is logically not profit. No, that should not be considered. That's what the law says. Very quickly, this is some items. What items are allowed? Usual working expenses, general administration overhead, and then production overhead, S&D overhead. All this is considered. Director's fees is also allowed. That is sitting fees. And then bonus or commission paid to the employees or payable to the employees is also allowed. Any tax, what is paid, is allowed. Interest on debenture loan, interest on debentures, interest on loan is allowed. Repair expense is allowed. Contribution for charitable purpose is allowed if it is within the limits under section 181. Remember 181 charitable charity given, 182 political contribution, provisions of Companies Act, not aware of. There is a specific percentage given. This much percentage of the profit can be given. If it is within that limit, it is allowed. If you pay beyond that limit, in taxation, when you compute profits, you disallow, no? Like that, here also you disallow. You take that profit, add it back. You take the profit as per P&L account, add that expense back because it is not. And similarly, depreciation is allowed if it is as per Schedule 2. Usually questions what happens is depreciation as per books, depreciation as per Schedule 2, both will be given. Net profit, what will be given in the question is after charging depreciation as per books. You add back such depreciation as per books, deduct depreciation as per Schedule 2, you will get profit for the purpose of managerial remuneration. You do the same in taxation, no? They'll give depreciation as per P&L account, depreciation as per section 32 of income tax. What do? We'll take net profit as per P&L account, add back the depreciation as per books of accounts, and then deduct the depreciation as per section 32 of income tax act. Right? Same to same. And when we talk about this compensation, now there is an employee leaving or there is a contract broken, there is a breach of contract. For that, if there is any compensation given, it is legally payable compensation, then totally allowed. You can charge that as expense to compute profit. If voluntarily you paid compensation, employee is leaving, he's a very good employee. You've given him a share of gratuity and everything. But because he's a very good employee, you are giving him voluntarily some additional compensation. Such voluntary compensation given will not be allowed as expense in computing profit for managerial remuneration. So if in case the profit is given and you start with the same, and they mention these items are already charged to P&L, and in that one of the item is voluntary compensation paid, what should you do? Add it back. We should not deduct. Why? It's already deducted and they've arrived at that profit. So we should add it back. If in case they don't give net profit, they give expenses and incomes. Then expenses which are not supposed to be considered, put into mark. Don't consider them. Only consider expenses to be taken, incomes to be taken. Add all incomes and deduct all expenses. If in case they already give net profit, then you can't do like this. You would have to start with that net profit and make adjustment. Very good. Am I going too fast? So insurance and bad debt expenses are also allowed. I've covered the items which will be usually repetitively mentioned in the question. Debit items which are not allowed is income tax payable, voluntary compensation paid, capital loss, and revaluation loss is not. Got it? And let's talk about incomes, and I'll tell you your favorite item, that is profit on sale of asset. Then incomes, we have subsidies received from government for the purpose of giving remuneration to managers. Sometimes government will give you subsidy. Use this money to give a salary to or managerial remuneration to directors. They'll tell this because your company is solely dependent upon government contracts and government is not releasing the money to you on time because of whatever is the reason. So if the government doesn't give money, you don't pay salary to managers, government will get abruptly affected. So they'll give you subsidy for a specific purpose to use it for distribution of remuneration among managers. So that will be included as a credit item, or any other general subsidy received also will be included in the profit. And then we have items not allowed. Premium on issue of shares. It is never a P&L item. Some questions may they do mention, ignore it. And if there is profit on forfeited reserves, forfeited shares, this is again capital reserve, not our P&L item. Or if there is any capital profit, or if there is any profit on sale of assets, or if there is any revaluation profit, these should not be considered. Now the point is profit on sale of asset. So now this is very interesting. Now whenever you purchase an asset for rupees 100, you don't usually sell it in the same year. Let us say you use this asset for 2 years, and each of the you charge a depreciation of 10. Let me repeat this to you. What is the original cost of the asset at which you purchased? 100. You used it for 2 years. Each of the year, let's say you provide a depreciation of 10. It cannot be 10 and 10 both years because we should follow WDV method. For example sake, let us take 10 and 10, and what has become the WDV of the asset? 80 rupees. So what is the original cost? 100. What is the book value? 80, or return on value? 80. Now at the end of the second year, let us say we sold this asset. Let us say we sold this asset. So let's say we sold this asset at 90 rupees. We compare the difference between 90 and 80 and then say 10 rupees profit. Am I right? But don't you think that that 10 rupees profit what we made is compensation for the depreciation that we actually charged? And the depreciation we charged at 20, but we actually recovered 10. So we could have charged only 10 depreciation. The value of the asset didn't go to the extent how we expected it to. Got it? So such depreciation is allowed as an expense under a different way, no? Here. So they say that money what you receive as profit, if it is for compensating depreciation, that is not profit. They regard it as profit only if it is absolute profit. What is absolute profit? It is cash profit. You paid 100 rupees for the asset. Depreciation and all, I don't care. Why? It is notional. It is estimate. It is not actual. You bought the asset for 100. You sold the asset for 120. You bought the asset for 100. You sold the asset for, on the date of sale, book value might be 80. I don't care. If the book value is 80, profit is 40. I don't write profit of 40 in my remuneration, profit for the purpose of remuneration. Out of that 40, absolute profit is only 20. Why? I bought it at 100. It became 80 because of my notional depreciation expenditure. From 100, it is sold at 120, 20 rupees profit. Such 20 rupees profit will be included. Are you getting this? Difference between original cost and WDV is not allowed. Difference between original cost and selling price is allowed. Are you getting it? So don't try to remember it like OC minus WDV, OC minus SP. Don't do that. Remember it logically. Logic is very simple. If the money is received towards sale consideration as compensation to depreciation, that is not profit. We will consider it only and only if it is absolute profit. We will consider it only and only if it is, meaning sale consideration received over and above original cost. Sale consideration received over and above will only be considered here in the income. You would have to take the net amount. Where? Uh, uh, we don't. This is one special purpose profit. This profit, what we do, will remain in working note to decide the maximum remuneration. That's it. This we don't adjust it with P&L. Got this? This is only working note of computing profit for the purpose of managerial remuneration. Now, let's say under your section 28, when you're computing the amount of profit for the purpose of PGBP under income tax, you take net profit as per P&L, you do lot of add less, section 36, section 32 depreciation, you'll do 43, 44, you do everything, no? When you do all of that, you get some profit to be taxed, no? Would you reiterate your profit as per P&L account to the profit as per tax law? No, not required. This is for a different purpose, that's for a different purpose. The difference there, whatever arises, will remain as deferred tax. If it is reversible, here also same. We'll keep it just like. You get this? Now let's quickly take one question. There's one more thing. What if the profits are inadequate? Let's do it after we do one quick question. Shall we? We'll be doing question number 26 from your material. Who has material can come to page number 20. Question number 26. Who doesn't have material, you can look at the board. I'll show the question on the board. Can we now see question number 26? For those who have the material, page number will be 63 or something. 60. It starts in 62. In 62 only question number 26 is nothing else. So HP Limited employs a managing director. So there is managing director. How much will he get? 5%. For other people other than project off ಮಾಡ್ಬಿಟ್ರಿ. So other than the managing director will get, I actually felt like project. You are not interested, you should not see, not turn off project. So managing director will get how much? 5%. If other than managing director, if there are other directors, they'll get how much in that case? 1%. So in this question, they've told there is managing director who is entitled to 5,000 per month salary. So they've already given the salary per month. We can't wait, no, end of the year I'll compute and then I'll give. We've already given. So we can tell whether what is given is within the limit. Or at the end of the year, they'll provide some performance bonus. We can tell whether the performance bonus, what they're mentioning, is within the limit or not within. Got that? So 5,000 rupees per month. For 12 months, how much would it be? Very good. So 60,000 rupees will be our remuneration given in the form of salary, and to a commission of 1% of net profit before charging such salary. Because they've used the word before, we'll take that profit due into 1 by 100. If they would have used the word after, we would have done into 1 by 100. And what profit are they referring to when they say net profit here? Is it this adjustment? This adjustment? Answer is no. This 1% is a profit that is there here. 3,32,500 is there, no, here. Whatever they want to write, let them write. Provision, they make 100 lakhs extra. I don't care. Of the profit that is there in P&L account, they are eligible for 1%. This 1% is as per the contract between the employee and the company. Companies Act will not meddle into that contract between employee and employer. They'll only tell you take 1%. I will tell whether it is based on the profits that I say on that within limit idya ilva. That's what we need to complete. You get this? So remember, this 1% of net profit is on what profit? Profit as per P&L without we doing any adjustment to such profit. Without we doing any adjustment to such profit. What is the profit as per P&L? 332,500. Sir, some items are not to be considered. We don't care. We don't care. How much is it? 332. This 332,500 into 1%. 3,325 plus this 5,000 into 12. 60,000. So 63,000, 60,000, 5,000 into 12, and that 1% is 3,925. Together 63,925 is the remuneration already given. Remuneration or 60,000 is given, 3,295 they are proposing to give. We should tell whether this is within the limit or not. If it is not within the limit, then they'll charge them contravention fine. Are you getting it? They've already given P&L account. They've already given. What I would recommend is you should start with this P&L, and if there is any debit item here which is not allowed but debited, we should add back. Are you getting it? Or the second approach is see each of these items. See what is allowed, add all the credit items and deduct all the debit items. Either of the approach is accepted. But what is recommended is start with net profit. Shall we start with net profit and then do the same? Or we can take GP and then do it. So GP, if we take GP, how much is gross profit that is there in the question? 10 lakh. And this profit of 1 lakh. How have we got this profit on sale of asset? Cost of the asset is 2 lakh 50. Return on value is 1 lakh 80. Now we need to compute what is selling price of this asset. So if in case our profit is 1 lakh and return on value is 1 lakh 80, can I say my selling price is 2 lakh 80? I made profit of 1 lakh by selling an asset of book value 1 lakh 80. So my selling price would be 2 lakh 80. So selling price is 2 lakh 80. Cost price is 2 lakh 50. How much is the selling price over and above cost price? 30,000. So what is absolute profit? 30. So I bought an asset for 2 lakh 50. I wrote it down to 1 lakh 80 and then I made 1 lakh profit. So how much did I depreciate from 250 to 180? I depreciated by 70 and I made profit of 1 lakh on sale. So that in that 1 lakh, 70,000 is compensation of my depreciation expense. Only 30,000 is absolute profit. So out of this 1 lakh, how much profit should I be considering? 30,000. Okay. So I will take 30,000 here as profit on sale of. In the color so that you understand. Is yellow fine? Correct. So then what do we have? Subsidy from government 4 lakh. Allowed, no? It is supposed to be taken into consideration. And again, when to consider the subsidy, we discuss it as per AS 12. When there is reasonable certainty that all the conditions will be fulfilled, will be taken to P&L and that will be taken here. They won't question you on AS and all within this question. Possible, but at right now this stage it's not. Going further, though, God bless people who are writing in June 2020. There are MCQs. MCQs can be case based. So all this AS 12 with AS 22 with financial statements with managerial remuneration, so So work hard for the remaining days. No matter, it's okay if you get couple of dark circles or you lose little hair. Your power of the eyes glasses will increase by another one. It doesn't matter. Put in that extra time, Mugaspadi. I'm telling you, I'm preparing material for June 2024, and I'm telling you, people, not good, not good. Finish it off now. Then, so subsidy 4 lakh we did take. Let us take the items. Staff salary and bonus to be deducted. General expenses to be deducted. Hey, will you go on telling the items from your question? I'll show the answer and then we'll do it. You can do it little faster. How many of you don't have the material? Do you have a neighbor who has a material? Who doesn't have a neighbor who has a material? You can change your place. Anyone in the class who doesn't have a neighbor who has material? Don't have anyone there? You both don't have. You have only one person. That book you sharing there. Will you see there? I'll show it on the screen. This part. Okay, now come on. Tell me what is the next item that's there? Staff salary. Allowed, not allowed? Allowed. Deduct. Then general expense. Tell what is the next item in the expense side? General expenses is allowed. Then repairs is allowed. Then allowed. Then R&D expenses. It is to be capitalized, no? Case 26. There are conditions, but it will not be considered. So not to be allowed. So remember that item. Yeah. Then depreciation. Unless they specifically mention, no. Ex gratia payments means over and above that. No, as a gratitude, we made payments to employees. That will be again not. If it is paid voluntary, if it is paid as per the terms of the employee agreement, for which the provision is made, expense is booked, then allowed. Then allowed. Ex gratia is over and above the terms. As a matter of goodwill, you paying employees some extra money. Not allowed. Got that? Then depreciation. Unless they give separately one more statement below saying that depreciation as per schedule 2, this is assumed to be as per schedule 2. Here they've told depreciation. At the end, if they give depreciation as per schedule 2, then what do? We add back this and then deduct that. If they don't tell anything, we don't have any basis to compute the correct depreciation. We'll assume that this depreciation itself is, so such depreciation will be allowed. Then bad debts is allowed. Then there is some compensation for breach of contract. This is actually allowed. This is actually allowed. Why? Legally you are supposed to pay that fine, no? It is allowed. So we'll take this compensation. And they've told they've donated some money to Ramakrishna Mission. We should check whether it is as per section 181. If it is as per section 181 and within the limits, allowed. If not, not allowed. If it is not told, you assume that it is within the legal requirement. Got that? So we'll assume that to be as per the terms. We'll take that also, compensation as well as donation. I've given it here. It is as per section 180. Interest on debentures is allowed, and debenture trustee remuneration is also allowed. Debenture trustee, remember, whenever debentures are issued beyond a certain point, we need to create debenture trust. Debenture trustee should be there, and they should sign the document when debenture DRR investments are sold. When DRR in reserve is created, it should be all after the approval of what to say, these debenture trustees. We'll read it in redemption of debentures, which will do post plan. Post plans, that was supposed to be our first topic. As of now, that's how it is. And then we have income tax expense of 3,32,500. It is paid or provision made. They have not mentioned, so it is assumed to be provision and then not considered. If it is paid, we'll take it. Sir, how do we get to know? They should mention that it is paid when it is paid. If not mentioned, it is always provision. Why? Very simple. Your assessment year starts after the end of financial year. You make the provision in the financial statements and only pay later. Now you can again question me saying, sir, what if they paid advance tax? Tax class. Here when they say income tax, it just means provision. It will be paid in the assessment year. We will pay with the 234 ABC interest. We won't pay it before. Why? At 1% I'll earn much more in my business. So I won't pay advance. What do you say? Business decision. Correct? No. Time value of money. It's okay me paying 1% advance tax interest. I'll make 20% return per month in my business. So I want my money in my business and working capital. Not in but you understood, no? I've added it back considering that it is provision and not the amount paid. Done. So when you do this, you arrive at the profit for the purpose of managerial remuneration. How much is it in this case? 6,85,000. They've told that there is only manager. They've not told that there are other directors. There will be other directors. But manager can be given how much of profit as remuneration? Maximum 5%. Compute 5% of 6,85,000. That comes to 34,250. What we are proposing is 63,920. Can we pay so much? Not possible. Can we pay so much? It is not within. Is it within limits? Not within limits. But there are certain cases where you can break the limits. Are you getting what I'm trying to tell? With a resolution in the general meeting and central government approval, these limits can be doubled. Limits can be doubled. We are assuming that they've taken such necessary steps, or we are recommending them that this much amount of remuneration cannot be paid because it is way above the limits given as per Companies Act 20. Get this? Now, based on the profit, though, we understood 5%, 10%, 11%. What if an organization doesn't make profit? Can we not give remuneration? See, even if it is loss making, managing directors, whole time directors, managers spend enough effort. In the startup culture, though, no organization will become profitable for first 4 5 years. Does that mean that managers will not get profit till the time the organization becomes profitable? No, right? So there is a provision given under the Companies Act 2013 which says that in the case of inadequate profits or losses, the beauty of the section is it says in the case of inadequate profits or losses. It doesn't say just losses. Just imagine if the provision would have told in the event of losses and the organization made 100 rupees profit, then you should give on 100 rupees 5% or 10%, 11%. So it says in the case of inadequate profits or losses, then the remuneration will be given based on the effective capital. It will be based on higher is the capital of the organization, more managerial skills required. Lesser is the capital, less is the managerial skills required. So based on the effective capital that is there in the organization, remuneration will be fixed. So there is a slab given. If the effective capital is up to 5 crores, remuneration will be 60. If the effective capital is 5 to 100, 84. 100 to 250, 120. More than 250, up to 250, you give that 120 lakhs. For more than 250, for every rupee, you give 0.01%. 0.01%. It is not 1%. You don't do into 0.01. You should do into 0.01 divided by 100. It is 1 rupee for 1 lakh. It is not 1 rupee for 100. Not 1%. It is 0.01 percentage of effective capital over and above 250 crores. Understood this? Okay. Now, what do you mean by this effective capital? Again, the definition is you need to learn to compute effective capital for this purpose. We can't take PUC plus free reserves as effective capital, or we can't take assets minus liabilities as effective capital. PUC definition is here. So, paid up capital, effective capital includes paid up capital, free reserves, security premium, debenture, and deposits which you received in long term funds. Because effective capital is a total money that the managers are handling. They might have a very bad debt equity ratio, very less equity, very high debt. Debt money is also used in the business, no? So debt money is also used means they have huge amount of responsibilities and work. So they'll get what you say remuneration based on that effective capital, which includes debt or deposit that's been received. You all get this? Current liabilities are not included. These are all non-current liabilities. When we say deposits, it is long term. Short term, 3 months, 6 months deposit received, not considered. You have received some 5 years, 10 years repayable deposit. That is as good as capital. That is debt capital. That will be considered for the purpose of effective capital. And if in case there is any revaluation reserve, you increase the value of the asset by increasing reserve. AS10 PP, you revalue the asset account debit to revaluation reserve. Such revaluation reserve will not be considered as a part of reserve for the purpose of this effective. And if there is any accumulated losses, that has to be deducted. If there is any P&L debit balance, then we take here free reserves, that is after deducting such loss. And if there is any share application money received pending allotment, that is neither share nor it is to be refunded. So they have not decided. You first decide, are you going to refund that application money, or are you going to accept that applications and then make it shares? If you have not decided it, then that's not considered. That is one thing that will come in the financial statement, because a lot of companies used to do this. If in case you raise more money by way of paid up capital, then what happens? A lot of provisions of Companies Act start being applicable to you, because a lot of provisions have limit based on paid up capital. They don't want to get covered in that, but they do want money in the form of capital. What do? We have collected application money, but we have not accepted, not told no. It's like you have proposed, but the other person didn't tell yes, didn't tell no. Kept it in pending list. So that way. So that is not allowed. That is supposed to be shown separately. That is not considered part of effective capital. Whatever effective capital you find here, no, that effective capital you see which slab does it fall. Based on that, you'll arrive. And this limit of 60, 84, 120 or 120 plus 0.01%, what is given? It is not per employee. It is not per manager or managing director. It is for all the managerial person together for entire annum. It is for all the managerial person together per annum. Are you getting this? Between them, how to share, let them fight. We don't care. but totally this is the maximum limit. You guys get this? And sitting fees is not included in this. Done. And investments, there is a beautiful adjustment called investments. Let us say the company has taken money by way of paid up capital, and company has invested in investments, shares in some company or deposits, investment in the form of fixed deposit, invested in mutual fund or all of this. So now we are giving higher remuneration with higher effective capital because managerial people will be putting in more efforts when there is more effective capital. Let us say in our organization, we'll raise 500 crores by way of capital, entire 500 crores invested in investments, and then we'll sit peacefully. What does the managing director do? Nothing. Hot seat. Now will you get remuneration because the company's effective capital is 500 crores? Higher slab? Not valid. So when you compute effective capital, we need to deduct the investments made. Deduct the non-trade investments. Non-trade investments means what? For a specific franchise, if you want, you have invested all of that should be deducted. Wherein you are not making a decision when to put the money, when to withdraw the money. If you are not making such decisions, such investment should be eliminated. However, such investment should not be eliminated if it is an investment company. Let us say our business itself is investment. We raise capital, we invest it in potential properties and then earn return. Then should I deduct it? No. Why? Because to make that investment, there is a managerial decision required. So you'll be rewarded well for that. So remember, if it is an investment company, don't deduct investments in computation of effective. If it is not an investment company, investments have to be deducted in computation of effective capital. You get this? Any doubts on this? When we quickly do a question on this, come on, let's quickly do a question on this. I would want you to do question number 28. Question number 28. And these questions, what I'm mentioning here is the questions what you can keep your last minute revision. The day before the examination, you don't know what questions to revise now. So each chapter may mention such questions what you can plan to revise. If you already have made a plan, you can stick to that. If you have not made a plan, you can stick to revision of these. Question number 28. Very good. Let's get started. So this authorized capital is time pass. Don't consider this authorized capital in the answer. Don't get tricked by this. Then we'll start with issued and share capital. So we will be considering our preference share capital, equity share capital, and we'll take capital reserve. But capital reserve in this question includes revenue reserve. Sorry, includes revaluation reserve to the extent of 60%. So in this 2,50,000, we will not be considering 60%. We'll consider only 40%. So we'll take this 15 lakh, 96 lakh. Share suspense, we won't take. What is the share suspense? That is share application money received pending allotment. It is suspense, whether it is a share or not a share. Get it? So take 15, 96. 2,50,000 may you take 40%. Security premium, consider, not consider. Consider. 15% debenture, 65 lakh. Consider. Which one? Which advance? Shares, share advance received. Calls in advance. Calls in advance is not part of paid up capital. It is not paid up. It's not part of paid up capital. It is simple, ma. When you ask them to pay and they pay, it is paid up capital. When you ask them to pay, they don't pay. They didn't pay, not paid up. When they pay more, you have not asked. It is not called up only. How can it become paid up? Paid up is always part of called up capital, which is received. Calls in advance is not part because it is not called. Calls in arrears is not part because it is not received. It should be called and received to be part of paid up capital. Got that? Yes. If in case you include it in paid up, you might have to end up giving dividend on it. We won't. We only give interest. We charge interest, we give interest. Done. So you will take equity capital, preference capital, will not take share application money received pending allotment. Capital reserve will take only other than revaluation reserve part, that is 40%. We take security premium, we take debentures. Public deposits, we should check whether it is long term. If it is long term, we would take it. If it is not long term, we will not take it. That is one assumption that we would have to make. This SBI short term loan, sundry creditors are all not considered. Now the question is investments. You tell me, what do we do with this investment? Depends whether it is an investment company or not an investment. If the company is an investment company, we will not deduct it. If the company is not an investment company, we have to deduct this 75 lakh. And profit and loss account, this has to be adjusted. We would have to deduct this and we would have to deduct our preliminary expenses from our results. So you take equity share capital, preference share capital, capital reserve after eliminating revaluation reserve. We'll take full security premium, full debentures, and public deposits under an assumption that it is long term. Got it? And then Investment in shares and debentures is eliminated. Why? Because we are assuming it is a non-investment company. P&L and preliminary expenses should be actually adjusted against these reserves only, no? So we'll take it as fine. That's how we arrive at effective capital. How much is effective capital? 90 lakh 40,000. Now come to the slab here. Slabs mean what do we have? First slab, less than 5 crore. Less than, because it is less than 5 crore, what is the maximum remuneration? Very good. So maximum possible remuneration that can be given on this is how much? Can these limits be increased? Can we give more than 60? Yes. By special resolution and in general meeting and by central government approval, you can double the limits. You can. There are certain conditions. You need to comply with conditions given under Schedule 7. Should have done no default in repayment of deposits. Should have done filed your annual accounts and annual return on time. No director should have done default. All of those things are there. The 3 years condition. There are a lot of other conditions. It should be fulfilled. There should be no failure in dividend compliance or interest on debenture compliance. All of that, if it is complied with, then you can double the limits. But that's after resolution in the general meeting and approval from central government. So we are done with this part, effective capital. Got this? Okay. Any part of this unit 1 of chapter 4 which is bothering you, which would want me to touch upon? Nope. So this calls the end of our chapter 4 unit 1. For those of you who would want to put timestamp on YouTube, you can put that. So this is unit 1, preparation of financial statements, done. And now let's start with unit 2. Our initial plan was to do this from 9 o'clock to 9:40. We did it from 10 to 11. We did 1 hour. 1 hour is what. So not bad. We took 15 minutes extra. We took 60 minutes. And this is the first topic, no? So we took slightly more time. Let us do the next one. Now tell me, what will be our target? 11 a.m. to 11:45. 45 a.m. Okay, let's see. Let's keep an aggressive target of 45 minutes to finish cash flow statement. Shall we quickly start with cash flow statement? So 4.2 cash flow statement. There are 3 topics that you should learn from the topic of chapter of cash flow statement, and questions also can come on these 3 topics. Number 1 is cash and cash equivalent. This is something which people take very lightly. What you should not take very lightly. There are questions that has come in the exam for 5 marks, 4 marks on competition of only cash and cash equivalent. Only cash and cash equivalent. Remember that cash and cash equivalent definition as per accounting standard 3 is different from cash and cash equivalent as per schedule 3. Whenever you see any company's practical financial statements, now you people in how to say articleship, so you might have already seen financial statements. People who are not in articleship, just download financial statements of some company online and then see. Schedule 3, when they prepare their balance sheet, there whatever they write as cash and cash equivalent, and the same company's cash flow statement, opening cash and cash equivalent, sorry, closing cash and cash equivalent will not match, need not match. They'll do one more reconciliation table. Why is there a difference between these two? What is there in this cash and cash equivalent which is not there? Are you getting it? Because the context is itself is different. One accounting standard, one schedule 3. One is law and other one is standard. So there is difference. So let's quickly start. What is cash flow statement? It's a statement. And it is prepared, see the regular classmates. So it is prepared as a mandatory part because section 129 of Companies Act 2013 talks about financial statements. That definition includes, that's an inclusive definition. It says it includes balance sheet, statement of profit or loss, notes to accounts, cash flow statement, consolidation statement showing changes in equity, and other significant accounting policies. So because this cash flow statement is part of section 129, it is mandatory for all the companies to prepare cash flow statement whenever they prepare their financial statement. When they say financial statements, cash flow statement is also part of it. There's no skipping. There are very rare exceptions, but for now, let's skip them. You read it in now. Okay, let's get back. So the logical answer is, why do we prepare cash flow statement? Don't we prepare cash book? Cash book where there is inflow, outflow, no? It's there in cash book. Why do we prepare? Answer is very simple. Cash book is nonsense. Cash book is insufficient. Cash book is not at all adequate to make decision making. Cash is the main part of the business. If in case you have control over the cash, you have control over the entire business. How the cash flows into the organization will tell the health of the organization. If in case, just imagine, you're drawing graph for all the cash flows in an organization. When you're drawing graph, let us say, I understand, no, there are 3 varieties of cash flows: operating, investing, and financing. In an organization, operating cash flows are slightly increasing. What does it mean? The organization is in the growth stage. Organization is in the Let us say investing cash flows are decreasing. What does it mean? Again, the organization is in growth stage. Why? Initial years, may investing outflow will be more. Investing outflow will be huge amount of money is outflow. And as the time progress, entire infrastructure is set up. No, entire infrastructure is set up. So there is no much of outflows on investing activities. Are you getting what I'm trying to tell? Or let's say after that, what happens? Okay, fine. If you draw a timeline, like this is the zero, this is minus, this is plus, this is zero, this is minus, this is plus. If that's the case, investing activity will be where? It will start from minus. No? It will slightly become towards zero. There will be cash outflow. It will become zero. After that, if it becomes positive, what does it mean? Investing cash inflows are there. That means you are selling assets. Organization is closing. Are you getting what I'm doing? Financing outflows, huge inflow, financing. What does it mean? Organization is expanding. Financing outflows are there. What does it mean? Capital is being repaid, debenture is being repaid, company is closing down. So you can tell all of this. In cash book, what do you do? Receipts one side, payments one side. You don't even know what receipt is it. Is it operating? Is it investing? Is it financing? Not eligible as a financial tool for decision making. So this cash book presented in a way that it can be used like a financial tool for decision making is cash flow statement. So what do we do in the same cash book? Receipts, payments are there. Each of the receipts will be classified into three categories. Is it from operating activity? Is it from investing activity? Is it from finance? Same with regard to each of the payments. And we write all the operating items at one place, all the investing items at one place, all the financing items at one place. So that we'll understand what is the stage at which the organization is there. Where is the cash coming? Which activity has cash inflow? Which activity has cash outflow? You get this? So if you would have to do that, we'd have to do it as per accounting standard. As per accounting standard 3, cash and cash equivalent. Cash equivalent definition is readily convertible, insignificant risk, short term, highly liquid items. So I call it rich. When you have too much of cash, no, you become rich, but you should not tell everyone that you are rich. You should tell, you are about to tell that you are rich, but you hear someone saying Shh. So it is RISH. Thumb rule to remember. RISH. What is R? Readily convertible. I. Insignificant risk. S. Short term. And then H. Highly liquid. Readily convertible means it should be readily convertible into cash. Now you cannot call land, building, plant, machinery, furniture as cash. You can convert it, but it's not readily convertible because there is significant risk involved. Let us say you recorded one land at 1 crore rupees in your balance sheet. When you convert it into cash, you want to convert it into cash in one day. Will you get 1 crore? No. You want the price that that asset has. You need to wait for a good amount of time to find the potential buyer, get the documents checked, transfer it legally, and then get the money. So if you have to do it in a very short term, you might end up selling it at a loss. Getting it? When you sell it at a loss, there is certain value to that asset. In the balance sheet, it's there at 1 crore. If it gets converted to 80 lakhs, then there is a 20 lakhs difference. No, that is risk. What is risk? Risk is actual being not in same lines of expected. Actual and expected being different is the risk. You read it in audit, no? Audit risk, opinion risk, sample risk. What you give as an opinion might not be the actual opinion. Opinion, sample risk. Sample that you pick from the population might not represent the population. Sampling risk. Correct or no? So here there is significant risk involved, meaning the value that you realize on conversion of that to cash and the value at which it's there in the books are huge difference. That is significant risk. There should be insignificant risk, nominal difference. You have savings bank deposit. When you convert it to cash, it is same, no? In fact, bank balance is cash. Let's say you have one investment. If you convert it into cash, shares you have. If you sell it into, or if you sell it and then take cash out, you might not get the same value that is there because of the market fluctuations. There is risk involved. So there is significant risk. It's not part of cash and cash equivalent. So to be eligible to be called as cash and cash equivalent, it should be readily convertible, insignificant risk, and it should be for short term. You have a fixed deposit for a period of 3 months. Cash and cash equivalent. Cash equivalent. If in case you have a fixed deposit for 4 years or 5 years, not cash equivalent. It is not cash equivalent. You get that? Then highly liquid. It should be, there should be a ready market to convert that into cash. If in case there is no readily available market to convert that into cash, then it will not be considered as a part of cash equivalent. So all these cash equivalent and cash items, we will not write them in operating, investing, or financing. We add all the opening balances, call them opening cash and cash equivalent. We add all the closing balances, call it closing cash and cash. Got that? Now, what does the activities include? Financing activity, investing activity, and operating activity. Financing activity deals with all such items which are related to raising of funds for the business. for the purpose of issue of shares, equity preference doesn't matter, issue of debentures, borrowing money from financial institutions by way of term loan or any other loan, payment of dividend, payment of interest, redemption of preferences, redemption of debentures, buyback of equity shares, all of this is financing activity. Some of them are inflows, some of them are outflows. However, investing activity is purchase of assets, purchase of shares, purchase of debentures. All of this will become investing activity. Are you getting this? On these investments, what we have purchased, if in case we receive interest on these shares that we have purchased, we receive dividend, that is return received on the investments. You get this? So that will become investing activity. If we pay dividend, if we pay interest, it will become financing activity. However, such a dividend interest can become operating. When? If the nature of your operation is investing, if your nature of your operation is financing, you are a financing entity. You borrow money, you lend money. You borrow money, you lend money. Then in that case, such interest will become operating. Such dividend income will become operating. Are you getting what I'm trying to tell? Yes or no? However, the dividend paid and interest paid on debentures will continue to be financed. Interest on short-term things will only become operating. Now, I borrow 1 lakh rupees from you for a short term, give it over to loan to somebody for 1 month. I collect 12,000 interest here, I give you 10,000 interest. Then the 10,000 what I paid to you is my operating expense, 12,000 what I received is my operating income. However, I've issued debentures to you and collected money from you, that time using for my business of lending. That debenture interest what I pay will continue to be financing, it will not be operating. Again, that current non-current differentiation is what. So this is one thing that you need to catch, which I made it easy here. Let's quickly see this. Dividend paid will be always very good. Dividend received, if it is for financial enterprise, it will be operating. If it is other than financial enterprise, it will be very good. Interest paid for financial enterprise, operating. Other than financial enterprise, interest received for other than financial enterprise, it will be investing. For financial enterprise, it will be operating. Be little cautious about long term and short term when it comes to interest. Got this? Then we have two different methods how to prepare the, unless they specifically mention, don't assume that an enterprise is finance. They should tell that this entity deals with finance related things. They only borrow and lend money. If they don't tell, it is not financial enterprise. Got that? So then we have a question to do on cash and cash equivalent computation. So shall we quickly see this question or skip it? See? Okay, come to question number 6. So this is a slightly interesting question because you need to do a small BRS also to arrive at the balance as per cash book. They have given balance as per passbook to start with. So what is the balance as per passbook that is there in your question? 20, page number 74. Balance as per passbook is 25,000 and they've told that certain checks are issued but not presented to bank. When the checks are issued, cash book balance has gone down, it is not presented, so passbook balance is not. So we're making changes in passbook, so we should reduce it to identify the balances per cash book. So from 25,000, I'll deduct that 15,000 checks which is issued but not presented to arrive at the balance as per cash. Balance as per cash book 10,000 is our cash balance. Along with that, they've given short-term investments in liquid equity shares. Equity shares has significant risk. Equity shares has, sir, equity shares are invested in the company where the person in power is very much interested. That and all we don't care. There is risk involved. Don't consider this as a part of our cash equity. Fixed deposit created on 1st of 11, maturing on 15th of April. So it doesn't matter even if they made fixed deposit for 5 years. On the date when we are doing this, if it's going to be liquid in the next short period of time, then it will be considered as a part of cash equity. So when are we doing this? 31st of March. When is this maturing? 15th of April. 15 days may it will mature. Is it part of cash equivalent? Yes or no? Yes. 75,000 is. Then what do we have? We have short-term investment in highly liquid. See, they've covered the definition. Short-term, highly liquid, They've told. And sovereign debt mutual fund. Sovereign debt means supported by, backed by the government of India. So this would be part of our, I would say, no insignificant risk involved items. So this 1 lakh, will it be considered? Yes, it will be. And then we say there is bank balance in foreign currency account in India. See whether it is there in sari or not there in sari. Lakshmi is Lakshmi only. You get this? So this dollar 1000 whatever is there, it is also cash. It might be there in dollars, it might be there in pounds. We don't care. You get this? It's still part of our cash always. We should include this dollar one. You get this? So we should include this dollar 1000 in Indian currency. What is the conversion rate that is there? So they've told two conversion rates. On the date of deposits, it's 69. As on 31st of March 2019, it is 70. So it is a monetary item. We should take the closing rate. So we'll take 70. Dollar 1000 into 70 is how much? 70,000. So this 70,000 will be considered as a part of our cash and cash. You get what I'm trying to tell? Doubt? Then we won't take it because there will be risk involved. Don't include it as a part of our cash and cash equivalent. It will become investing. If it is, yes. If it is investment based company, then it will become operating. If it is not investment based company, then it will be investing. So that's how we compute our cash and cash equivalent. There can be small questions like this in the examination on computing cash and cash equivalent, or in a bigger CFS question, they'll give these items here and there. You should not take them in operating investing, but remember to take them separately into our cash and cash equivalent. You get this? Next, quickly let's see the methods. So we have two methods to prepare our cash flow statement. One is direct method and the other one is indirect method. So under direct and indirect method, our investing and financing activities will be same. The only point of difference is computation of operating activities. Same question solved under direct method and indirect method should give you same cash flows on each of the categories. In fact, one of the question I'll show it to you how do we get the same cash flows under both the methods. I put it, but let's see. So the only difference between direct and indirect method is computation of cash flow from operating activities. Under direct method, it is literal presentation of your cash book into from receipts and payment account to statement. So there we write receipt payment, we'll write receipt minus payment. That's the only difference from cash flow statement under direct method to cash. Whereas under indirect method, we don't take it straight. We don't take it straight like that. We analyze it. How do we analyze? See this analysis of financial statement. So this is your balance sheet and this is your P&L account. If you remember the cash flows, whatever activities you know, in this balance sheet, this first three items, whatever is there, shareholders fund, share application money received, pending allotment, and non-current liabilities. These three actually represent finance activities. And in the balance sheet asset side, non-current assets represent investing activities. P&L account, whatever is there, is everything operating activity. Am I right? And income is inflow, expense is outflow. Income is inflow, expense is to the extent it is earned but not received, it will be current asset. Incurred but not paid will be current liability. If this all incomes are received, sale is made, amount is received, there will be no current asset. There will be only cash. It will go to cash and cash equivalent. Sale is made, amount is not received, it will become current asset. Purchase is made, amount is not paid, it will become current liability. So if expense is fully paid, income is fully received, there is no current asset, current liabilities except cash. So P&L account में whatever profit you get here is nothing but your operating cash flow. Your cash, your business is cash business. I sell goods to you 100 rupees, you keep 100 rupees and then take. Your net profit is your cash profit. I can easily tell net profit as per P&L account is my cash flow from operating activity. However, business runs on credit. So the credit arising because of this revenue and expenses will be current liabilities and current assets in the balance sheet. So can I say balance sheet liability side is financing activity, balance sheet asset side is investing activity, P&L account is operating activity. Current liabilities and current assets, what is there in balance sheet is also operating activity. Got it? Under direct method, what we do in the cash book, receipt side, whatever is operating, payment side, whatever is operating, we write them together. Receipts from operations, payments during operations, that is cash flow from operating. However, when I start indirect approach, I won't do that. I start with my net profit as per P&L. I start with my net profit as per P&L account. Why? This revenue from operations is income. All these expenses are payment. So I'll take this. This should be my cash, or to say cash from operating activity. But actually it is not. Why? In these incomes, there might be some income which is non-cash. In these expenses, there can be some expenses which are non-cash. Similarly, there can be some incomes which are cash but not operating. And in these expenses, there can be some expenses which are cash but not operating. Interest paid, which is financing, or here some dividend received, which is investing, sale of asset, which is investing. So all of these will be there. So we need to eliminate them. We need to, rather than freshly identifying cash flow from operating activities, cash flow from in or to say cash flow from operating activities payment, instead of taking that, we'll take net profit. In that, I'll say remove whatever is not required, so that I'll be left with cash flow from operating activity. You get this? So that's the reason we start with net profit as per P&L. So this to you. We'll start with net profit as per P&L account. So P&L account is after deducting all the expenses from income. If there is any non-cash or non-operating income credited to P&L, if there is any non-cash or non-operating income already credited to P&L, because of this net profit is increased. No? Now when we eliminate it, profit will decrease. So non-cash or non-operating income credited to P&L should be deducted. If in case there is any non-cash or non-operating expense which is debited to P&L, because of which profit has come down. Now if I eliminate it, what will happen to my profit? So I will add back. You all get this? And when you eliminate it from here, it should get included in financing or investing. Just check with that part. So I know you people would have remembered it in some order or some list of items, but try to fit this logic in. This will make your life little simple. And I told you, not items relating to operating are not there only in P&L. Some items are there in balance sheet. What items are there in balance sheet? Current asset, current liabilities. Current asset, current liabilities should be included in cash flow statement operating. How do? We will not add it or deduct it to profit. From the profit, when we do add back this non-cash items, non-operating items, deduct this, all of this, we get cash flow from operating items. Cash flow from operating items before making changes for working capital. Then we write changes for working capital. Changes for working capital is the difference arising between current asset and current. Changes changes in working capital. How do we do this? I don't know how you people remember. The logic is very simple. Take current assets. For current assets, do opening minus closing. For current liabilities, you do closing minus opening. Why? The reason is very simple. Let's say current assets. Opening is 10, closing is 12. What does it mean when opening is 10 and closing is 12? Let's say we have stock of 10 in the beginning, stock of 12 at the end. So stock increased by 2, which means you purchased stock. When you purchase stock, you pay 2000. So outflow. Opening 10, closing 12. 10 minus 12, minus 2. Are you getting it? However, for a liability, let us say you had creditors of 12 in the beginning, creditors of 12 in the beginning, creditors of 10 at the end. So how did the liability decrease? Because you made payment. When you make payment, cash will decrease. So 12 closing minus 10. Or let's say opening is 10, closing is 12. So creditors increased. That means you purchased stock. When you purchase that stock, such stock will be sold. When it is sold, there will be inflow. So that way. So if you're fitting in the logic, you can do things. But I would honestly tell you, don't waste time thinking so much. So for current assets, you do opening minus closing. For current liabilities, you do closing minus opening. If you have some set of current assets, add all the current assets total, add all the current liabilities total, and then do it. Or each current asset, you do opening minus closing, closing minus opening. Current assets, A starts with A. A is the first letter, opening minus closing. Current liabilities, CL, CL minus closing minus opening. Some dumb logic, whatever you want to. So then once you arrive at this cash flow from operating activities, after we need to adjust tax. Now a lot of them might feel like tax will get adjusted here. Don't adjust tax here. Don't adjust dividend also. The only reason is tax provision is made in the current year, payment is made in the next year. Provision is made in the current year, payment is made next year. So what you do, entire provision that is made for tax should be added back because it is non-cash expense debited to P&L. It is operating, but it is non-cash expense debited to P&L. So add it back. Whatever tax paid is given to you, that you deduct. Get this? So let's say they have told provision for tax 10,000, opening, closing 12,000. What does it mean? 2,000 is the provision created. No, 10,000 is fully paid, 12,000 is fully provision created. Let me repeat. Let us say the opening provision for tax is 10,000. Closing provision for tax is 12,000. When opening provision is 10, closing provision is 12, does that mean that we have created provision of 2,000 during the year? No. Entire opening provision of 10,000 is paid. Entire 12,000 closing provision is created during the year. So what do? We add back 10,000. Sorry, we add back 12,000 provision created during the year. We deduct 10,000. You might say, sir, net difference is 2 only, no? If I do like that, 2,000 provision created and then add it back, my answer will still be same. Your answer will still be same. Your cash flow statement, cash flow from operating activities will still be same. Your cash flow statement will tally, but not your marks in the mark sheet. Marks will be deducted because this entire chapter 4 is not computation based. It is present. You don't compute any number. All the numbers are there. You just figure out where to write that number. Should I repeat? Opening provision 10, closing provision 12 for tax. There is increase in 2. You can say, sir, 2,000 is a provision created during the year. Provision is non-cash expense. Am I right? So provision is non-cash expense debited to P&L. So I will add back 2,000. If you do this, your cash flow statement from operating activity will match with the answer given in suggested answer. But marks will not match. What do? 10,000 is the opening provision. Means what? Last year you had done provision in the last financial year. That tax will be paid in the current year. So tax paid is 10,000. Cash outflow is 10,000. You deduct 10,000. And 12,000 is the closing provision this year. That is because for this current financial year, you have created 12,000 rupees provision. So that 12,000 is the provision created during the year, which would have to eliminate. Unlike other provisions, provision for bad debts and other things, provision for tax is year specific. Provision for bad debt, you just write provision for bad debt 2%. Provision for tax, you write provision for tax 2013-14, provision for tax 14-15, provision for tax 15-16. Year wise, you maintain separate provision account. Those of you in article sheet, you agree with me. When you see financial statements, will there be only one provision for tax ledger? There will be so many provision for tax ledger, advanced tax ledger, TDS ledger. ಅದೆಲ್ಲ ಸೀನಿಯರ್ ಕೊಟ್ಬಿಡ್ತೀರಲ್ಲ ಇದು provision. You tell me how to do what amount to write, but just understand that provision will be year specific for tax. Did you understand this part? Same with dividend again. Last year whatever dividend is recommended and then proposed and written will be paid this year. What is made this year will be paid exception interim dividend, which is declared in the same year and paid in the same year. Is it too overwhelming? Am I going too fast? Are you getting it? The day before the exam, it will be like this only for you. You would have to run like this only. If not, you won't be able to finish. So I've told you this part. Mathematical logic also I've told. Then dividend part. Okay, quickly read through this. Proposed dividend and provision for tax. Though they are current liabilities, don't adjust in changes in working capital. What should we do? We need to open a ledger account for them because provision, previous year provision is paid during the current year and current year tax provision will be paid in the Akka. Can you go forward? Sure. And this I'll explain to you when we're doing a problem. Shall you quickly take up a problem on cash flow statement? We'll do one question on this. Yeah. Okay. I'll tell you which question to do. Should I solve in complete? I would recommend at least this topic. This topic deserves such discussion in detail. Shall we do it? Question number 20. Sorry, question number 15. Is it indirect approach? Is question number 15 indirect approach? I'll teach you how to solve the problem. Yeah, closing and opening balances are given. Shall we do this? 15th one. Okay. In this question, they've asked only operating activities. Or if you straight away, if you're doing two questions, we'll do 15 and 24. If you're doing only one question, I'll do only 24. Two questions or one question? Two questions. We'll do 15 and 24. Okay. Come on, let's do question number 15. I'll just clear this screen and then we'll do it from the screen. After this unit, we'll take a break. Shall we? I was seeing the list of topics that you had written and given them. You remember one of the last days? Paper is there with me. I was checking it today morning. Okay, guys. Great. I am ready. Are you ready? We'll solve the question from the scratch. Have a look at illustration number 15. From the following particulars, calculate the net cash flow from operating activities. Shall we start computing cash flow from operating activities? They've given P and L account balance. Opening to be 1000, closing is 7000. Usually they first give opening column, then give closing column. Some questions to trick you, they'll give closing column first and opening. Don't do the entire answer ulta. You might not even get 0 1 for 1 0. You get 0 0 only. So opening is 1000, closing is 7000. So profit and loss account, which is reserve. This is like P and L reserve, accumulated profit. This is not P and L account. In P and L account, you'll have GP brought down and NP carried down. You will not write balance brought down, balance carried down. So there is 6000 increase in the profit. You cannot say 6000 is current year net profit. Why? Some appropriations also can be there during the year. Whenever you don't know, remember to say the answer as don't know. Don't try to guess the answer. So opening is 1000, closing is 7000. Why? How much is the difference between them? Don't know. What is the answer? There can be 6, but there can be inflow of 10 and outflow of 4. No. So the answer is don't know. So when you don't know, what do you do? Wait till you get to. Wait till you. I'll open P&L reserve account. I'll open P&L. Opening balance is how much? 1000. I'll write on the credit side. Closing balance will come on the debit side. To balance carried down 7000. Just write like this and then first page you leave for cash flow statement. Second page you start doing working. At the end of the problem, all the ledgers will be filled. And in each ledger, whatever balance and figure you get will affect cash flow statement. Yeah, you'll understand. You'll love it at there. Come on, let's wait till general reserve. Opening is 10, closing is 15. How did it increase from 10 to 15? Don't know. What is it? Don't know. So what do we do? Open one ledger. Usually people follow one shortcut here. They say 1000, 7000 difference, 6000, and then 10,000, 15,000 difference, 5,000. 6 plus 5, 11,000 net profit. Then what if they give at the end of the question dividend paid 21,000? Don't do that. So instead, wait. Instead, just wait. You will take the same amount of time. You will not take extra time. If in case you try to save time here, no, by doing this 6, 5, or this something, you will take 6 months extra, which is scary. Don't do that. So general reserve, opening 10, closing 15. Where do we write? You open general reserve ledger. You open one general reserve ledger. How much is opening balance? 10. Closing balance, got this? Opening balance credit side, closing balance debit side. What is after general reserve? Dividend payable. Opening 21, closing 25. Does that mean 4000 is paid or 4000 additional provision created for dividend? Firstly, provision we won't create for dividend. Dividend is declared. And last year 21,000 is there, no? First that will be paid. Then you will make further 4. You cannot like, okay, last year 21,000 declared, not paid. This year I'll declare 4,000. Ella accumulate mabutto, sayakenta muche pay marte. No, you need to transfer the dividend to a separate account within 7 days, paid within 30 days. If not, within next 7 days, it will go to unclaimed dividend account. There it will stay for some time and later it will go to IEPF. From where how to use the funds can be told only by SEBI. SEBI will tell these mutual funds are subjected to markets. Please read the offer documents carefully before you invest. That will come. No, that is using IEPF funds only. So it will be used for investor education and investor protection. Mutual funds is like cricket field. Zyada der tikega, so zyada der right. All that will come using that IEPF funds. How to use that funds will be decided by SEBI. So not paying the dividend what is declared is a very big mistake. You cannot afford to do that. So this 21,000 will be paid. This 25,000 is freshly declared unless there is some interim dividend. So right now, do we know? Don't know. What do we do? Open one ledger, dividend payable account. How much is opening balance? 21. How much is closing balance? 25. Just write this much and then wait. Okay, now just change the order. I'll send general reserve up. Bring this down. Sir, why? Aage, for your comfort. Got it? Then next item. Provision for tax. Opening 15, closing 25. Does that mean provision created during the year 10? No. Last year's provision 15 will be paid. Restly we created provision of 25. So I'll open one provision for tax ledger. I'll write by balance brought down. How much is opening balance? 15. How much is closing balance? 25. Clear? Let's go to the next item. After provision for tax, we have debentures. How much is debentures? 21 opening, 25 closing. So does that mean 4,000 worth of debentures are issued during the year? Don't know. What if you assume it is 4,000 issued and then write it in your financing activity? But later it turns out that some loan was converted to this or some stock was purchased and debentures were issued. You're getting it? Don't take chance. Open debenture ledger. Opening balance 21,000. Closing balance 25,000. And wait till the end. Wait till the. Then what do we have? Trade payables. Trade payables don't open ledger, please. Trade payables changes in working capital. Trade payables changes in how much is opening? 8,500. How much is closing? 1,17,500. Trade payables is current asset or current liability? Current liability. CL. So we should do CL minus OP. 1,17,500 minus 8,500. Shall I write it in our cash flow statement? In our cash flow statement, we'll start with cash flow from operating activities, net profit. We'll do a lot of adjustments. After we do all those adjustments, then what do? Changes in working capital. In changes in working capital, first item trade payables. How much trade payables? 1,17,500 closing minus opening 8,500. That will be 1,09,000. Am I right? If in case you think, sir, how much space to leave here, I don't know. Then do this as one separate working note. Changes in working capital. Write the total amount here. Changes in working capital. So much amount. Will be still be given full marks. Unlike your schedule 3 format for balance sheet, there is no format printed and given with schedules for cash flow statement. There is guidelines given, instructions given. There is no specific format like this item should come first, this item should come next. Operating, investing, finance is there. Within operating, items are not frozen. Are you getting it? Yes. What do we have after trade payables? Machinery, asset. 50 became 44. How? Depreciation 6? Don't know. There might be some purchase, there might be some sale. On that sale, there might be some profit. So many things are possible. Got it? So we'll open one machinery ledger. We'll open one machinery ledger. And in that machinery ledger, I'll write opening balance. How much is opening balance? 50. Closing balance. Done. After 50 and 44, what is next? Goodwill. Sir, goodwill became 10 to 8. Correct? Huh? Does that mean amortized by 2,000? No, can be sold also. Can be, if it is sold, investing activity, inflow. If it is amortized, then it is operating, non-cash expenditure debited. There are several other things possible. So we will not take a chance. What do? Open goodwill ledger. Opening 10, closing. What do we have after goodwill? Discount on issue of debentures. 200 rupees expense was there, it has become 0. Maybe it is amortized during the year. We will not take a risk. I'll write there is a discount on issue of debentures. Opening 200, closing 0. Oh, closing 0. Closing balance is 0. Done. After discount, what do we have? 10% current investments. It is current investments. Shall we take it as cash and cash equivalent? No. It can be shares, it can be debentures. Only if it fulfills all the four conditions: readily convertible, insignificant risk, short term, and highly liquid, we'll take it as cash equivalent. Otherwise, we won't. So this will be current assets. What will this be? Alva. Sir, why won't we take it as investment activity? Current investments, not non-current investments. How much? Oh, sorry, current assets, what do we do? Opening minus closing. How much is opening? 3. How much is closing? 8. So 3 minus 8. 3 minus, correct, minus 5. If you don't write minus 5, you answer me, they'll do minus 5. 3 minus 8, minus 5. What do we have after that? Inventories. Don't open ledger. Current assets. Inventories is, again, we should do opening minus closing or closing minus opening. How much is opening? Closing. So do here inventories 6,000 minus 24,500. 18,500. What do we have after inventories? Then we have trade receivables. Trade receivables again is current asset. We do opening minus closing. 7,300 minus 1,12,300. Shall we do that? What do we get? 1,05,000. Then cash and cash equivalent. Current assets. Shall I do 0 minus 17,700? No, this is the point for which we're doing the entire statement. This will come separately. Net cash flow, opening cash equivalent, closing cash equivalent. Got it? But in this question, we're doing only cash flow statement from operating activities. Investing and finance, we're not doing. So we'll ignore this for the moment. We don't have information of investing and financing. If we would have had, we would have done. So this table is over. Now we'll read the information given here. Income tax paid during the year is how much? 21,000. Now come to our provision for tax ledger. When the tax is paid, entry is tax account debit to cash. In our provision for tax account, I'll write to cash. Tax paid during the year 21,000. This tax is paid, cash outflow. I'll write in my cash flow statement. Where do I write? Here I'll write cash flow from operating activities before tax, which I don't know, plus tax paid. How much? 21. Are you getting it? Exactly like how we do accounts, any final accounts. Items which are there in the accounts only once, items which are there in the adjustment 2 times. We wrote it once in the ledger, once in the statement. Then what do we have? Dividend paid is 21,000. So dividend paid, dividend paid, dividend paid, dividend payable. 21,000 was payable, 21,000 is paid. Entry is dividend account debit to cash, 21. So we wrote once here, liability is decreasing, dividend is paid, it is cash outflow. Where? Financing activity. Here the statement is only for, will we write here? We will not write here. Sir, here we should close this dividend ledger, close this provision later. Once we finish all the adjustments, we'll do it. This adjustment, there are no adjustments in this question. If it was there, some other adjustment, we'll do all of it and then close ledgers. Don't start closing the ledgers in the middle of the problem. First, give priority to write all the data that is there in the question in the form of ledgers how you want it. Once you finish the question, then you start your assumptions for the data that is not given in the question. So we have one last item. New debentures and new investments were issued or acquired at the end of the year. Why have they told this? It is issued or it is acquired for helping us adjust our interest. So new debentures are issued at the end of the year. So we don't have to give any interest on the closing debentures. We have to give it only on the opening debentures. So 21,000 was the opening. Closing is 25. So there is 4,000 worth of debentures issued. This is balancing figure by cash. Where will we write this? In the financing activity inflow. Correct or not? This will write it in financing activity as inflow. Are we preparing financing activities here? So ignore this. Got it? Remember this 4,000 is happening on the closing date. Understood? So interest will be computed only on 21,000. On 21,000 debentures, we'll give 10% interest for 12 months. On 4,000 worth of debentures, we'll give 10% interest for 0 months. Why? It is issued on what date? Are you getting this? Noted? Then what is the next point? New investments were acquired at the end of the year. Investments, we don't care. Why? We already adjusted it in where? Changes in inventory. Sorry, changes in working capital. But here, when we again compute interest, opening is how much in this? 3,000. Will we write interest income on 3,000 or 8,000? 3,000, not 8,000. So 3,000 into 10% is the interest income which is included in P&L account. which is included in the profit that will start here. But that is not operating income. So what do we have to do? Eliminate. That is interest income already included, because of which profit has gone up. Now we should decrease. What you do now, if you think the answer is plus, you do minus. If you think the answer is minus, you do plus. Because there is 50% probability. You're always in the other 50%. Do that next time. My friends used to do. They used to ask my session. Do exactly opposite. That is little hurtful, but it used to work for them. So then we add back or less our non-cash and non-operating items. Here, the first one is interest on debentures. Interest on debentures, on what debentures do we compute? Do we compute it on opening or closing? Opening. Why closing is made that 21,000 andre 4,000 is, opening is 21. 4,000 is issued at the end of the year. We don't have to give interest on that during the current year. On 21,000 debentures, 10%. How much is interest? 2,100 rupees is the debenture interest, which is debited to P&L account, which is non-operating expense debited to P&L. Because of this non-operating expense which is debited to P&L, our profit has decreased. Correct or not? Now we need to find cash profit. What do we do? Increase. Cash operating profit. Shall I add back? Okay. How many of you still find it difficult when to add, when to deduct? Logic artha aita? Little no, make little noise no. Done. After that, this investment, opening balance no, on 3,000, interest of 10%. How much is interest of 10% on 3,000? 300 rupees is interest received, included in income. Because of this, our profit has increased. It might be received in cash, but is it operating income? It is non-operating income. What do we do? Eliminate. When I eliminate, what happens to my profit? Decrease. So I should decrease it. I'll write here. What is it? This is 21,000 into 10%. Interest on investments minus 300. Minus, you don't have to write add item separately, less item separately. Add idre plus barri, less idre minus barri. Don't try to segregate. It will take too much time. Yeah. What's after that? Now we're done with the entire question. We just need to close the rest of the statement. We don't know profit also. Shall we close it? Come to our ledgers. P and L reserve account. P and L reserve account. Opening 1,000, closing 7,000. So what do you think is the difference here? There is appropriation and there is also net profit. Net profit earned during the year will come from P&L account to here. Do you agree with me? Yes or no? We need to find this as the balance sheet. Don't write 6. Why? From this P&L account only will give dividend. From this P&L account only will transfer to general reserve. So P&L account is the last ledger to be closed. P&L account should be the last ledger to be closed. Once you close this, general reserve only 10 is there, 15 is there. 5, where does it come from the sky? Where does it come from? P&L. So this is already closed. No, you can't write this. So close this at the end. Close this at the. If you don't close this at the end, first if you come write this year net profit 6,000, then again here difference of 5,000 you should write add it to net profit. So don't do that. This will be the last ledger to be closed. Now come to general reserve. Opening 10, closing 15. So what has happened? During the year we have transferred some money to reserve. How much? 5,000. So in general reserve ledger, I'll write by P&L. So in P&L I should write to general reserve. How much? Understood? Then this ledger is closed. Yes or no? 15. Then comes to dividend payable. 21,000 last year's dividend is paid current year. 25,000 is payable. So that is the dividend which will be paid out of current year profit. Am I right? Current year profit will decrease. I'll write here by current year P&L account 25,000. That's how I close my ledger. In my dividend payable account, I've written by P&L. Am I right? In P&L account, I'll write to dividend payable 25,000. Now you will find the balance here easily. Let them give 3 more reserve accounts. Very easily we do. If you don't do this, you usually prepare one table, no? Difference in P&L, difference in general reserve, difference in, don't do that. That's little irritating. That's not organized. It is not double entry system. Got it? So now automatically you'll find it. Will you find this now? No. This will be the last ledger to be closed. This is the last nail on the coffin. So we will wait. We will wait. We'll hit all the other nails. So this ledger closed. Come to provision for tax. Any killing? Provision for tax also, if something comes, you might have to write there, or you might have to write in cash flow statement. There might be more adjustment. Provision for tax. Opening provision is how much? 15. But what is the tax paid during the year? Maybe you had under disclosed the provision. Some expense is disallowed, because of which you might have to pay higher tax. Now, how much is the provision that will be created during the year? 25 plus 21, 46. 25 plus 21, 46. 46 minus 15, 31,000 is the provision created during the year. Might be 6,000 for last year, 25,000 for current year. But provision created during the year is 31,000. How do we create provision? P&L account debit to provision. Don't tell me that you don't know what is provision and how to create provision. What is the entry? P&L account debit to provision. In P&L account debit side, you write provision. Do you pay money when you create provision? Non-cash expenditure debited to P&L. Non-cash expenditure debited to, because of which your profit has come down. Now, when we eliminate that provision, profit will. So I should add this 31,000 in my P&L account. Shall I? Come back to our cash flow statement. Here I will add provision for tax created during the year. 6,000 for last year. Last year provision created is 15. Current year tax paid is 21. So we created 6,000 less provision last. We created that provision. Further, current year's provision is 25,000. Current year provision is how much? 25. So it was 6,000 for last year, 25,000 for current year. Total provision created 31,000. Understood with logic. Next, go to next ledger. Debentures. How much is opening? 21. Cash received 4. Closing 20. What will I do? Nothing. Why? Ledger is already closed. Ledger is already come to discount on issue of debentures. How much was the opening discount on issue of debentures? 200. This is unamortized expenditure. Expenditure incurred which is not transferred to P&L. This 200 became 0. How? Magic. No, this became 0 because this 200 is charged to PL. How did this 200 become 0? Is charged to, so I'll write here by P&L account. Did you get this? Discount is written off. When I write in discount on issue of debentures by P&L, in P&L I would have written 2 discount on issue of debentures. It is expenditure debited to P&L which is not paid in cash. Non-cash expense debited to P&L, because of which profit has come down. If I eliminate that, what will happen to profit? Increase. What do I do? Add. Shall I add this 200? Are you getting it? So, I feel like I'm teaching myself. But your response. 200. If I give break, how many of you will stay back after break? Half class auto talk. I understand that in this entire unit, these two are difficult chapters. So these 2 units are difficult. Profit pre and post to, bonus issue, right issue, these redemptions are all easy. So first day, full Josh is there, energy is there. I'll finish off this crucial part. Then after one short break, profit pre and post will be all happily smiling and then doing 5, 6, 7, 8 easily. 1, 2, 3, 4 is difficult. 5, 6, 7, 8 is easy. So I wanted to do the important part and little tricky part when you are also still not yet started judging. So I'll do that. That's the point. Stay back. I'll definitely tell you it will be worth it if you stay till the end. You can do much more than what you can otherwise do sitting back at home. That much though I can promise, because so much of time I've definitely put into making it. Yes, let's go to the next one. So discount on issue of debentures done. Did we add it back in P&L? Sorry, did we add it back in cash flow statement? Discount on issue of debentures. Next ledger. What is the next ledger? Goodwill account. Goodwill was 10,000. Closing became 8,000. How did goodwill reduce by 2,000? Please don't tell depreciation. It is amortization. What is it? So from 10 to 8, when it decrease, amortization is done by debiting P&L. Am I right? In goodwill account, if I write by P&L, in P&L account, I would have debited goodwill, amortized. Is it cash expense? It is non-cash expense debited to P&L, because of which profit has decreased. Now, if I eliminate that expense, profit will. So I'll add back this 2,000. Shall I? Come on, let us add back 2,000. I'll write here goodwill amortized. Did this make sense? Let's go to the next leg. After goodwill, we have machinery account. Goodwill was 50, closing is, sorry, machinery was 50, closing became 40. How did it reduce by 6? It is depreciated by 6,000. You can write depreciation up. Then you should open one depreciation ledger and there you should write by PL. Will I write here only by PL? In P&L account, you would have debited depreciation. This is non-cash expense debited to P&L because of which profit has come down. If you eliminate the depreciation, profit will increase. So I'll add back 6,000. Shall I add back 6,000? In our cash flow statement, I will write depreciation on machinery 6,000. We have everything except for one thing. What is it? Starting point, net profit as per P&L. That is what we'll find in the last nail in the coffin. Come to our P&L account. You add opening balance of profit 1,000. In that 1,000 rupees, you have paid dividend of 25,000. You transfer to reserve 5,000. You're still left with 7,000. What is this Akshay Patra? Jesus Christ. One bread, 500 ಜನಕ್ಕೆ ತಿನ್ಸೋದು. Allah, there is some profit earned during the year. How much is it? 5 plus 7, 12. 12 plus 25, 37. 37 minus 1, 36,000 is the net profit earned during the year. That's our starting. Net profit as per P&L account is how much? 36,000. Quickly take your calculator. 2,100 minus 300 plus 31,000 plus 200 plus 2,000 plus 6,000. How much do we get? 41,000. How much is changes in working capital? $90, 19,500 minus. So take 36, add 41, deduct 19,500. What do we get? For 57,500 is cash flow before tax. From this, if we deduct 21, we get cash flow from operating activity after tax, which is 36,500. You all get this? If in case there are some exceptional extraordinary items, they should be disclosed separately, but you won't have such questions in cash flow statement. You can. If there is some insurance claim received, you cannot include it here. You would have to write it separately as a separate line item. Insurance claim received on loss of stock by fire. You cannot include it here. You should eliminate it here and then write it separately. A separate line item disclosure. AS5, PR period items, extraordinary items. Extraordinary items should be disclosed separately. Got it? This is how you prepare indirect approach mein operating activity. We did only operating. Then I have another question to do wherein we'll be discussing operating, investing and finance. Shall we do that? Or you're like, none sir, cash flow statement Saku. Saku or will do? 20? Will do? Very good. Can one of you please close the door? Request, not order. ಅಲ್ಲ ಭಯ ನಂಗೆ ಮಾಡಲ್ಲ ಏನೀಗ ಅಂತ ಹೇಳಿದ್ರೆ No, I don't even have time to deal with that. Shall we do 24th one? Pakka? Or should we keep it till the end? End ಅಲ್ಲಿ ಏನಾಗಲ್ಲ sir. You can have a look at the question. I'll clear this screen for us and we will start very shortly. I'm ready. Can we start? Illustration number 24. Can we start with illustration number 24? Please be a little responsive. We have a long day. We'll be able to do it with your help. I'll be able to do it better with your help. And don't worry about writing down whatever has been, what do you say, shown in the sheet. Entire sheet, I'll share the link to you. It has all the chapters listed in it. 4.1, 4.2, 5, 6, 7, everything. Each unit wise, it's separate sheet. I'll share this sheet to you to see later. You can see it and use it that just the day before exam also. And actually, for advanced accounting, it is much better. I have more organized short notes for last. Group 1 accounting, somehow I couldn't get to do. Done. Let's get started with illustration number 20. See, the problems which has balance sheets and multiple balances given are actually much lengthy than the problem with statements. You would have seen some questions where they don't give balance sheet like this. They give statements like this. These are much easy. Why? Net profit, they only give. You take that. Depreciation, add back. Discount, add back. Interest, add back. So they straight away give amount. You add, deduct. It's more like PGBP computation in tax. Got it? Here it is like accounts. Like you don't know. You need to add back, but you don't know how much to add back. You need to figure it out. So once you prepare ledgers, whatever the numbers you get, no, straight away if that is given, it is this kind of question. Question number 23 types. So that is the reason why I picked 24. Are you getting it? No special love towards number 24 or anything. Following are the summarized balance sheets of X Limited as on 31st of March 2005 and 2006. In this question, first they've given opening and then they've given closing. Got it? So before you start with solution, quickly glance through the adjustments to understand which items have adjustment. You need to prepare ledger accounts for items which has difference between opening and closing balance and for items which has adjustment. You need to open ledger accounts for what items? Items which has difference between opening and closing balance and items which has adjustment. Exception, you don't have to prepare ledger for current assets, current liabilities, cash and bank. Why? Current asset, current liabilities, no matter how many transactions have happened, we straight away do opening minus closing or closing minus opening and rate in operating activity. Cash and bank balance, we total them and rate opening cash and cash equivalent, closing cash and cash. You agree? Is something. Let's quickly read. Dividend, there is some adjustment. Do you see dividend, dividend ledger? And then machinery, there is some adjustment. Machinery ledger. Then one more machinery. Machinery ge onde ledger, but error adjustment. Then income tax, provision for tax, one ledger. Then fourth adjustment, fifth one, company sold some investment ledger. Then what do we have? Investment over. Then there was no sale of machinery during the year. Means decrease in the machinery is either revaluation or depreciation. Sir, how do we get to know whether it is revaluation or depreciation? If it is revaluation, also P&L account. If it is depreciation, also P&L account. Alva. Sir, illa sir, revaluation or revaluation, sir. That is if it is upward. This is downward, no? Sir, no, sir. If it was previously upward revalued, now it is downward revalued. To the extent revaluation reserve is already there, it will be adjusted against revaluation reserve. That is there. But Astella Kerala nimge. If it is there, then revaluation reserve will be there. No, your liability side. Hey, did you understand what I told? When you revalue the asset upward, where do you transfer? Revaluation. When you revalue the asset downward, P&L account. If the asset which was previously revalued upwards is now revalued downward, to the extent revaluation reserve is already there, you will adjust revaluation reserve. Only beyond that you transfer to P&L. In case such complex adjustment is there, then they'll give revaluation reserve where you transfer so much there and then do that. That AS10 plus AS3 question and all won't come as of now. Future I can't promise. Let's go. What is there after that? Investments we mark. The machinery we mark. Depreciation written off on land and building 20. So how can they depreciate land? Maybe they're depreciating building. Should I scratch the word land now? ಸ್ವಲ್ಪ adjust ಮಾಡ್ಕೊಳ್ಳಿ sir. Done. That's it. So they want us to prepare cash flow statement as per for the year ended 31st March 2006 as per AS3 indirect method. Shall we start? And check, is there a difference between equity share capital opening closing? So we should open this ledger. Is there a difference between capital reserve opening closing? Yes. So this ledger. Is there a difference between general reserve? Yes. So this ledger. P&L? Yes, this ledger. Hey sir, ಸುಮ್ನೆ ಎಲ್ಲ ಓಪನ್ ಮಾಡಿ ಅಂತ ಹೇಳಿ except current assets and cash. ಹಂಗೆ ಹೇಳ್ಬಾರ್ದು. You will feel disheartened. Sundry creditors, you don't have to open. Sir, there is difference, but this is, yeah. Then dividend payable and provision for tax we open. Stock we don't have to open. Sundry debtors, cash and bank we don't have to open. You might think you will take too much time to prepare ledger. Actually not. Just go on writing the amounts, opening, closing. It will happen in a quick span of time. If you don't open ledger, you will take the time to think and then compute in the calculator. No. So much time only you will take to write it in the paper. If you fold the paper, draw line, debit, credit, particulars, amount, check the rupees symbol, all that, then you will take more time. You don't have to do all that. Fold the paper into half. Debit side, credit side, just to go on writing. You don't even have to write particulars amount. Don't even have to write. Reason, there is no marks for preparing equity share capital account. Just imagine you prepare all of these ledgers. Don't write cash flow statement. Wow, how many marks will you get? Are you getting it? Working notes will carry marks in the exam. Not all the working notes will fetch you marks. Maybe certain working notes, this land and building, they will allocate some marks. Sorry, not land and building. Machinery, they would have allocated 2 marks or 3 marks for that. For machinery ledger, you will get marks. For preparing investment ledger, land and building ledger, capital ledger, general reserve ledger, you won't get marks. Certain working notes will fetch marks. Not all the working notes will fetch. Got that? Yes. Let's start. First, we'll do always solve the question from the beginning till the end. We'll start with liability side equity share capital and read it till cash and bank. Got it? First item, equity share capital. How much is opening? 10 lakh. How much is closing? 12 lakh 50. So I will open equity share capital ledger. On the credit side, I'll write buy balance brought down 10 lakh. On the debit side, I'll write to balance carried down 12 lakh 50. Got it? Ivan, did you come? No. Surprise, I didn't see you in the beginning. No, others are thinking. So I should also not come in the morning. If I come late, sir will call me by name. Yeah. Then capital reserve. Opening is 0. Closing is 10. Shall I open ledger? Capital reserve. Opening balance 0. Closing balance 10. Done. Next ledger. General reserve. Opening 2 lakh 50. Closing 3 lakh. So let's write general reserve. Buy balance brought down 2 lakh 50. To balance carried down 3. That's the 0 extra ಇದೆ. ಕಡಿಮೆ ಮಾಡ್ತೀನಿ. Okay, na? General reserve done. What do we have after general reserve? P&L account. Opening 1 lakh 50. Closing 1 lakh 80. So I'll open my P&L reserve. I'll write opening balance 1 lakh 50,000. Closing balance 1 lakh 80,000. Got this? What is after P&L? Long term loan from bank. Long term loan from the bank. Opening 5 lakh, closing. Shall I open ledger? Yeah. Or I think we have repaid 1 lakh. There is no adjustment, no? I can open ledger and later close it by writing balance and figure 1 lakh. Or shall I straight away write it right now? Opening 5, closing 1. So how much is repaid? Outflow. So minus. Operating, investing, financing. Financing. So in financing activities, shall I write outflow 1 lakh? In our cash flow statement, cash flow from financing activities, I'll write bank loan repaid minus 1. Don't ever try to write inflows, outflows separately. In the material, when they print, they do it in Excel sheet or some software like this. I can select it, move it up, move it down easily. You cannot do that in the examination. So what do? Inflow or outflow, write it together. Don't try to write all inflows separate, all outflows separate. You're not Britishers. Don't try to divide and all. Write it everything together. Got it? What do we have after that? Sunday creditors. Sunday creditors, will write it in operating activities. This is current liability. Current liability, what do we do? Closing minus opening. Closing is 4. Opening is 5. 4 minus 5. Minus 1 lakh. In operating activity, I'll start with net profit as per P&L. Do all the adjustments. Then I'll do add or less changes in working capital. Here I'll write sundry creditors. 4 lakh minus 5 lakh minus. Done. Don't mock and be sarcastic, sir. It's Sunday creditors, sir, not sundry. Provision for taxation. Shall I adjust it? No, I should open ledger. I should open ledger. Provision for tax. How much is opening? 50,000. Closing? We'll discuss it later. Balance. Then come to dividend payable. Opening 1 lakh. Closing 1 lakh 25. So I'll open dividend payable account. Opening 1 lakh. Closing 1 lakh 25. If you sit and think, your brain will get little bit of shivers. Don't do that. Don't think. Just follow. Write the ledger. Later you think. Simplify to the extent possible. You are making your brain use its memory unit, use its control unit, and use its analytical unit also. Don't do that. Don't let the memory unit work. Use the complete capacity only for, what to say, analytical skills later, once the entire table is filled. Got it? Then after this, we're done with liability side. Shall we go to asset side? To start with, we have land and building. Opening 5, closing 4 lakh 80. So let us write what is the item? Land and building. Land and building. That 20,000 is depreciation. No, they've given here somewhere. What is it? Depreciation is 20,000. No other adjustment. There is no purchase. There is no sale. The depreciation is the expense charged to P&L, which is non-cash. Am I right? Because of which the profit has come down. Now, if we eliminate that, profit will increase. So what do I do? Add back. Let us go to our cash flow statement. If you want, you can open ledger and then do. But once you get the hold of it, you know how to do, right? Then I'll add here depreciation on land and building, 20,000. Done. Next, what is after that? Machinery. Opening is 7 lakh 50, closing is 9 lakh 20. There is more than one adjustment. Shall I open ledger? Let me open machinery account. And in my machinery account, I'll write balance brought down 7 lakh 50, balance carried down 9 lakh 20. Understood? What's after 750 and 920? Investments. Opening 1 lakh, closing 50. Don't try to adjust it straight because there might be some profit or loss on sale. Opening 1 lakh, closing, done. What's after 1 lakh and 50? Stock. Opening 3, closing 2 lakh 80. Don't open ledger, please. This is current asset. We should do opening minus closing. Opening 3 lakh, closing 2 lakh 80. So 3 lakh minus 2 lakh 80, 20,000. Shall I write it in cash flow statement 20,000? Operating activities, changes in working capital, stock. 3 lakh minus 2 lakh 80, 20,000. Am I right? Everyone got this? What's after stock? Sundry debtors. This is also current asset. We'll do opening minus closing. How much is opening? 4 lakh. How much is closing? 4 lakh 20. 4 lakh minus 4 lakh 20 is minus 20,000. Minus, got this? Next, cash in hand 2 lakh, cash at bank 3 lakh, together 5 lakh. Together 5 lakh. I'll write it as opening cash and cash equivalent 5. How is it? 2 lakh plus 3 lakh. And closing cash and cash equivalent is 1 lakh 65 and 4 lakh 10. 5 lakh 75,000 will be my closing cash and cash equivalent, should be my closing cash and cash equivalent. After I identify cash flow from each of the activities, I will add all of them to my opening cash and cash equivalent and I should get closing cash and cash equivalent. If in case I get, that's the correct cash. Got it? Then certain questions they won't give. If they don't give, you won't be able to check also whether what you did is correct. Luckily, when they give, you can check. Dividend of rupees 1 lakh was paid during the year. We'll go to dividend account. Come to dividend. Dividend. Paid. What is the entry? To cash. How much is paid? 1 lakh. So this dividend paid is financing outflow. Am I right? I've written in dividend account debit side and in financing activity, I'll write here dividend paid minus 1 lakh. Remember? And we have not closed the dividend account. Shall we close it now? Later. Later. Don't try to close it now in the middle of the problem. Then machinery during the year was purchased 1 lakh 25. Machinery purchase. What is the entry? Machinery account debit to cash. So I'll go to my machinery ledger. And in my machinery ledger, I'll write to cash. How much? 1 lakh 25. Machinery to cash. So cash is going out. Am I right? What activity? Operating, investing, financing. Investing. And it is outflow. So it is investing outflow. In my investing activity here, operating, investing. Purchase of machinery, I'll write minus 1 lakh. After machinery, what do we have? This machinery of another company was purchased for a consideration of 1 lakh payable in equity shares. When you purchase machinery, entry is machinery account debit to cash. Here machinery account debit will not credit cash. Instead of cash, we will credit share capital. So in equity share capital account, I will write here buy machinery. How much? 1 lakh. And in machinery account, I'll write 2 equity share capital 1 lakh. Did you understand this? So it is appeared at both of these places. Debit credit ille over. Should I write it in cash flow statement? No, I should. Now did you understand why do we disclose it in our notes to accounts as to how much of the shares are issued for non-cash consideration? So in the process of audit or in the process of decision making, the user of the financial statements, when he sees cash flow statement, he will be able to make out the fact that there is change in the equity without being change in cash and cash equivalent. And also in the matters of specific inquiry, section 143, which talks about auditor's responsibility, Here also it's told that auditor has to check for every change in equity, is there actually cash inflow the check ಮಾಡಬೇಕು. Should also check whether short-term funds are used for long-term purpose. Should check whether cash is received against shares issued. All of that. These are matters of specific inquiry. Okay. Then what do we have? Debit to credit. Income tax provided during there is 55. This is provided, not paid. This is provision created during the year. Am I right? P&L account debit to provision. Come to provision for tax. Shall I write here by P&L? How much? 55. In provision for tax, I have written by P&L. In P&L, I would have written to provision. But have I paid? This is non-cash expense debited to P&L. Because of which our profit has. Now what do we do? Add. Shall I add back? Let me add back. In our cash flow statement, when we are doing cash flow from operating activities, to net profit, I'll do provision for tax, add back 55,000. Done. Next item. Company sold some investments at a profit of 10, which was credited in capital reserve. If they would have not told this, which was credited in capital reserve, you would have assumed that it would have been taken to P&L. Would have assumed that it would have been taken to, they mentioned that it is taken to capital reserve. Now, when you sell the investments, what is the journal entry? Cash account debit to investment. If there is profit, cash will be more, investments will be less. That excess credit will be given to P&L. Here they're telling not P&L, capital reserve. So entry that they have passed is cash account debit to investment to capital reserve. Cash account debit to investment to, very good. Shall I first write in our investment account? In investment account, I will write by cash by capital reserve. Correct? How much is by cash? Do we know? We don't know. No. Do we know? No, no, no. We don't know how much is the sale price. We know that the profit is 10,000. Profit 10,000 should appear where? In capital reserve account, credit side by investment. So in investment account, debit side to capital reserve. How much is profit? Did you understand? Here we have received consideration more than the value of the investments going out. So profit in capital reserve credit, in investment debit. Right? Should I read the journal entry and explain? Welcome back to CA Foundation. No. So in capital reserve account, I'll write here credit side by investment profit 10,000. Other way, in capital reserve, if I write by investment, in investment I should write to capital reserve, not 10,000. I somewhere feel like you didn't understand. Understood. Got it. Do we know sale consideration how much? Don't know. You should find. You should find. And this 10,000, shall I adjust it in cash flow from operating activities to net profit? No. Why? It is not credited in P&L. If in case they had not mentioned that word capital reserve there, I would have assumed that this profit on sale of investment was credited to P&L because it is non-operating cash income, but it is not operating income credited to P&L. Profit has increased. Now I'll remove it. My profit will decrease. So I would have deducted. But now I don't do anything. Why? It is not credited to P&L. That is your logic. If you see the process, no process also will help you in the exam. Credit illidya, debit illidya, cash flow statement will baralla. If you write only one of it here, the other item will come there. You get this? Okay. Good. So investment part done. Next adjustment. There was no sale of machinery during the year. So meaning in machinery account, balance in figure will not be cash. Then lastly, we have depreciation 20,000 already done. Question is over. Now shall we start with our answer? In our answer, we'll close all the ledger accounts and our cash flow statement will get automatically filled. Let's start with equity share capital. Opening 10 lakh, machinery 1 lakh. Together, how much should it be? 11, no. How did it become 12 lakh 50? That sir, all the shares they had kept in that locker, no, Mari Akate. No, that is not possible. How did shares increase by 1 lakh 50? Huh? What is the bonus issue? If they don't tell bonus issue, don't assume bonus issue. Bonus issue, they would have to pass board resolution and they would have to do. No. So don't assume. It is issued for cash. Issued for cash. No, sir, I'll assume this 1 lakh 50 to be bonus issue. I'll reduce it from the reserves here, general reserves. Why? Yeah, okay. So this shares have been issued for cash. Cash is received. Inflow. You should add in cash flow statement. Operating, investing, financing. Financing inflow. In cash flow statement, I'll write financing activity, issue of equity shares 1 lakh. Done. By this, I've closed our equity share capital. Have we? Let us go to next ledger. Capital reserve. 10,000, 10,000. Closed. Closed. No problem. Will not affect cash flow. Okay. General reserve. Opening 2 lakh 50, closing 3 lakh. How did it increase? Profit transfer to general reserve during the year. So here I'll write by P&L 50. Correct? Zero extra. My laptop number lock button, tab, alt button, couple of buttons are not working. Kutti kutti. So this 50,000 you understood, no? In general reserve I have written P&L. So in P&L I'll write to general reserve 50,000. What do we have after that? Shall I close P&L account? No, 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 no. This should be the last nail in the coffin. Huh? Don't close it right. What if that person is alive? See later. Provision for tax. Opening 50. So closing 60. Provision created during the year is 55. So how much is paid? 50 plus 55. Closing should be 1 lakh 5. No. Why is it not 1 lakh 5? 45,000 worth of tax is paid. Got it? Paid during the year. Paid during the year is cash is going out. No, it is operating only. So what do we do? In cash flow from operating activities, I will deduct. Correct? Last cash flow from operating activities before tax. Less tax. 45,000. Sir, this I don't know. This Yalla Bharat. Wait. Done with that. P&L will close later. Provision for tax over. Dividend. 1 lakh last year's tax, last year's dividend is paid current year. 1,25,000 is the dividend declared in the current year. This is out of profits. So much is the balancing figure here. I'll write by P&L. So in dividend payable, I've written by P&L. In P&L account, I'll write to dividend payable. Did you understand why did we not close this ledger then? This story is not over. Then machinery. 7 lakh 50 plus 1 lakh 25. 8 lakh 75 plus 1 lakh. 9 lakh 75 here. 9 lakh 20 here. What happened to 55,000 worth of machinery? They have told no machinery is sold. Meaning that difference is depreciation. I'll write here by P&L. Sir, I want to write by depreciation. Okay, write by depreciation and open one more depreciation account. There you write two machinery and then write by P&L. By P&L. So in machinery, if you written by P&L, in P&L you would have written two machinery. That is depreciation expense charged for the non-cash expense debited to P&L, because of which profit has decreased. If you want to find cash profit, you need to increase it. So what do we do? Shall I add 55? Is something. So in our cash flow statement, here I will add depreciation on machinery 55,000. Got it? Let's go back. What do we have after machinery? Once again, machinery over. Investment ledger. Opening is 1. 10,000 rupees is profit. Closing is 50. Opening is 1 lakh. Closing is 50. There is profit of 10. So selling price is 60. How? One more way. Ignore this 10. 1 lakh ittu. 50 aitu. So how much is sold? 50. It is sold at 10,000 profit. So selling price is 60. You're getting this? 60,000 rupees is the cash receipt. Investing. Very good. Investing activity. Inflow or outflow? Inflow. Sale of investment. 60. Sir, 10,000 rupees profit will be created to P&L and we should reverse. No, no, no. It is not created to profit here. Otherwise, we would have actually done. Did you understand this? All the ledgers are closed except one. P&L. Come to P&L account. See, 1,50,000 rupees is the last year's reserves. In that, we paid 50,000 rupees transfer to reserve. We gave 1,25,000 dividend. Still, we are left with 1,80,000. How come? There is current year profit. 205, 255. Sorry, 355 minus 150, 205. Alva. That's it. 2,05,000 is current year profit. 2,05,000 current year profit is our starting point in our cash flow statement. That's the ending point for our answer. 2,05,000 plus all of this. What do we get? 2,05,000 plus 55. 3 minus 1 lakh plus 20 minus 20, 2 lakh 35 minus 45, 1 lakh 90. That is cash flow from operating activity. Okay, na 1 lakh 90 is cash flow from operating activity. Then investing minus 125 plus 60 minus 65. Correct? Then minus 1 lakh minus 1 lakh 0 agata, minus 2 lakh plus 1 lakh 50 is 50,000 minus. So take this 190 minus 65, 125, 125 minus 50, 75 plus 5 lakh, 5 lakh 75. Did you understand this? Pakka? Though it is a statement, don't give up your double entry system. Till the time you are following double entry system, there is someone helping you people. In fact, two hands are helping you. Double entry. Your answer will tell. If in case the moment you start doing it like a statement, from there you are bluffing. There is a very good possibility that you might miss one number and you might end up the answer B. So always keep that plus, minus, debit, credit logic throughout. Even when you're doing cash flow statement, even when you're doing consolidation, or you're doing buyback, or any topic for the matter. Debit, credit, bitre, accounts chapter ಮಾಡ್ತಿಲ್ಲ ಅಂತ ಅರ್ಥ. Done? Yes. So this kind of question is a must to do. And there is one more variety question where they don't give balance sheet like this. They'll give statements like this. I told this then, I'll repeat it again. If they give question like this is simpler than this. That's the reason I did this. Here we had to figure out how much is depreciation. 20,000 depreciation, 18,000 depreciation. Here they will only tell depreciation 5 lakh, add back. Discount on issue of debentures, return of 30,000, add back. Interest on debentures paid 3 lakh 50. Financing outflow. Book value of investments rupees 3 lakh, sale value 3 lakh 20. 20,000 profit would have been included in P&L, which is not operating income, which has increased profit, eliminate. So deduct. So here it is just think plus minus plus minus. This will happen much faster. And actual possibility in the examination is questions like this. Actual possibility. This will easily take 20% lesser time than that type question. You get it? Yes. Can I say we are done with cash flow statement also? So we had a target of your target kele bidi. We kept it 11 to 11:45. Day 4 we'll try and do as much as possible. See, if we can finish the entire syllabus in 9 hours, then why did you take 200 plus hours of class? Correct or not? Yeah, we'll try and finish it, but let's see where can we break how. Initially also we lost no little time. I'll see what string can I pull and then accommodate how. Shall we do profit pre and post incorporation or take a short break? Take a short break. It is 12:30. Let's take a short break. 12:45. Or do you want lunch break? Now, if I start at 12:45, I can again go for 1.5 2 hours. No, 2 ಗಂಟೆ ಕೊಡ್ತೀನಿ lunch break. Okay, 15 minutes break. You want to eat, you eat. I am not stopping you. Lunch, snack, ella ella. You eat like you feel like eating lunch, you eat lunch. Lunch 1, lunch 2 ತಿನ್ನಿ. ಇಲ್ಲಾಂದ್ರೆ 0.5 lunch, 0.5 lunch you eat. I don't care. So 12:30 it is the timer. We'll meet back at 12:45. We'll take another break at 2:15, 2:20ish. Maybe after about 2 hours, after I finish couple of topics. But that, hello guys, take a break. Good afternoon, everyone. Welcome back to CA Intermediate Marathon Revision. We were discussing the topic of financial statements, both cash flow statement and preparation of financial statements before break. We're done with it. Now we're in the second part of the session, and in this session, we are starting with profit pre and post incorporation. This chapter 5 of our syllabus. After this, it will be bid adduced to this chapter because this is the last time that this chapter will ever be discussed. The new scheme of education, this chapter is. Yeah, sad, unfortunate, nice chapter, but so from the time you get the idea till the time you incorporate it as a company, there is considerable amount of time involved. This chapter originated back in the time when registrar of companies is a place where you need to physically visit to get the company incorporated. Now to increase the ease of business index in the company, Modi uncle whatever has done is he's taken the entire process online and they've told everything you can sit at home and then incorporate. Company will get incorporated if all the documents, Aadhaar card, PAN card, and then whatever the documents required of the directors are available. You apply for DIN in one day, you apply for DSC in one day, DIN, DSC comes, AOA, MOA formats are ready. You fill it, you file the application online. MCA also accepts the application in 2-3 days. Everything, if it is clear, in the span of less than a week, you can get your company incorporated. So in such less time is there, this chapter is redundant. That is the reason this is removed. Back in the time, it used to be like almost every company, if you have to get incorporated, it used to take months. You got to an idea, you need to incorporate the company, it takes months. You won't keep that idea within you. What do? You experiment. You start doing the business. Not in the name of the company, but in the name of the sole proprietorship. In the form of an organization other than company, also you too can do business in the country. Am I right? So you do the business in the country other than in the form of company. Once it gets incorporated, same business will happen under the name of the company. At the end of the year, you try to prepare financial statements only to realize that before it got incorporated as company, in one book you are writing all the entries. In same books, you continue to write the entries after incorporation also. They are two different entities, but they've written all the transactions in one book. Now we need to segregate that book into classification where we determine how much of the profit was made by the organization before it got incorporated, how much of the profit was made after it got incorporated. Why? The profit made after incorporation is company's profit. Profit made before incorporation is not company's profit. If you want to record it in company, because the company acquired the told business, such profit is pre-acquisition profit, which is capital in nature. Such profit made during the period before incorporation as company is pre-acquisition profit, which should be transferred to capital reserve. The treatment is not same. However, the profit that is earned after incorporation is post-acquisition profit, which is revenue in nature, which will appear in P&L. Now, how do we segregate this profit into pre and post? We can't straight away do that. We need to segregate each item of expense and each item of income. We cannot say 4 months they did business as partnership or sole proprietorship, 8 months they did the business as company. So net profit into 4 by 12, 8 by 12. If you do like that, chapter is not required. Now, how do we get that profit? There are some 100 expenses, there are some 150 incomes. Each of the income need to be seen. How much is pre, how much is post, how much is pre, how much is post. Each of the expense, how much is pre, how much is post, how much is pre, how much is post. All the pre incomes, all the pre expenses, pre incorporation profit. All the post incomes, all the post expenses, post incorporation. Post incorporation profit will be revenue profit treated normally in P&L account. Pre incorporation profit or loss, capital in nature. If pre incorporation profit is there, it is capital reserve. If pre incorporation loss is there, it is goodwill. Oh, sir, why is it goodwill? Very simple. Before you start the company, now I am starting one company wherein we sell one product. Now people don't know my company, people don't know my product. To create awareness, before I incorporate the company, I start selling that product at a very cheap price, or I start giving that product free. If I sell it at lesser than cost, or if I give it free, I'll make loss. That loss is not expense for now. That loss is an asset that I built, because of which I'll get benefit in the future. Here, first 3 months they gave free. Do you think they got free? No, they gave it free. Why? They capitalized on that and they earned the profits in the future. You getting what I'm trying to tell? So pre-incorporation loss is goodwill. Pre-incorporation profit is capital. So this is to be treated as capital in nature and not revenue in nature. Got it? And the entire chapter's objective is to identify pre and post profit, to find which each item of expense and each item of income has to be segregated as pre and post. Okay. Now have a look. Objective. What is the objective? Segregates profit to pre and post. Reason: there is difference in accounting treatment of pre and post incorporation. What is the accounting treatment? Pre incorporation profits. What do we do? Transfer to capital reserve. Post incorporation profits. What do we do? Transfer to P&L account. How do we segregate this? Each expense or income is to be analyzed and segregated. What is the basis for segregation? If you know the actual basis, if you know how much is pre, how much is post, do it. If you don't know, then you estimate based on what? Ratio. What ratio to apply? Depends upon the nature of the expense. Depends upon the commission that you pay to a sales agent is dependent upon sales. Rent that you pay to the building is dependent upon time. You use the building for 3 months, you pay 3 months rent. Commission agent, higher sales, higher commission, lower sales, lower commission. Are you getting this? So we segregate the expenses as pre and post on actual basis. Priority number 1 is actually we know how much is pre, how much is post, right? No, we don't know actual. Then what do? Then we segregate it based on ratio. That ratio can be sometimes time ratio, sometimes sales ratio. Depends upon the nature of expense. Let us take examples. Gross profit. What ratio? Sales ratio. Gross profit is, if they actually tell gross profit is not in sales ratio, pre-incorporation your GP ratio is different, post-incorporation your GP ratio is different. Then you do it different. See, priority number one is actual. When actual data is there, we go by actual. When actual is not there is when we do this. Next, discount received, sales ratio. Discount allowed. We are assuming all of these to be direct in nature. Direct item, sales ratio. Indirect items, time ratio. In fact, actually, discount received should be made on purchase ratio. Should be made on. We believe that purchase will be directly in proportion with sales. We are assuming that purchases are in direct proportion with sales because we are assuming that the stock level maintained is same. What if you say previously we used to maintain stock level of 1 month sales, now we maintain stock level of 3 month sales? Why? Now you are a company, you are applying what you say, economic order quantity, stock level maintenance, FMO costing, full fledged you are applying, then it will be much diverse. Unless they give so much complex information, we are assuming stock levels are same, GP ratio is same, we are assuming that. Then rent, salary, these are items which are based on time. Yes, please. We will not do purchase ratio. We'll do sales ratio only unless they specifically tell us. Though purchases are there, you would not know how much purchase pre, how much purchase post. How do we know? We are under an assumption that purchases pre post separate quote. Then you can take, but I would still recommend you not to take. You can, that is more appropriate basis, but we will not take that unless they specifically tell us in the question. Actually speaking, we'd have to prepare 2 separate books of accounts. Do you agree with me? To prepare 2 separate books of accounts when so much of complex information is there. They have not done that. They maintained in the same. Now estimation basis only we do. Got that? Okay. Rent, salary, administrative expense, interest, all this we do it in time ratio. Bad debts we do sales ratio. Why? Bad debts will arise because of debtors. Debtors will arise because of sales. Higher sales, higher debtors, higher bad debts. Lower sales, lower bad debts, lower debtors. So we do it in sales ratio. Then we have advertisement expenditure. Again, we assume that advertisement is directly related to sales. We do it in sales ratio. However, there are certain questions where they tell sales promotion was paid to an appointed employee 5,000 rupees per month salary. If they tell like that, time ratio. Usually, assumption is that sales is basis for advertisement. If they give some time as basis, then do it like that only. Varies from question to question. This is generic, not specific. Incorporation expenses. You say, sir, incorporation expenses incurred for company. Is incurred for company. Shouldn't it be post? Some people are like, hey, no, sir, it is incurred before incorporation. So it is pre. What logic do we go by? One person says it is incurred before incorporation, it should be pre-incorporation expense. The other says it is incurred for incorporation of company, it is company's expense, so it is post. Where do we take it? Post is incurred for company. It is completely post. It's completely post. Or if the sales say something like director fees, interest on debentures, director's fees and interest on debentures is paid by company only, not by sole proprietorship or partnership. So it's completely post incorporation. And some questions will have adjustment of there was a manager who on incorporation of company was appointed as managing director. So they'll give some information. You read that question and then identify how much pre, how much post in such question. So audit fees. So remember, audit fees can be incurred for company also, can be incurred for other than company also. What do you mean by audit? It is an independent examination of books of accounts of an organization irrespective of its size and legal form, where such examination is conducted with an objective of expressing an opinion thereon. So yeah, I read it long ago. So I used to teach audit long ago. So then I stopped. Every time I meet Karthik sir, that's what I say. Boss, I don't know how do you talk so much. I can't. Accounts only I talk so much. If I take audit, then gone. And you are better singer than me. So go ahead. I'm very happy for you. Next. So when we talk about audit, audit should be done for company as well as non-company. For company, if you do audit completely, post. For other than company, if you do, what is it? It is other than company audit. What audit will you do other than company audit? GST audit, tax audit. GST audit and all, you will not get in the question. So it will be basically tax audit. So tax audit is done based on the turnover based thing. So we apply sales ratio. But actually, professional ethics wise, this is wrong. We should not be applying sales ratio. We should actually apply it time ratio. The reason is, let's say you become a chartered accountant in 2 3 years now, or maybe even like in some time. And when you become chartered accountant, when you give tax audit services to someone, how will you charge the fees for tax audit? How much is your turnover? 10 crores, 10 lakhs, 100 crores. Why? 1 crore, sir. Will you ask like that? Actually, it is against professional ethics. A chartered accountant should not charge the fees as a percentage of the profits or turnover of the entity. You should not. You should charge it based on the efforts you put. Yeah, it should be based on the number of. That should be the basis. But no one does. No, everyone is like the client to the son client shouldn't do that. So it is actually based on the time period, based on the time that goes in. But in the material they follow tax audit fees sales ratio. Will also follow sales ratio. But when you become chartered accountant, remember to charge the fees to the client, not based on the turnover they make. Don't show any mercy. Cannot charge money. Hey, you sacrifice. Yesterday India Australia match. How many of you saw? I myself didn't see it. Oh, man, do you people, you don't know rest of the World Cup is postponed. Today, yeah, for people writing CA intermediate examination in November 2023, all the World Cup matches are postponed. It will happen to you in the highlight form after November examination. One innings, 15 minutes. You can watch it afterwards on Disney Hotstar. You get it? So please don't watch the match. India will win the cup, irrespective of the fact whether you watch it or you don't. Namde. Yes. So then interest, last one, interest to vendor for purchase consideration. Now there is one sole proprietorship or partnership which is now converted into company. When you say you started with an idea, you can start from the scratch, from zero, taking one place on rent, setting up the business, or you can acquire an existing business. When you acquire an existing business, when you acquire their business, you need to pay consideration for that business. That purchase consideration will be paid by raising the money by the company in the form of shares and debentures. Company is not yet incorporated. You might decide and agree upon the purchase consideration, but not release it, not pay it. You might keep that vendors waiting till the time company raises money. For that delay, you pay interest. So this interest, should it be pre or should it be post or should it be time ratio or should it be sales ratio? It depends upon when is it paid. Depends upon when is it. Interest is due because you didn't pay it on the date of acquisition. Let us say on the date of incorporation of the company, you raised the money and then you paid the interest. So entire interest is paid for pre-period, is pre-incorporation expense. Let us say the company paid the purchase consideration after 2 months after incorporation. Then what do we do? 2 months part will be post, balance will be pre. Let us say they didn't pay purchase consideration till the end of the year. Then pre, post, same time ratio, we should segregate. Are you getting it? Interest is paid till the date you settle the PC. Interest is paid till the date you settle the PC. You need to compute interest and segregate it in time ratio. Segregate it in, if nothing is mentioned, two possible assumptions. Assumption number one, entire PC is paid on incorporation. Assumption number two, PC is not paid till year end. PC is not paid till. Two possible assumptions. What will happen if we assume that it is paid on date of incorporation? Full pre. Full pre. What if we assume that purchase consideration is not paid till the end of the year? Pre and post both based on time ratio. You get this? Sir, which assumption is correct? Both are valid. You can do either. You can do which is easy. You don't have to segregate. Assume it to be on the incorporation date. However, think logically. If they tell, it is assumed to be paid. If they don't tell, it is not paid. They don't tell anything, it is. So for the entire year, segregate it in time ratio. To write one note. In the absence of specific mention, it is assumed that purchase consideration is due till the end of the year. So interest is computed till the end of the year and segregated based on time ratio. However, if it is so assumed that the interest is purchase consideration is settled on the date of incorporation, entire interest will be pre and it is also computed only till the date of incorporation. And my answers will change accordingly. Right, that way. Got that? So this is the theoretical understanding of the topic. In order to very easily lose 2 marks in the chapter, just do the statement of apportionment and then stop. To get full marks in the chapter, after you finish the entire statement, do write one statement at the end, conclusion, saying that this much amount of pre-incorporation profit should be transferred to capital reserve. This much amount of pre-incorporation profit, pre-incorporation loss should be transferred to goodwill. Writing conclusion is very important in profit pre and post incorporation chapter. If you don't write the conclusion but do the entire problem, you will easily lose minimum. The chapter is based on conclusion. This one. Previous chapter was based on presentation. Here conclusion is very, very important. Got it? We will now quickly solve one question. Question number 10 from your material. Should I solve from the scratch? Shall I clear this all and then do it? Beda. I'll just show the answer and then discuss. I can do either ways. I've taught this syllabus a number of times. If you feel like a sari ಏನು ಗೊತ್ತಿಲ್ಲ, I will clear it and then teach from the scratch. ಯಾ ಸರಿ ಗೊತ್ತಾಗಿದೆ ಅಂತ ಗೊತ್ತಾಗೋಷ್ಟೊತ್ತಿಗೆ ನಿಮಗೆ ಟೈಮ್ ಆಗೋಯ್ತು ಅಂತ ನಿಮಗೆ ಗೊತ್ತಾಗುತ್ತೆ. Don't be impressed by me because I'm not here to impress you that I know something. I'm only trying to help. Take help if you can and help yourself. Question number 10 from page number 111. Who has material can open page number 111. Otherwise, I will only show it to you. 10, 10. 112. Sorry. 112. Shall I start? Okay. ABC Limited was incorporated on 1st of May. When was the company incorporated? 2011. To take over the business of DEF and Company on 1st of January 2011. So 1st of January 2011, they took over the business. They ran till 1st of May in the name of that partnership firm or sole proprietorship. On 1st of May, it became company. So for what period was it pre-incorporation? 1st of January to 1st of May. January, February, March, April. 4 months pre. Don't say 4 months pre and the post will be 8 months. No, need not be. There are questions where the entire period is not 12 months, 15 months. So don't do 4 count ಮಾಡಿ ತಕ್ಷಣ 12 minus 4. Don't do that. Please don't do that. Count. See the date. They've told 31st of December. Now you do. May, June, July, August, September, October, November, December. Please count. Please count like this. And then take. It is 8 months post incorporation, 4 months pre-incorporation. Can I say our time ratio is 4:8? So here, observe. Date of incorporation 1st of May, date of takeover 1st of January, year end is 31st of December. Time ratio 4 months, 8 months, 1:2. See what I've highlighted. Got it? If this is all confusing, you can delete it and then start from the scratch. 4:8. For topics which are complex, we do that. For simple ones, we do this way. 4:8 pakka. No doubt. Very good. Let's read the question further. So they've given statement. We'll start with a statement and then start analyzing this. But before that, shall we read that adjustment what they've given? Prepare a statement showing allocation of expense and calculation of pre-incorporation, post-incorporation profits after considering the following information. GP ratio was constant throughout the year. GP ratio is constant. So pre-incorporation, if GP is 20% on sales, post-incorporation also GP is 20% on sales. You don't have to recompute the ratio. Sir, shall I segregate GP in time ratio then? No. GP on sales is constant. Sales pre and post is different. Are you getting it? Okay. Then sales for January and October is 1.5 times the average monthly sales. Well, sales for December are twice the average monthly sales. So start with January, February, March, April, May, June, July, August, September, October, November, December. Write it that way. Then January and October write 1.5, 1.5. December you write 2. February, March, April, May, June, July, August, September, not October, November you write 1, 1, 1, 1. January 1.5, October 1.5, December 2. Remaining months 1. And then pre-months is January, February, March, April. January 1.5, February, March, April 1. 3 plus 1.5, 4.5 pre. Sir, 4.5 pre means 12 minus 4.5, 7.5 post. Angalla. Who told you total is 12? Then April 1, May 1, June 1, July 1, August 1, September 1, October 1.5. ಎಷ್ಟಾಯ್ತು 6 ಇದೆಯಾ 7.5. Then October ಆಯ್ತು November 1, December 2 ಅಷ್ಟಾಯ್ತು ಈಗ 5 3 7 8.5 2 10.5 10.5. Got it? So that's how we compute 9.5. May I forgot. Sorry. So May, June, July, August, September 1. October 1.5, November 1, December 2. You add, you get 9.5. Here 1.5, 111. You get 4.5. Ratio is 4.5 is to 9.5. Don't keep ratios in decimal. Ratios you keep in whole number. How to make 4.2 whole number? Multiply by 2. It will become 9 is to 90. 9 by 28, 19 by 28. Got this? So we have sales ratio and we have time ratio. So then there is some adjustments. Bad debts are shown after adjusting recovery of bad debts. Now, bad debts and bad debts recovered are not at all connected. What is the journal entry for bad debts recovered? Cash account debit to bad debts recovered. What do we do with that bad debts recovered? Bad debts recovered to P&L account. I'll repeat, cash account debit to bad debts recovered is when the money is received. Bad debts recovered to P&L account is the entry when it is transferred to P&L. Otherwise, there is no effect on debtors or bad debts or provision. What they've done, they've adjusted bad debts recovered with bad debts. Stop. They shouldn't do it. Discount receipt should not be adjusted against discount alone. Bad debts recovered should not be adjusted against bad debts. You should not net off the expense and incomes. Expense separate, income separate has to be written. Bad debts will be segregated based on time ratio, sales ratio. Bad debts recovered on actual basis. For what period does that bad debts recovered belong to? This bad debts recovered for a sale made in July 2010. Oh, July 2010 is when? We are doing 2011, last year. So it is pre. Bad debts recovered is pre-incorporation income. It is pre-incorporation. Now tell me how much is bad debts here? 91,000. Related to sales. Ante. What else can it be related to? Okay, 91,000. In this 91,000, how much is bad debts recovered? How much will be actual bad debts? Thank you. You didn't do 91 minus 7. 91,000 bad debt is after deducting bad debts recovered of 7. Before deducting bad debts will be 98. Before deducting 7,000, bad debts is 98. You should have written 98 on expense side, 7,000 on income side. What did you do? Income we deducted from expense and we made that 98 to 91. Got it? So bad debts record belongs to which period? July 2010. July 2010 is pre. So in my statement of profit or loss, I will write bad debts recovered 7,000 pre. Did you understand this? Everybody. Green, okay? Okay. So 7,000. Then that 91,000 will now become 98. I'll show it to you here. Observe, bad debts has become 98. And we are segregating it in what ratio? Sales ratio. Done. Next item. Manager's salary was increased by 2,000 per month from 1st of May 2011. After it became company, he got 2,000 rupees per month, increased by 2,000. Whatever was there previously, that is there, plus he got 2,000. So May to December, May, June, July, August, September, October, November, December. 8 months he's got 2,000 rupees per month salary. 16,000 is completely post. 16,000 is post. How much is manager's salary here? Manager's salary 85,000. 85,000 ali how much is post? 2,000 into 8, 16. So 85 minus 16 is pre? No. It is increased by 2,000. Meaning previously whatever was there, he continued to get that. Over and above the 2,000. 2,000 into 8 months is post. Balance is pre and post. Pre and post. So what do we do? Salary. Observe here. Salary. We take 85,000 rupees salary as 4,000 4x plus. We understood 16,000 as post. No. What is balance? 60. That is for how many months? 12 months. Divided by 12. 5,000 per month. It's 5,750. So 5,750 into 4 months. 23,000. Post will be 8 months. How much is it? 46 plus that 16. 62,000 pre, 23,000 post. Did you understand? 85,000 alva. Yes or no? In that 2,000 into 8 months, 8 months, 16,000 is post. You eliminate that 16 increment. That is post. What do we get balance? 60. 69,000 is for 12 months. Divided by 12. 5,000. 5,750 for each month. each month. Segregated as pre and post based on time. 5,750 into 4, 5,750 into 8. Difficult? Everyone understood 5,750 into 4, 23,000 pre and 62,000 post. What I'll do is in this statement of profit or loss, here I'll say salary. Salary we understood. What did we understand? We understood the other salary. Manager salary artha aitu. Correct? Total salary is how much? 3,31,000. Am I right? In that 3,31,000 manager, if you deduct 85, what will be remaining? That will apply our time ratio. We'll not do it right now. We'll do later that part. We'll finish the adjustments. All investments are sold in April. When is it sold? April. So April. When did we incorporate? April. So why have they told this? If there is any profit on sale of investments, it will be pre. If there is any interest, that will also be pre. Why? After we incorporate the company, we didn't hold this investment. So investments were held in the pre-incorporation period. Here in the income, do we have interest on investments? Yes, this will be pre. Shall I write pre? 36,000. Interest on investments, 36,000 is pre. Done. Any other adjustment? Entire audit fees relates to company. Is to audit fees. Shall I write as post? Observe here, audit fees will be completely. Got this? What do we have after this? Then that's it. All the adjustments are. Shall we see each of these items now? Rents and taxes. What ratio? Time ratio. 90,000. Observe here. Rents and taxes. 90,000. Time ratio. Time ratio is 1/3, 2/3. 30, 60. Done. Next item. Salaries. 331. Already agoito. But we have written half. 331 is there, no salaries. In that manager salary 85 done. This 246 we should do it in time ratio. 1/3, 2/3. Artha aita? What is after this salary? Then we have carriage outwards. Carriage outwards means what? After the goods are sold, to transport the good from the place of sale to customer's place, we are incurring expense. After the goods are sold from the place of sale to the place of customer, we're transporting the goods, and that's carriage outwards. So carriage outwards should be sales ratio. Carriage inwards should be sales ratio. Actually, purchase ratio. We're assuming purchases are in the ratio of sales. So we'll apply sales ratio there. So 14,000 expense, carriage outwards, sales ratio. 9/28, 19/20. Okay, now. ಆಮೇಲೆ printing and stationery 18,000, time ratio. Sir, ಜಾಸ್ತಿ ಸೇಲ್ಸ್ ಮಾಡಿದ್ರೆ will print more papers. No, it's not like that. Printing and stationery is assumed to be standard expenditure. ಅಲ್ಲ ಸರ್, ಬಿಲ್ ಎಲ್ಲ ಜಾಸ್ತಿ ಪ್ರಿಂಟ್ ಮಾಡಿದಾಗ ನೋ ಗೈಸ್. 18,000 time ratio. 1/3, 2/3. Then interest on debentures. Time ratio ಹಾಕೋಣ. Post. Why? Debentures are issued by company. Then sales commission. Sales ratio. 9/28, 19/20. Okay. What's after that? Underwriting commission. Patents over. Underwriting commission. Why? Company, no. Partners' capital won't be underwritten. It is only shares which are underwritten. Completely. What's after underwriting commission? Preliminary expenses incurred for company. Post 28. Preliminary expenses 28,000. Then what do we have? Loss on sale of investments. When are the investments sold? April. That is before incorporation. They have not told April. It is sold before 1st of April. Have they told on 1st of April? Before. So it is sold before. So profit, loss, interest, everything is pre only. Sold. But there is no period after that. No. Sir, actually, the ratio. There is no ratio. No? We call it pre. Done. Anything else left? Net profit. What ratio? If we could have applied ratio to net profit, then we didn't have to do that entire thing. Net profit, you put ratio, this is pre, that is post, over. We can't apply ratio to net profit. That is the reason we did the entire chapter. Very good. Net profit 3,90,000, we don't put. Take the total of income for this gross profit sales ratio. Okay. So we'll take total of pre-acquisition income, total of pre-acquisition expenses. If we deduct, we'll get pre-acquisition profit and post-acquisition. The answer doesn't end there. You need to write the conclusion saying that pre-acquisition profit of 1,86,900 will be transferred to capital reserve. Have to write this. If you don't write this, don't expect. If you don't write this, don't expect. Artha aita? Yes, that's it. Any doubts that you have in this? No? Pakka? So this is a very, very simple, easy topic. This can be your first question to solve in the examination. Anyone who find this chapter difficult? We started with this chapter. No, we did this as second chapter because it's one of the very easy chapter. Shall we go to next one? Bonus issue madada. Bonus issue and rate issue. That's what we started with. So what's the time? ಅಯ್ಯೋ ಇಲ್ಲೂ 25 ನಿಮಿಷ ಆಗೋಯ್ತಾ? We'll finish bonus redemption and then take break. You guys had something, no? No. 25 plus 10. Okay, 1:25 p.m. By when do we finish? 1:45. 20 minutes ಜಾಸ್ತಿ ಆಯ್ತಾ ಕಡಿಮೆ ಆಯ್ತಾ? No, did you people tell like it's too much or it's too less? I didn't understand when you give that expression. 1 minute. I just open the presentation. For few chapters I do have like let's start. I didn't know I finished. Come on, man. Let's start with bonus issue. Chapter 6 of your syllabus is bonus issue. Weightage and all is different. Let's quickly discuss. Pay attention, please. Bonus issue can be seen from two perspectives. One, from the perspective of the company. From the perspective of company, we call it capitalization of reserves. From the perspective of the shareholder, it is free share. It is free share. He received the share free. He had 4 shares still yesterday. Today he has 5 shares. Why? 1 share the company gave it to me free without collecting any money. So from the perspective of company, we call it capitalization of reserves. In fact, lot of places they don't call it bonus issue. The word bonus is not at all there. You only use the word capitalization of reserves. Capitalization of reserves means bonus. Got it? So in the balance sheet, on the liability side, you have reserves and surplus. That reserves and surplus will be taken and then pushed to share capital. You take like this and then you put. Not Jakesh, Ritik Roshan. Take it and then you put this way. So you take it from reserves, put it to share capital. That becomes bonus issue. So when you capitalize reserves, the question is what reserves are capital? What reserves are? Can we capitalize all the reserves? No, there is certain restrictions. The reserves that we're talking about, the first reserve that can be used for capitalization is CRR. Whenever CRR is available, we should always first use CRR. Only after we finish utilization of CRR, we can use other reserves for bonus issue. The reason is capital redemption reserve can be used only and only for bonus issue and not for any other purpose. Capital redemption reserve can be used only and only for bonus issue and for no other purpose. Because CRR can be used only for bonus issue, unless until we finish or exhaust utilization of CRR, we'll never touch. If in case CRR is not there or CRR is exhausted, then we use security premium. Then we use, there is a condition. Security premium can be used for bonus issue only and only if it is realized in cash. If it is not realized in cash, if the shares are issued for non-cash consideration, or if the shares are issued in the process of amalgamation, or if the shares are issued by way of any other process other than cash consideration, we cannot use such security premium for the purpose of bonus issue. No using phone in the class. You are easy to walk out of the class, but in the class, okay, only rule for the class. Security premium cannot be utilized if it is not realized in cash. Then we have capital reserve. Capital reserve is the profit arising on capital transaction. In one of the questions that we did in cash flow statement, when the assets were sold, profit was transferred to capital reserve. Such profit which is there in capital reserve can be used for bonus issue. However, if capital reserve is arising by other than cash, revaluation reserve. Getting it? It cannot be used for the purpose of issue. Can we use it? Amalgamation may there arise capital reserve. Can we use it? No. Because that's not realized in cash. Only if it is realized in cash, we can use it for bonus issue. Did you get this? Then the next condition, the next reserve is free reserves. Free reserves will include general reserve and P&L account. We need to use them in the same order. You should not straight away jump to general reserve. First CRR, then security premium, then capital reserve, then finally free reserves. You all get this? Now, sir, how do we get to know whether security premium is received in cash or not? They'll tell in the question. If they don't tell, what do we assume? We'll assume that it is realized in cash. How do we get to know whether capital reserve is realized in cash or they'll give? If they don't tell, we'll assume. What do we assume? Not realized in cash. Why? How often do you sell assets? How often do you revalue assets? Which is more often? Revaluation is more often. An asset can be sold only once, but it can be revalued any number of times. So what is more often possible is revaluation, not sale. What is more often possible is issue of shares for cash, not for non-cash assets. So unless nothing mentioned, assume security premium to have realized in cash. Unless something mentioned specifically, assume capital reserve to have not been realized in cash. So to use capital reserve, they should tell us very clearly that it is realized in cash. To use security premium, they should tell specifically that it is not realized. Only then we'll not use. Otherwise, we'll consider it in bonus issue. Do you get this? These reserves will decrease. This I told you. Should have realized in cash. Who tells this? Section 63 of Companies Act 2013. Now, these reserves will decrease and our capital will increase. Now the question is, which capital can we issue equity? Bonus issue of equity shares or preference shares? There is no restriction in law which will restrict us from issue of preference shares as bonus. Preference shares can also be issued as bonus. There is no law which says preference shares cannot be issued as bonus. Yeah, I've in fact put a statement of preference shares being issued as bonus. But will usually companies do? No, companies usually won't do. Companies usually won't do. But it is possible. It is very good. So the journal entry. Whenever we do bonus issue, there is little bit of effects. Share capital will increase, reserves will decrease, no impact on assets, no impact on liabilities, and liquidity in the market will increase, cash flow will increase. What are the advantages? What is the process? Theoretical part. One more thing. Shares should be fully paid up for bonus issue. Shares should be. Can we issue for partly paid up shares, get fully paid up shares as bonus? Not possible. If the shares are partly paid up, can we give them a full share as bonus? No. In order for them to receive fully paid up share as bonus, should call for the balance money, collect money from them, and then we can issue them fully paid up share as. Otherwise, we can convert that partly paid up portion to fully paid up without collecting cash from them. Sir, without collecting cash, how do we increase? Bonus. I have share of rupees 8, I'll make it 10. How much should I give? Nothing. Why? I have profit. Rather than me giving dividend 2 rupees to you and then collecting 2 rupees from you and then converting that partly to fully paid up, I will adjust it. But if Companies Act says no, don't tell that dividend was adjusted against bonus. Why? As per Companies Act 2013, dividend and bonus cannot be adjusted against. You cannot tell, I will not give dividend this year. Why? I gave bonus. This is not Karnataka government. You cannot tell no development this year. Why? We gave bus pass free. You can't tell that. You get this? So dividend cannot, bonus issue is not in compensation of dividend. This was told because long ago on dividend there used to be tax called dividend distribution tax. So to avoid that, companies used to make bonus issue. Just to give bonus shares to people and then ask bonus shares to be sold in the market. So that they can route it through that way and then skip dividend distribution tax. But now DDT is removed. The people used to go around like this to skip. Then what did they do? Madhyaliro building was road straight mount. So like no DDT, no dividend distribution tax. Dividend is taxed in the hands of the assessee now, no? 115 BBD. No. Correct. Next, types of bonus issue. Two types. One, issue of fully paid up share as bonus. Two, conversion of partly paid up share to fully paid up by way of bonus. Conversion of partly paid up to fully paid up by way of bonus. There will be some questions where shares will be partly paid up. Company will call for the balance money, receive that balance money in cash, and then issue a fully paid up share as bonus. Don't confuse that with a case where company has partly paid up shares. Company will call for the balance money, will not receive cash, and convert that amount receivable by way of bonus to fully paid up shares. That is different from this. Do you understand? Let's say share of rupees 10, 8 rupees called up, 8 rupees paid up, 2 rupees uncalled. Now company wants to do bonus issue. Company will make 2 rupees call. Shareholder will pay 2 rupees. Company will collect 2 rupees. Then company will make bonus issue. This is not conversion of partly paid up to fully paid up. This is call made, call received, fresh shares have been issued as bonus. Second case is where company will call 2 rupees, will not collect cash. Convert that share of rupees 8 to rupees 10 without collecting cash using reserves. That is conversion of partly paid up share to fully paid up by way of bonus. To convert such partly paid up to fully paid up without collecting cash, you cannot use CRR and security premium. You can use CRR and security premium only and only to issue fully paid up share as bonus. However, capital reserve, general reserve, P&L account can be used either to convert partly paid up share to fully paid up or to issue fully paid up share as bonus. I'll repeat, if you are issuing a fully paid up share as bonus, you can use CRR, security premium, capital reserve, general reserve, P&L. However, if you are converting a partly paid up share to fully paid up, can you use CRR and security premium? You can only use capital reserve, general reserve, and P&L. Got this? That's it. Whenever these shares are issued as free, remember in the financial statements of the company, you should make one separate disclosure. These many shares were issued for non-cash consideration. Journal entry. Reserves are decreasing. Debit the reserves. Debit the reserve. Credit share capital. But if you straight away credit share capital, you won't be able to identify how much is the bonus. So after you debit those reserves, you will create one dummy account called bonus to shareholders, which will be later debited by crediting share capital. That bonus to shareholders, if you remove, reserves debit, capital credit. Reserves decrease, capital increase. Reserves decrease, that entry will go and then capital will increase. You all get it? Okay? Fantastic. If it is conversion of partly paid up shares to fully paid up by way of bonus, first you call for money, share call account debit. To what? Share capital. Done. Then you receive money. Do you receive in cash? No, you use reserve. You debit reserves. Can you debit CRR? Can you debit security premium? You start with capital reserve, general reserve, P&L. Then credit bonus to shareholders. Then you debit bonus to shareholders by crediting share call. If you don't write bonus to shareholders to share call, you should write bank to share call. But that's what I told you. You're not collecting cash. Without collecting cash, you're converting that partly paid up shares to fully paid up by way of bonus. Did you understand that? Share call will get cancelled. Bonus to shareholders will get cancelled. Capital will increase, reserves will decrease. Ultimately, what's happening? Capital will increase, reserves will decrease. You take from the reserves, put it to capital. Take from the reserves, put it to. That is the reason it's called as capitalization of reserves. You'll get promotion. It is in second floor. It will go to third floor. Now, disclosure in notes to accounts has to be made for shares issued for consideration other than. And I think we are done. We can do one question on bonus issue. Shall we? Which question do we do? You know it. One which has both. Recent exam question. Oh, majority of them didn't do in that previous attempt because that question is not there in any of the ICA publications. Any of the ICA publications. You see all the examination papers, RTP, MTP, study material, nowhere is there. So long ago, under PCC scheme, there was one author material in which this question was there. And ever since that time when I started teaching, I put this question, try make them write and then do. But same question with different numbers had come in the last attempt of examination, where there was partly paid up shares in the question. There is fully paid up shares in the question. They are converting partly paid up shares to fully paid up by way of bonus, and then telling proportionate bonus issue is to be made to fully paid up shareholders. Usually they tell no one share for every 3 shares, one share for every 4 shares. In this question, ratio is not given. We have to find the ratio. So the question is here. Have a look at the question. Share capital, two classes. 10,000 equity shares of rupees 10 each fully paid up. 10,000 equity shares of rupees 10 each, rupees 8 paid up. Then there are reserves. What do we have after that? Company decided to make bonus issue by converting partly paid up shares to fully paid up and proportionate bonus to shareholders having fully paid up shares. Did you get the question? Yes or no? Have they given the ratio here? Just now they got free. ಮತ್ತೆ ಅನ್ಸುತ್ತೆ ಏನು ಕೊಡ್ತೀವಿ ಅವ್ರಿಗೆ ಎಷ್ಟು ಕೊಟ್ಟಿದೀವಿ ಅಷ್ಟೇ ಉಳಿದವ್ರಿಗೆ ಕೊಡೋದು. Got it? Yeah. So now, first, this partly paid up shares is there, no? For them, we'll make bonus issue. How much have they paid? 80,000. How much is the bonus issue that will give? 2 rupees per share. For how many shares? 10,000 shares. 20,000 rupees. Got it? Now, what is the journal entry? First, we'll make share call. First, we'll make, what is the entry? Share call account debit to share capital. 20, 20. Got that? Observe. Share call account debit to share capital 20, 20. Do we write bank to share call? No, no, no. We'll utilize reserves. What reserves do we use? Can I use CRR? Can I use security premium? I can use capital reserve. But is it realized in cash? Don't know. Don't know. If you assume it to be realized in cash, you can use it. But our logic is usually we don't know. Yes or no? So nothing mentioned, we'll assume this to be not realized in cash. Oh, there. Further, capital reserve includes revaluation reserve to the extent of 1 lakh. Revaluation reserve is 1 lakh. So entire capital reserve is revaluation reserve. Should we use it? No, no, don't use it. Premium on issue of shares is for, okay, okay, okay. There is one more line here. How much is from issue of shares against asset? 3,000. So in this security premium of 10, how much can we use? We should not use 3. So we should use 7. So can I use 7 for bonus? We should not use only. So we'll start with general reserve. 10. How much do I need for bonus issue? 20. Henge 2,000, sorry, 10,000 shares into 2 rupees per share. 20,000. Am I right? Now, how much is available in general reserve? How much will we use? Full 10. How much further do we need? 10 more. Where does it come from? So can I say general reserve I use 10,000, P&L account I use 10,000 and I write it to bonus? I will write the entry general reserve account debit, P&L account debit to bonus to share. General reserve account debit, P&L account debit to bonus to shareholders 10, 10, 20. Got that? Then I'll write bonus to shareholders to share call. If I would have not written, I was supposed to write bank to share call. This share call here is there, no? I will credit it here. It will get closed. Bonus is here, no? This will get reduced here. So what is happening ultimately? My capital is credited, increasing. My reserves is debited, decreasing. So I'll use my reserves to increase my capital. By how much? 20,000. So I'll take money from reserves, I'll put it to capital. How much? 20. If I do that, here 20,000 will move from these two and then get added to this, making this 80,000 1 lakh. Did you understand how to convert partly paid up shares to fully paid up? Now you gave bonus issue to these 10,000 equity shares. They'll also ask, no, what did you didn't give anything to me? Shall we give them? How much should we give them? Usually they give ratio. In this question, they have not given ratio. What have they told? Proportionate bonus. How much proportion? How much ever we gave them, in the same proportion we should give to these people also. How much did we give these people? So shall we give 20,000 to these people? No. These people had given us 80,000 rupees. For the people who had given us 80,000, we gave 20,000 bonus. So people who paid 1 lakh, how much should we give them? 25,000. How? You give me 8. I give you 2 rupees bonus. 2 by 8. 1 by 4. If you give me 4 rupees, I'll give you 1 rupee. If you've given me 10 rupees, I should give you 2.5 rupees. Correct or not? If bonus is 20,000 for 80,000, for 1 lakh it will be 25,000. If bonus is 20,000 for 80,000, for 1 lakh it will be 25,000. How do we get it? Cross multiplication. See here, 80,000 paid up, bonus is 20,000. For 1 lakh rupees paid up, bonus is 25,000. Oh, 25 into 80 divided by 20. Sorry, 1 lakh into 20 divided by 80. 25. 25,000 rupees. Shares are of rupees 10 each. How much bonus? 2,500 shares of rupees 10 each. Where does it come from? CRR. CRR 5,000 is there. We'll use. Then security premium. Security premium 10,000 is there. In that 3,000 is on shares issued against asset. Non-cash consideration. So we should use 7. So 5 plus 7, how much over? 12 out of 25 over. How much is balance? 13. 13 we can use from capital reserve. But capital reserve is arising from non-cash consideration. Why? Revaluation reserve. We can use general reserve. But general reserve is already utilized. Full. So we have no option but to use from P&L 50. P&L also it's actually not 50 now. It is much lesser, but we have enough what we want. So we'll take CRR, security premium and P&L. 5, 7 and 30. So these reserves are decreasing. I'll debit CRR, I'll debit security premium, I'll debit P&L and then credit bonus to shareholders. CRR, security premium, P&L debit to bonus to shareholders. Then bonus to shareholders to share cap. 25, 25. Got this? After this, if I prepare balance sheet in notes to accounts, I should specifically mention that out of the above 2,500 shares of rupees 10 each have been issued for a consideration other than cash, that is by way of capitalization of reserves. Second disclosure, in my notes to accounts for reserves and surplus, I should write CRR original balance minus bonus total closing balance. P&L, capital reserve, general reserve, everything I should write the balance before bonus issue, less reserves utilized for bonus issue, and then reserves after bonus. Everyone got it? Akka, this is the end of bonus issue. Can we now discuss right issue? Okay, cool. Let's go to right issue. Right issue. What do you mean by right issue? Right issue is not free share. Right issue is not. Right issue is a right to buy the share. Right issue is a. It is an option. You have an option. You can buy the share. Why do you want to buy the share? Very simple. If in case you don't exercise this option, it is not an obligation. You are not obligated to buy the shares of the company. You have an option to buy. The reason why people go for this is because let's say there's a company in which there are three shareholders. One is Bhim, other one is Chutki, then we have Raju. So Bhim holds 10,000, Chutki holds 7,500, and Raju holds 2,500. Together, if the shares in the company is 20,000, do you see the percentage of holding? How many percentage does Bhim hold? 50. Chutki, 37.5. Raju, 12.5. Bhim is the majority shareholder. Am I right? If in case company goes for further issue of shares to the extent of 10,000, Cholakpur Limited for expansion of business required additional capital and issued how many more shares? 10,000. This entire 10,000 is bought by Kalia. You get this? If you don't do right issue, you know what happens now? Kalia buys 10,000 shares. So out of 20,000 shares, sorry, out of 20, no, 30, 10,000 is held by Beam, which comes to 33.3. Then Chutki holds 7,500, which comes to 25%. And Raju holds 2,500, which comes to 8.33. And now there is Kalia who holds 10,000 shares, 33.3. Previously, what was Beam's holding? 50%. He formed majority. He could have taken decisions in the company. Now he is no more majority. He is one-third shareholder in the company. Kalia has as many shares as many he has. For number of shares what Beam hold is same, but voting power of Beam has come down. Decision cannot be taken by him. He is no more the majority in the company. In order to avoid this, in order to ensure that the existing shareholders retain their voting percentage, what does the company do? Company will go for right issue. When the company makes right issue, company will not make it an obligation, but company will give an option to Beam, Chutki and Raju to buy the 10,000 shares which are freshly issued in such a way that Beam's holding after right issue is 50%. Chutki's holding after right issue is 33.33 and Raju's holding is 16.67. How? Company had 20,000 shares. Am I right? Additionally, they're issuing 10,000 shares. One for every two shares. You will be given one right for every two shares. If you have two shares with you, you can buy one more share. If you have four shares with you, how many can you buy? Two more. If you have 10 shares, buy. If you have 20, what if you have 15? So that is the reason they tell one cut-off date. They say from this date, right issue will be made. So you have an option. You remember, no, you make your shares into even. If you have 15, either sell one share or buy one share. You will be allowed to do that. They'll mention in prior and then mention record date. Now let's see how does it work. One share for every two shares is given as bonus. Now Beam had how many shares? 10,000. Chutki had 7,500. Raju has 2,500. Beam will get 5,000 right shares if he buys. Chutki will get 3,750 if she buys. And Raju will get 1,250 if he buys. And if they exercise their rights and buy the shares, it will be 15, 11,250 and 3,750, which is same 50%, 37.5% and 12.5%. Are you getting it? I'm not telling that they must buy. They have an option. They have an option. If Beam wants 50% stake in the company, He can buy. He says, I don't care 50%. Till the time I'm next to Chutki, I'm happy. And if Kalia comes also and pay, then he can come and then buy. Did you get this? In this case, they won't ask us to write journal entries. Journal entries is simple, same bank account debit to share application debit to share capital. If premium is there, write premium. The trick is not there. The trick is in identifying theoretical X right price and cumulative right price. What is this theoretical X right price? What is this cumulative right price? Oh my God. What is all of this? Now, whenever the company gives an option to an existing shareholder to buy the right share, would they quote the same price what is there in the market? They would quote a price slightly lesser than the market price. When they sell it slightly at lesser price, it means you are getting some concession. You buy that share. When you buy that share in the market after that right issue, number of shares have increased and the fresh lot of shares you got it at a lesser price. You tell me what will happen to the market price of the share? Decrease? Yes or no? Before that right price, whatever is the price that is there in the market is what we call as cumulative right price. After the right issue is made in the market, whatever will be priced, it is called as theoretical X right price, excluding the rights. After the right is made, what is the price in the market? So you should identify both. One more thing is you have an option, you have a right, but not an obligation. So you have two shares. I give you one right. What do I give? Why? You are the existing shareholder. And assume that your friend is there who's not the existing shareholder. He wants to buy the share of the company. Can he buy? He cannot buy because the right is given to the existing shareholder. You can buy one share. Can your friend buy one share? No. What will you do? You will give your one right to your friend. He will buy the share from the company. Right andre free Allah. Should give that right and you should also give cash to buy the share. If you want to buy, you can buy. If you don't want to buy, you can sell not the share, but the right to buy the share. You can sell not the share, but right to buy the share to your friend. When you sell that right to buy the share to your friend, at what price should you sell? At what price should you sell? Difference between theoretical X right price and cumulative right price. Difference between theoretical X right price and ಅರ್ಥ ಆಗಿಲ್ಲ. Let me explain this to you. The effects of right issue, you know this. This is theory. ಇದು ಬೇಡ, ಸ್ವಲ್ಪ skip ಮಾಡೋಣ. Let's see. Come right price. What do you mean by cumulative right price? Price per share after announcing the right, but before the issue of it. Company has announced one right share for every two shares held. Announced. Then whatever is the price is cumulative right price. Meaning the price at which the share will be traded in the market will be for the price of the share less the money that's inside. Like this, there's one dog. Okay, you know that dog has puppies in its tummy. It's going to it's going to conceive puppies in some time. Correct? Better word. I get it. Or now the price that you quote for the dog is for the price of the dog plus the puppies inside. Cumulative, including the price of the puppies. After the puppies are born, then X right price. Theoretical X right price. What is X right value? It is the price per share after right issue. You get this? Now you want to sell only puppies. You want to sell only the difference between the price at which the dog was sold when the puppies were not born and the price at which dog will be sold after puppies are born. That difference is your value of right. Is your value of. How do you find X right price? How do you find X right price? Your cumulative right price was there, no? Multiplied by the price of the shares, that number of shares that you had there. Price that was there before the right issue into number of shares that you had there. Plus, how many right shares? How many right shares do you have? Multiplied by how much money should you pay for each right share? For every two shares you held, I gave you one right. To exercise one right, I'm asking you to pay 12 rupees. Cumulative right price is 15. How much is cumulative right price? So you have two shares at rupees 15. 2 into 15, 30. 2 into 15, you get one right share. At what price should I sell? I'll give it to you at 12. I'll give it to you at 1 into 12. 30 plus 12. 42 rupees you paid totally to me. Correct? For how many shares? So, right shares multiplied by right issue price divided by that old shares plus new shares. What do we get? You tell me. You had two shares at rupees 15 each. I gave you one right share for rupees 12. 2 into 15, 30. 1 into 12, 12 divided by 3. Ishtu barutte. 14 rupees the value per share. After the right issue in the market, each share was 15 rupees. No, in the market it will come to 14. Market it will come to 14. Did you get this? Now, if you buy the share, you had two shares at 15, you bought one share at 12, it became 14. What if you don't buy the share? You would have to sell it to your friend. You know at what price should you sell? To the extent it will decrease. Let us say you didn't buy right share. You didn't buy, you had two shares. You had two shares at rupees 15 each. What is the value? 30. Now, after right issue, what will be the price in the market? 14. So you'll have two shares at rupees 14 each. So 2 into 14 becomes how much? Your investment was 30, no? 2 into 15, 30. Now it becomes 2 into 14, 28. 2 rupees decreased. Why? That right was there in, no, in your hand. You should have sold it for 2 rupees. At least, or you should buy the share. You should either buy the share or you should sell the right. If you don't buy the share and don't sell the right, your investment value will decrease by 2. Understood? That's what we're trying to find. How do we find value of right? Cumulative right price minus X right price. See this. Cumulative right price per share minus X right price per 2 rupees. Everyone? So they would want us to apply this formula and then compute the number. Anybody has any doubt on right issue concept? I will do the question after this if you guys have no doubt. Sure. Did you understand? I don't know. Options with existing shareholders, 3 options. Option number 1, exercise the right. Option number 2, sell the right. Option number 3, do nothing. And I'll tell you the statistics in India is that whenever a listed company issues right shares, more than 90% of the shareholders don't buy the rights, don't sell their rights. Their rights will get expired because of people not being financially knowledgeable. People don't. They only buy the dip, buy the dip, buy this at this rate, sell it at higher rate, and then invest the money in small cap and lose it. That's what we do. Some tip you saw in some YouTube video, you try to execute it because they dump their sales. Someone wants to sell their shares. Nobody is buying. That share is not traded. So they give tips to you people. Buy this share. It will grow up to this amount. You buy, no. Whenever you put buy order, they put sell order. They'll wipe their hands and then go. You bought that shares. Now you want to sell, but nobody is willing to buy. So whenever you go get those free tips on your message, mobile phone, buy this share. Free messages will come. Some random person say you get message. Don't buy all of that. You get this, save your money. Shareholding pattern. 20,000 shares. Beam 10,000, 50%. Chutki 7,500, 37.5. Raju 2,500, 12.5. Got it? Right issue is made 10,000 shares. Sir, it's already discussed. Same thing. One right for every 2 shares. Nominal value 100. Cumulative right price 150. Correct or not? Right issue price 125. Come on. Compute what is the theoretical X right price. Think. Sir, for whom should we find? For company, not for Beam, Chutki or Raju. You are not personal consultant of Beam. Theoretical X right price. 141 point. How? See, for every 2 shares, you get 1 share, no? So 2 shares into 150. 300. You get 1 share as right share. How much should you pay for that right share? 125. 1 into 125. Divided by 3. 140. 141.61. Are you getting it? That is your theoretical X right price. Have a look. Beam is entitled to 5,000 rights. Option with Beam against rights. 1. Subscribe to right shares. 2. Share, sell the rights. 3. Do nothing. If he subscribes to right shares, you know what will happen? He has 150 shares. Sorry, 10,000 shares at rupees 150. He will buy 5,000 shares at rupees 125. Divided by 15,000 shares. What will be the value? 15 lakh plus 6 lakh 25 divided by 15,000. How much will it become? How much will it become per share? 141.67. Understood this? That's what you did. So now hang ಮಾಡಿಲ್ಲ ನೀವು ಇಲ್ಲಿ 2 ಇಲ್ಲಿ 1 ತಗೊಂಡ್ರಿ ನಾನು ಇಲ್ಲಿ 10,000 ಇಲ್ಲಿ 5,000 ತಗೊಂಡೆ. Same. Take 7,500, 3,750. Take 2,000, 1,000, 6,000, 3,000. Same answer. Correct or not? So after the right issue, what will be the price in the market? 141.67. Got it? What if he sells the rights? What if he sell the rights? We should sell the rights at cumulative right price minus X right price. Cumulative right price is 150. Theoretical X right price is 141.67. You should sell each right at what value? 33 per share. How many shares does he have? 10,000. So 10,000 into 8.33. 8,300, sorry, 83,300. For how many rights? For 5,000 rights. For 5,000 rights. 2 shares is equal to 1 right. 2 shares is equal to, so 83,300 he will sell. Correct? If in case he doesn't sell, you know what will happen? His share value before is 150 rupees. Share value after is 141.67. 150 into 10,000 is how much? 15 lakh. After the right issue, what is happening? Same 10,000 shares. He didn't buy the share, he didn't sell the right. It will be 141.67. 14 lakh 16,700. His value of investments decreased by how much? 83,300. You should have received that 83,300 by sale of rights. Because he didn't sell rights, he was lazy. He lost 83,300 rupees in the value of his investment. If in case he sells this 83,300, what will be received in cash should not be adjusted against the cost of investments. This should be written completely to P&L account as income. We've done this in accounting standard 30. What is the journal entry when the rights are sold? Cash account debit to sale of rights. That will go to P&L. Where do we write it in investment account? No way. Where do we write in investment account? It will be straight away written in P&L account. Did you get this? Yes or no? Because when you sell rights, nominal value of shares will not decrease. Okay. However, when bonus issue happens, we'll write it only in the nominal value column. Number of shares or nominal value will increase. Amount column is not touched. Got it? Very good. This loss could have been avoided either by acquiring the right shares or selling the shares. Ta-da! This is the concept of right issue. Everyone understood? Was it helpful? Okay. If I do presentation like this, revision becomes so smooth. Yeah, but takes a lot of time to do. For doing it for entire syllabus. Next new syllabus, your juniors will do marathon, no? In the month of April or March, then we'll do full syllabus. If your juniors ask, no, next time tell them it's okay, attend. Okay. Little boring, but it's fine ಅಂತ ಹೇಳಿ ಅಲ್ವಾ? ಓಕೆ ಸರ್ ಅಂತ ಬೋರಿಂಗ್ ಏನ್ರಿ? ಮಲ್ಲಿಕಾ ಶರಾವತ್ ಅಲ್ಲಿ ಡಾನ್ಸ್ ಆಡಕ್ಕೆ ಸಬ್ಜೆಕ್ಟ್ ಇಸ್ ನಾಟ್ ಮೆಂಟ್ ಟು ಬಿ ಮೇಡ್ ಇಂಟ್ರೆಸ್ಟಿಂಗ್. ಸಬ್ಜೆಕ್ಟ್ ಇಸ್ ಮೆಂಟ್ ಟು ಬಿ ಮೇಡ್ ಅಲ್ಲ. ಮೈ ರೆಸ್ಪಾನ್ಸಿಬಿಲಿಟಿ ಇಸ್ ಟು ಕವರ್ ದ ಸಬ್ಜೆಕ್ಟ್. ನಿಮ್ಗೆ ಎಂಟರ್ಟೈನ್ ಮಾಡಕ್ಕೆ ಆ ಕ್ಯಾಟಗರಿ ಅಲ್ಲ. ದಿಸ್ ಇಸ್ ನಾಟ್ ದಟ್. We'll do question number 7 from page 124. To the extent possible, I do keep it entertaining, but that is never the first option. Subject is option number 1. For the sake of one song, because one heroine is there, I will not create the situation. If the situation and demands, then we'll keep the heroine professor. Correct, no? Movie? Movie ಮಾಡಬೇಕಾ? ಕ್ಲಾಸಿಗೆ ಬಂದ ಮೂವಿ ಬರ್ತೀರಾ? ಕ್ಲಾಸಿಗೆ ಕಾಂಪಿಟೇಷನ್ ಕಡಿಮೆ ಸರ್. ಮೂವಿಗೆ ರಾಜಮೌಳಿ ನಾಲ್ ಇಸ್ ದೇರ್ ಫಾರ್ ಕಾಂಪಿಟೇಷನ್. Sustaining with them all is little difficult. Okay, come on. Let's do illustration number 7. Next book we are doing now. Okay, certain secrets. So MCQ will come. 30 marks book. The name of the book is what to say? Ravel Multiverse. Like Marvel is there, no? Marvel conceptually multiverse book MCQs. Grading of the questions and all will be there. Usually there will be easy, medium, difficult. Namdangalla. Namdu question ali. If it is some Guardians of Galaxy character, easy question. If there is some Avengers character name in the question, medium level question. If the question name somewhere is there, the word accounts manager, that is difficult question. So grading within that and all. So full changing bookally. You should see the new material that will come. That will be like Netflix bookally. Each module has specific theme. The new syllabus book taking lot of time. but to do that. But trust me, when it comes, no, you'll be like subscription yavak tolodu for book. You feel like that. Hello, let's do illustration number 7. Quick. Yes. So that's the end of commercial advertisement. Now we'll get back to the movie. Company offers new shares of rupees how much? 100 each at 25% premium. Nominal value 100. 25 rupees premium. So issue price is 125. Issue price is 120 to existing shareholders on 1 for 4 shares. Ooh. How many shares are we giving? 1 share for every 4 shares. Very good. Outstanding number of issued equity shares is 1 lakh. How many right options are given? 25,000. Why? 1 for every 4 for 1 lakh 25,000. Sir, 4 lakh alva. Hey, 1 into 4 Allah. 1 by 4. 1 right share for every 4 shares held. For 1 lakh shares, we divide by 4. We give 2 lakh 50. Okay. The cumulative right value per share is 150. 4 shares at 150. 4 into 150. What do we get? 600 plus how many rights do we give for 4 shares? 1 share. 1 share into how much is right issue price? 125. 1 into 125. 600 plus 125 divided by 4 plus 1 5. 145 is theoretical X right price. And 150 is the cumulative right price. 150 minus 145. 5 rupees is value of right over 5 marks. I am not kidding. See here. 4 shares, 1 right. 1 lakh shares, 25,000 rights. Correct? Cumulative right price, 150 per share. Theoretical right price, formula, number of existing shares multiplied by cumulative right price plus number of right shares multiplied by right issue price divided by cumulative right shares plus number of rights. That is 1 lakh shares into 150. Sir, you 4 into 150 madri. If I do 4 here, I'll take 1 year. For 4 shares, 1 share. For 1 lakh shares, you get 25,000 shares. You take 1 lakh into 150, 25,000 into 125. 1 lakh plus 25. So 1 crore 81 lakh 25 divided by 125 is 145. Sir, why did you do 4 and 1? Because 1 lakh into 150, too much of space in brain. 4 into 1, easy. I can do it like this without using calculator. Answer is 145. Did you understand? What is 145? Theoretical X right price, meaning after the right issue is made, in the market, price will come to 145. If after right issue market price is not 145, if it is 146 or 144, then there is arbitrage opportunities. You can actually make profit. But market will get correct. Yes. So 150 is cumulative right price. 145 is theoretical X right price. You tell me how much will be your value of right. 150 minus 145, 5 per share. Understood? Right issue is also done. Bonus issue, right issue. Got it? What time had we put? Yo. ಪರವಾಗಿಲ್ಲ but we are not wasting time. 2:10 ಹಾಕೋಣ ಅದು ಆಗುತ್ತೆ ಎಷ್ಟು ಆಯ್ತು ಅಲ್ಲಿಗೆ 35 plus 10 45 minutes 45 minutes ಬೇಕಾಗುತ್ತೆ each topic. Don't you think so? No, shall we do redemption and then break? After break, hungry? Hey, hungry, not hungry? How many of you are hungry and want break? No. People who are not hungry will not eat you, obviously. You didn't understand. Ready? How many of you want break right now? Very less. Hey, you tell unitedly. We will do it either ways. Come on, guys. 30-35 minutes. Quick. Let's finish redemption of preferentials. There is only one trick in this chapter. What will bother you people? Those of you who already read this chapter will understand this. It is easy when they tell how are they redeeming preferentials. It becomes tricky when they tell to issue sufficient number of shares for the purpose of redemption. Do you agree with me? But it has become very, very simple. I'll tell you how to do it. Because ಅಲ್ಲಿ CRR ಬರುತ್ತೆ, all of that. No, that's the only complex part. If you can crack that, this topic is very easy. Redemption of preference shares. Preference share. What is preference share? It's a share with preferential right for receiving dividend or capital in prior and before our equity shareholder. First we pay dividend or capital to preference shareholder, then whatever is left will be paid to equity shareholder. That's the preference that they carry. So we should first redeem preference shares and then pay money to equity shareholders in the event of winding up also. However, there is a condition given that we cannot keep the preference share in irredeemable format, which was there under Companies Act 1956. Under Companies Act 2013, every preference share we issued will be redeemed at the end of minimum period of 5 years, maximum period of 20 years. It cannot be kept beyond that. However, there is one exception given for infrastructure development companies. They can give it for additional 10 years. They don't say 30. It says additional 10 years. So redemption meaning, Google ali, don't read this. So redemption meaning it's opposite of issue. What is it? Opposite of issue. In the case of issue of shares, what do? We receive cash. We receive cash. We give them share. We give them share. This is company. That is shareholders. In the case of redemption, ulta. We take the share back from them and we give them the which share? The share that we gave. The share that we gave, we collect it back and then we give them money. So in the case of issue of share, what happens? Equity share capital will increase, and capital will, cash will increase. Capital, cash, both will increase. This is for issue of share. In the event of redemption, capital will decrease and cash will also decrease. And decrease in the capital means company is slowly winding up. If in case when the company has good money, it pays money to preference shareholders. Later, when there is no money, equity shareholders super account. That is not fair. So the rule of Companies Act is company cannot decrease its capital. Company cannot decrease its. So cannot. However, company, if it has to decrease its capital, it has to be by way of capital reduction. It has to be by way of the capital reduction. Internal reconstruction we do know that's capital reduction. Approved scheme from the court of law with prior permission from registrar and members. That's the only way in which the capital can be reduced. Otherwise, the capital cannot be reduced. So then can't we redeem preference shares? We can redeem preference shares. But whenever we redeem preference shares, to the extent our preference share capital is decreasing, to the same extent, we take the money from reserves, then create CRR. Create. Sir, nominal value of the preference shares redeemed is 1 lakh. Nominal value, 1 lakh rupees we take from profit and then create CRR. And that CRR can be used only and only for one purpose that I just told you some time ago. What is the purpose? Bonus shares. When you use that CRR to issue bonus shares, equity share capital will increase by 1 lakh. So on the total, capital has not decreased. On the total, capital has not. So there is no reduction in the capital. We get this? So whenever preference shares are redeemed, we have to create CRR. Sir, Angala, sir, if in case we want to redeem preference shares, to redeem preference shares, we issued equity shares to somebody else. We collected money from them. That money I used to redeem these preference shares. Then should I still create CRR? No. Why? Equity share capital increased. Preference share capital decreased. So capital is not decreasing. We don't have to create CRR. What if we issue 80,000 rupees equity shares? Redeem 1 lakh rupees preference shares. Capital increasing 80, capital decreasing 1 lakh, 20,000 from where is that money coming? That is not coming from fresh issue. That is coming from your own pocket. Got it or not? So if you have pocket, say money 20,000 is going, that cash is decreasing 20. So much profit should have been there. When that profit is there, from that profit we create CRR. Sir, what if you have cash 20,000? You have cash 20,000. Preference share capital 1 lakh. We need to redeem. You have only 20,000 cash. So I'll issue 80,000 rupees shares. I'll get 80,000 rupees cash. 80 bantu, 20 ittu, 1 lakh korti. I'll give 1 lakh. My reserves is not this. Can I do that? You can't. Why? If you have 20,000 cash, you freshly issue 80,000 rupees worth equity shares, you receive 1 lakh. 1 lakh cash is there to pay to preference shareholder. When you pay 1 lakh to preference shareholder, capital is reducing by 1 lakh. Correct or not? Equity share capital is increasing by 80,000. There is 20,000 decrease in capital. Should create CRR. Do you have reserves? Reserves 0, sir. Can you do this? This is not allowed. But why? Very simple. If there is 20,000 cash, but there is no reserves, that means that 20,000 is not profit. That 20,000 is not. You have sold goods. You received cash. That is bandwalane. That is capital only, not cash. If you eat your capital, one day you will become, say, it will become zero. One day the business will become zero. No, 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 I don't use curse words. So the capital will become zero. You should only eat profit. Let's say you invested 1 lakh rupees capital. You sold goods worth 1 lakh. 1 lakh cash came. Can you take that 1 lakh rupees home? If you take 1 lakh rupees home tomorrow, what will you say? 1 lakh rupees worth of goods are sold for 20,000. Sorry, 1 lakh 20,000. Then you know, 1 lakh 20 there will be cash. 20,000 there will be reserves and surplus. 1 lakh there will be capital. So balance sheet, capital 1 lakh, reserves and surplus 20, cash 1 lakh 20. So 1 lakh you keep it for inventory. 20 you can take home. If capital is 1 lakh 20, cash is 1 lakh 20, you should not use that cash. That is the logic. You understood? Normal, prudent Indian business concept. No. Hi-fi word CRR in companies. But it is normal thing what we do only. Nothing new. Nothing new. Full common sense only. Let's go ahead. See this. So provisions of Companies Act says that redeemable preference shares only can be issued, not exceeding the period of 20 years. However, that infrastructure development company, additional 10 years. Okay, shares can be redeemed either out of divisible profits or out of fresh issue. If you have profit, instead of giving dividend, you can use that money for redemption. Second one, freshly you will issue shares, raise the money, and you will use such money to redeem. Is that also allowed? Is something very good. Allowed. Then shares should be fully paid. Shares should be, in order to redeem the preference shares, it should be fully paid. Sir, what if the shares are partly paid up? Call for the balance money, receive the balance money, convert it to fully paid up share, and then make the. Sir, what if they don't pay? Beautiful thing. No, you don't have to pay. Forfeit the share, keep the call scenarios money adjusted for which are profit. With this, they paid 80 rupees. They didn't pay 20. If you collect 20 from them, you should pay 100. Call 20, they don't pay. Call scenarios for the share for which are money 80 rupees. You transfer to capital reserve and then enjoy. But that usually doesn't happen. But just telling you that. Then premium on redemption of preference shares can be paid only and only out of profits. If you have any material which says it can be used from security premium, that is very outdated. Please don't refer that. That's not allowed. Whenever company wants to redeem preference shares at at premium, such premium should come only and only from profit. Sir, what if there is no profit? Then redemption is not possible at premium. Redemption is not possible at, sir, but 20 years is getting over, sir. I want to redeem. Redeem at par. Redeem at par. It? Very good. So then next thing is, if redemption is out of profits, profits, then capital redemption reserve should be created to the extent of nominal value of shares redeemed. Understood this? Did I discuss this? Yes or no? Let's get going. Let's see the next part. Sources of money for the purpose of redemption. Two sources: internal, external. Internal means profits. External means fresh issue. External means, so internal funds. If you use cash funds, then you should create CRR. Correct? So internal funds can be sale of assets, sale of investments, or issue of debentures, taking of loan. That is also internal funds. That is not fresh issue. It is fresh issue only when shares are issued. It is fresh issue only when, very good, issue of shares is fresh issue. Then whenever you use internal funds, you should create CRR. Got it? How much CRR should we create? To the extent of nominal value of funds, to the extent of nominal value of preference shares redeemed, and they should come from free reserves, general reserve and P&L account. Got this? CRR can be used only and only for the purpose of, can we use it for any other purpose? Answer is no. External funds, number of shares to be issued. We count what here? Number of shares to be issued. If they give in the question, very good, we are happy. If they don't give, then we should find. How do we find it? If in case they mention that when the profits that we have is insufficient, when the profits that we have to create CRR is insufficient, then you take nominal value of preference shares to be redeemed less how much is the available divisible profits. Whatever we get, no balance. This is the funds to be raised by way of fresh issue. This means funds should be raised. How many shares should be issued have to be found. So this has to be divided by the what price? Issue price or nominal value? Paid up value per share. That is like nominal value per share. If in case when cash and bank balance is insufficient, then the same thing we'll do. We'll identify how much balance is required, and that will be divided by issue price per share. This is the smallest trick. So this is not there in any material. This I made it up to make you people understand this better. You see, entire ICA study material. Some questions they would have taken nominal value. Some questions they would have taken with premium. And some questions they do nominal value, but later adjust premium separately. Are you getting it? So this is something. If you want to take a picture of this, you can take a picture of this. This is going to save your day. Is going to save your day. I'll repeat this once again. Remember, the questions where they will tell how many shares are to be issued is very easy. They will tell issue 10,000 shares. Easy, very easy. If they don't tell how many shares to be issued, if they ask us to find this much money is available in cash, balance will be raised by way of fresh issue. What will they say? Balance will be raised by way of fresh issue. And they ask us to compute the number of shares that is required. Then what do we do? First, we'll identify how much money is required for redemption of preferences. From this, we deduct how much money is already available. We'll deduct how much money is already. After we deduct how much money is already available, we'll get the balance of money that is required for the purpose of redemption. This money will be divided by paid up value per share if I would say profit is insufficient. We don't have enough profit to create CR. Are you getting this? If the cash and bank balance is not sufficient, we're raising this to generate enough cash. Then what do we do? Divide it not by paid up value, but divide it by issue price per share. You get this? If there is shortage in reserves, what do we divide it by? Paid up value. If there is shortage in cash and bank balance, we divide it by Akka. Everyone got this? Then we'll quickly do a question on this. Once we do a question, we will wind up. Accounting for redemption, preference share capital will decrease, capital will be debited. Out of divisible profits, out of fresh issue, or this both slightly. So capital is decreasing, debit capital. We should pay money to preference shareholder. So we will credit preference shareholder. Premium, if it is there, debit that premium also. Premium is expense. And when we pay this, journal entry will be preference shareholder account debit to bank. Preference shareholder liability will decrease, bank balance asset will decrease. And this premium, whatever is there, it has to be transferred to P&L, and we should create CR. I'll write P&L account debit to premium. Premium being transferred to P&L account, and I'll create CRR from divisible profits. Divisible profits can be either general reserve or P&L account. Did you understand these entries? This is when it is made out of completely free reserves. Next one, what if it is made out of fresh issue? First issue the shares. Cash account debit or bank account debit to share capital. Asset increase, capital increase. Next, we write share capital account debit, premium or redemption of preference shares account debit to preference shareholder. Then preference shareholder to bank. Then P&L to premium. Then finally, preference share over. No? Did we pay preference shareholder? Yeah, we paid everything. Should we create CRR? Not required. Not required. However, if it is partly out of fresh issue and partly out of free reserves, first issue the shares and then go on redeeming. And then you also create CRR to the extent the funds used are other than by way of fresh issue. Got it? Let's take continue. Topic is over. We just need to do questions. Just need to do. Shall we do a question? Bunny, bega marna. Madbittu break. What time is retail break? 2:45, 2:25, 20 minutes ಇದೆ. ಆರಾಮಾಗಿ ಮುಗಿಸೋಣ. Question number 131, clean limited. Only this question. Shall we do clean limited? Should I clear the answer completely and then solve it from the scratch, or can I show the answer? Now you're telling show. After some time you'll say, better sir, question you number you tell, I will do it at home. Then you say, sir, chapter name you tell, sir. Remaining I will read. Then sir, subject you tell which one I should read. I will read. Question number 8. This is also one of the past examination questions. Not under CA intermediate scheme, but under IPCC scheme. Hey, lunch break kotre, will you people come back after that? Yaar mail doubt nahi. Naning nin mail doubt. You won't come back. You will come back. Nice. I don't mind. The game will go on. Summarize balance sheet of Clean Limited as on 31st of March 2016 is as follows. We have equity liabilities, share capital, reserves, current liabilities, all of this nonsense. The share capital of the company consists of 50 equity shares of rupees 4,50,000, and there is some split. Basically, what we need is this. Rupees 100 each, 8% preference shares are there, 1 lakh. So this is what the company is issuing, no? No, this is already issued. Reserves and surplus is completely profit and loss. So it is divisible profits available. We can use it for bonus issue. We can use it for CRR. We can use it for the purpose of premium or redemption of preference shares also. No restriction. In order to facilitate the redemption of preference shares at premium of 10%, company decided to sell all the investments for 30. Is the investments? 37,000. It is sold for 30. Listen, when you sell this 37,000 worth of investments for 30, you will make loss of 7,000. When you make loss of 7,000, your P&L account balance here, no. This will reduce by 7. First, you should reduce it and then account for the rest. Got it? Shall we read the entry for sale of investment? What is the entry? Cash account debit, sorry, bank account debit 30,000, P&L account debit 7,000, to investments 37,000. Observe this. Correct? Received 30, lost 7, investments 37. After this, what's happening? To finance part of the reduction from company funds, subject to leaving the bank balance of 24,000. So, bank balance is how much? 62. Now, you will further receive 30. It will become 92. It will become, in that 92, 24,000, they want to have it in bank balance. How much is that? 92 minus 24. 68,000. Correct or not? 68,000 will be raised by way of fresh issue. Got it? Yes or no? Do we have sufficient reserves to create CRR? Is there shortage of funds or is there shortage of reserves? You should figure that out. If it is shortage of reserves, then we divide it by paid up value per share. If it is shortage of cash, we divide it by issue price. They are telling to issue fresh equity shares of rupees 50 at a premium of 10. If the shortage is funds, then this 37 plus 37, sorry, 62 plus 30, 92 will be divided by 50. If it is shortage of reserves, if it is shortage of cash, we'll divide it by 60. How do we get to know which is shortage? We should compute. Compute ಮಾಡಿದ್ರೆ ಎಲ್ಲ ಗೊತ್ತಾಗುತ್ತೆ. Come on, let's see. Let's do that computation. Yeah, nominal value of preference shares to be redeemed. How much? It's there in the question. 1,30,000. 1,30,000. How much is the premium? So we should pay 1,43,000. 1,43,000. How much cash do we have? How much reserves do we have? Reserves in balance sheet is 96. 7,000 rupees loss on sale of investments. Premium 13,000 will also will deduct. How much will we be left with? 76,000. Reserves available for redemption is how much? 76,000. How much is cash available? 62,000 was there. We sold investments. We got 30. 92 aitu. Then balance 24 should be maintained. How much will be cash available for redemption? So which is shortage? Cash. Which is shortage? Cash. So we'll divide it not by paid up value of 50, but we'll divide it by issue price of 60. How much? See, we need 1,43,000 for redemption. Thank you, sir. 1,30,000 redemption of preference shares nominal value plus premium of 10%. 10% of 1,30,000 is 13. 13,000 plus 1,30,000 is 1,43,000. In that, how much cash do we have? Cash that we have is, already we have 62, we got 30, 92. In that 92, we should maintain, oh sorry, we already have how much? 62, we got 30, it will become 92. In that 24 should be maintained. So how much do we want? 68,000. Correct? So 1,43,000 should be paid. How much should be paid? How much do we have? 68,000. Balance 75,000 divided by 60. What do we get? 1,250 shares will be issued. 50 rupees nominal value, 10 rupees premium. Bank account debit to share capital to security bill. Bank account debit to share capital to, I'll tell you, observe this. Bank account debit to equity share capital to security bill. How much? 1,250 shares into 60. 50 equity share capital, 10 rupees premium. Got it? Then that preference share capital 1,30,000 debit. Also premium 13,000 debit. Totally preference shareholders should be paid 1,43,000. We pay our preference shareholders 1,43,000 by bank. 13,000 rupees whatever premium is there, we'll adjust it with P&L account and then we create CRR to the extent of 67.5. Sir, yes, sir, 67.5. Very simple. How much is our preferential capital decreasing here? Here. How much is it decreasing by? 1,30,000. Against this, we are issuing some equity shares. How much is equity share capital increasing? Preference share capital decreasing 1,30,000. Equity share capital is increasing 62,500. 1,30,000 minus 62,500. 67,500 is the extent to which total capital is decreasing. Create CRR to the extent of 67,000. There are few questions in the material where they want us to do this assumption, and using that CRR they want us to do bonus issue. Get this? I have not taken the question which you might think is maximum difficulty. I have picked such question which covers the all topics or the adjustments to be covered and will not be repetitive in nature. You already done bonus issue, so I didn't take that. Not the I didn't take the lengthy one. I took the one which covers the maximum possible adjustments and will not be repetitive in nature of the topic that you already got it. And at 2:32, told 2:45, you told 3 o'clock only will happen. So this is it. And they've also asked us to do balance sheet. Balance sheet, I hope you'll be able to handle it. But remember to do disclosure. Reserves may should disclose what is the appropriation of reserves. And share capital may we should disclose how many preference shares are redeemed and how many equity shares are issued. Part of note stock accounts to be disclosed. And working note also present it nicely. For this working note, you will get marks. For this working note, you do get marks. Got it? So this is an easy topic on which questions do come in the exam all again. So we are done with profit pre and post incorporation, bonus issue, right issue, and the redemption of preference shares. My plan was to do till redemption of preference shares by lunch break, and I have done it. But lunch break we are supposed to take at 1 o'clock, which we are taking at 2:30. I agree, but we are little behind the schedule. We also started little behind the schedule. I am sorry for it, but I hope you people are happy to the extent we've done justice to the worth it. No, your time is not getting wasted, right? That's it, guys. So now we'll take a break. It is not 2:45, it is 2:35. So we finished in 25 minutes. So now we're taking lunch break. Difference between? I thought you were asking me. So we'll take 2:35 p.m. to what time? 25 plus some 15 minutes. Shall we take till 3:10? 3:15 or 3:10? Okay, 3:15 p.m. dot will get started. Okay, 3:15 when we start. Hey, sit. Decorum illa, ಏನilla. ಎದ್ದೆದ್ದು ಹೋಗ್ತಿದ್ದಾರೆ. So 3:15 p.m. what do we start with? Debentures? Or no, we'll do investments. We'll do investment ಮಾಡಿ ಡಿಬೆಂಚರ್. Investment ಮಾಡಿ ಡಿಬೆಂಚರ್ ಮಾಡೋಣ. So 4 p.m. So we should do this one quick. So then we'll do insurance claim. Which is your hatred topic which you don't like? Branch. Insurance claim ಅಲ್ವಾ? Branch ಮಾಡಬೇಕಾ? Okay, will at 4:30 after debentures you want me to do branch, or you want me to do branch before debentures? I don't mind. We can plan that. Think over it in the lunch time when you have lunch. Please do think. If you want me to do branch over and above this at the top, I don't mind. We can do branch at the top. Too many topics, too many concepts are there in the branch. And also do tell me, would you be interested if we tell day after tomorrow again accounts remaining, whatever is there? Because today I can't take it beyond 5. I have one more class, 5 to 8:30. ಇವತ್ತು ಇದೆ, ನಾಳೆ ಇದೆ, ಎಲ್ಲ ದಿನ ಇದೆ. Would you be coming day after tomorrow if I tell again some half day? If you won't come, then ಬೇಡ ಬಿಡಿ ಪರವಾಗಿಲ್ಲ. Then how much ever possible we'll do so much today. Okay na? Think and tell me post break. But if it is a no, tell me. I am not here to hear yes from you people. Tell no, but it's okay. It's okay, but tell no. Loudly you tell me. Okay? Don't keep it inside you and then, yeah. That's it. Let's take a break, guys. See you all at 3:15. Very good afternoon, everyone. Welcome back to CA Intermediate Marathon Revision. We were discussing the chapter of redemption of preference shares before our lunch break. And I hope people have had good lunch break. We'll come back to post lunch session. And in this part of the session, we have made slight changes in the plan according to our whims and fancies. Yeah, we decided it, not me. So now we're going to start with insurance claim. And once we finish our insurance claim chapter, we'll do branch. The time permits, we will be doing departmental accounting also in today's session. And the rest of it, Wednesday morning, we will start with remaining portion. That would be the topics of investment accounting, redemption of debentures, hire purchase, incomplete records, and accounting standards. We'll have good day, good amount of syllabus is there for that day. And tomorrow's session, as planned before, 10th of October, will be advanced account. Online recorded one will come. Was it out? Fine. Let's start with insurance claim. Give me one moment. This is again a Tata Bye Bye chapter which is there right now in the syllabus, which will no longer be there after this attempt. This will be the last attempt. Insurance claim is removed. Specialized case. Now, how often do you get a client who will tell like my business caught fire and then it is lost? I have a loss of profit policy. Compute my loss of profit. Very, very rare. It's very rare. Extremely less. The reason is there is a lot of development in firefighting in the recent times that fire insurance practical cases have decreased. Kidding, guys, not serious. Let's get started with chapter 10 insurance claim. So this is the weightage of the chapter in the past few examinations. Regularly it's come for 10, 10, 10, 10, 10, 10, 10. Two times it's come for 5 marks. Let's see what will it come for in November 2023 exam. There are two basic topics in this chapter. One is on loss of stock and the other one is on loss of profit. Loss of stock is where you take an insurance policy protecting your goods from getting caught by fire, and magically fire caught and then you got goods got damaged. Now you need to file an insurance claim saying how much is the stock that's there in the godown. And what is happening along with this is the books also will get burnt lot of times. So they'll tell books are also burnt, goods are also burnt. You need to tell how much goods was there when the fire caught. So that is the extent to which you will be basically filing your insurance claim for. This can be required by the, what to say, the claimant. The insured ask you to compute, or it can be insurance company ask you to compute what is the value of the goods that is lost by fire. So this is the first part. The second part is where when the business catches fire, for you to refurbish the entire exterior and interior, build up the entire infrastructure freshly, and to restart the business, there is some downtime. There is certain period, 3 months, 4 months, 6 months, or 7 months, or maybe a year, for the extent which the business might not be done or might not be done at the scale at which they would have done otherwise. So in that scaled down business, there is lot of sales that is lost. That sales which has come down has decreased the profit. That profit has been lost because there was fire. Insurance company might have to compensate for the profit that is lost by the businessman because of fire. So how much is the profit that we would have earned if there was no fire? How much is the profit that we would have earned if there was no fire? That's another set of questions that we need to compute. That's part 2, your favorite part. So let's get started with the part 1, loss of stock. The loss of stock is where there was a godown and then it caught fire, and it didn't just burn the godown, but it also burned the stock that is there inside the godown. When the stock got burnt, it is right now turned into ashes. We need to find the value of the stock that got burnt looking at the ashes. How do we do it? We basically can't do it. So what we do is we are trying to find the value of the inventory that was there in the godown when the fire happened. How to find this? We know the last year's financial statements. Sir, when the books caught fire, won't those books also be caught fire? Would have filed a copy of those books of accounts with income tax department and MCA. No? From there, we'll download the soft copy. Would have given it to bank, would have given it to shareholders. Somewhere, some data will be there. So using that, we'll be able to figure out the last year's closing inventory. Last year's closing inventory will become this year's opening inventory. And after this year's opening inventory, during there you would have done a lot of purchases. If you have purchased goods, someone else has sold goods, you go to that person who has sold goods, ask him for bills. How much did I purchase from you? He will give you some details. If he doesn't give, you would have paid money through bank. Your books got burnt. Bank's books are still alive. No? Bank passbook you will take. Through that you will identify to whom and all have you made payment. Collect details from them. Sir, now you don't even have to do that. Very simple. GST filing is being made. No, go to GSTI and download the entire sales report. You'll understand how much sales have. This is a very outdated topic. In modern time, this doesn't work. Modern time, entire data is there in the server. Even if the laptop catches fire in the server cloud, it's there. Sir, what if cloud melts and the rain comes? This cloud is not that cloud. Yeah. No, once one Rajasthan MP actually told it. अब सारे डेटा ये लोग लेके क्लाउड पे रखा है. अभी बारिश गिरेगा तो डेटा मिस होगा. He literally told that. And the same minister had once more told that the water that's coming to their state is not good because of which the crops are failing. He told ये जो लोग पानी देते हैं इसमें सारा बिजली निकाल के देते हैं तो उसमें शक्ति ही नहीं है ना उससे farming कैसे. He literally told that when you take electricity out of the water there is no life in the water. And with such I am not kidding. The present Rajasthan Chief Minister told this in a press meet. I won't take the name. Yeah, Sachin Pilot will be very happy if I take the name. So I won't. Let's start. So what do? We, based on this kind of data, we understand how much is the purchase we made. Similarly, we'll talk to our customers or we'll take GST returns or something. We'll understand how much sales did we do. So we know opening stock, that is from last year's closing stock. We know how much purchase we made. We know how much sales we made. Based on the previous year data or based on the payments, we can also identify how much expense did we incur. When we write opening stock, we write purchase, we write expense, we write sales. On the sales, we know our profit margin also, no? On that sales, if I write profit margin, I am preparing something which is looking like trading account, but not trading. From the beginning of the year till the date of fire, I'll write purchase, I'll write sales, I'll write expense, I'll write opening stock. On the sales, I'll find GP also. I'll find closing stock as balancing figure. This closing stock is the stock that was there in my godown as on the date of fire. This closing stock is the stock that was there in my godown as on the date of fire. That is the extent to which I should file my claim. Are you getting it? When we write sales here, when we write purchase here, we should not write the sales and purchase considering ownership. We should write sales and purchase considering possession. Let's say we sold some goods, but the customer didn't take the delivery. The goods were still there in my godown. I sold some goods, customer gave the money, I gave the invoice, customer gave address, I need to send the goods. I didn't send the goods. I told I'll send next week. I kept the goods in my godown, went home and slept. Only to wake up next morning, seeing my godown burning. So now those goods are burnt. Will I get insurance claim on those goods or I won't get? I will get. I will get. Insurance policy is based on the insured policy. When you say, do we have insurable interest on it? Not based on ownership. I have right on that goods that was there. I have taken insurance on the goods in my godown, not based on the fact whether I own it or not. I need to make good to the person who has bought. I cannot tell him, no, you should have taken. You didn't take it, got burnt down. Not my loss. Can't tell that. You would have to compensate. So I would have taken protection against such goods also. Other way around, let's say you purchased some goods, you've not taken delivery of that. You made the payment online, you got the invoice, you entered it in books of accounts, but you physically not received the goods. If the godown catches fire, such goods which is there with your supplier, but you purchased, will it get burnt? By your godown caught fire, no? Goods which belong to you, which is there in multiple places also will catch fire remotely. That won't happen. Those goods are safe. Will insurance company give you claim on such goods which you purchased but you have not received? So they should give insurance on such goods which you sold but still in your godown. So insurance company will accept the claim against the goods that is there in the godown, irrespective of the fact whether those goods were sold or not sold. So usually when we write trading account, we write goods purchased, not goods received. Goods purchased but not received will be still written as purchase. Goods sold but not delivered will be still written as sales. Why? Trading account's objective is not to find the value of the goods remaining. Its objective is to find profit. Now, when we prepare something which looks like trading account, is our objective to determine the profit? No, our objective is to determine the value of stock in the godown as on the date of fire. What is our objective? It is to find the value of the goods in the godown as on the date of fire. So when we're trying to find value of the goods in the godown as on the date of fire, we don't follow the principles of trading account. We do it similar to trading, but not trading. The objective is not same. That's the reason, my friends, we don't call it trading account. We call it memorandum trading account. What do we call it? What is the objective of memorandum trading account? See how memorandum trading account will look. Trading account's objective, determination of gross profit. Memorandum trading account's objective, determining stock as on date of fire. What is the period for which trading account is prepared? Accounting year. Am I right? What about memorandum trading account? It is prepared from the beginning of the year till the date of fire. From the beginning of the year till the date of. Very good. Next, what are the entries that is made? In trading account, entries are made based on accrual basis. Based on as and when the transaction happens. As and when the goods are received, we don't write the entry. We purchased, we write the entry. Sir, we have not received goods. It's okay. We don't care about possession. We're not so possessive. We're only worried about ownership. Do I own it? Yes. I'll record it. Whereas memorandum trading account, we write the stock on actual basis. We write it on. You're getting it. Goods are sent on return or approval basis. It's with customer. We'll still include it in our closing stock or trading account to determine profit. However, to determine our value of the stock as on the date of fire in the go down, can I do that? No, no, no. I'll write it only when it is actually with me. If the goods that I own is with my consignee or is with my customer or agent or branch, in my memorandum trading account, I'll not include it. Why? I will not get claim on that. Throughout my objective is to find how much stock was there when there was fire. Got it? That's it. So closing stock. Here it is taken based on ownership in trading. But in memorandum trading account, it is based on possession. Based on, once you get this topic, no, rest of the questions will become very, very easy. Now, this is how memorandum trading account is prepared. We'll write debit, credit. On the debit side, we do write opening stock. This is taken from the previous year's closing stock. We write purchases till the date of fire. How do we get opening stock? We take it from the previous year's closing stock. This closing stock of the last year, they would have written it according to para 5 of AH2. They would have written this according to para 5 of AH2 says inventory should be recorded at cost or NRV, whichever is less. That's how they would have recorded. But when insurance company is going to give you money, they're going to compensate you for cost of, not cost or NRV, whichever is less. Because you pay the premium on cost, no? So what should we do? Last year's closing stock in the last year's trading account or balance sheet will be cost or NRV, whichever is less. If cost or NRV, whichever is less in last year balance sheet is cost, no problem. If cost or NRV, whichever is less is NRV, and we recorded NRV. In the current year trading account, memorandum trading account, when we start, we don't write NRV. We will bring it back to cost. We'll bring it back to and record it at original. Get it? Have a look at this. Check if the goods are recorded at a value below cost to comply with AS2. If it is recorded below cost, then adjust it and bring it back to original cost. Next one, purchases. Purchase will be recorded till the date of fire. Cash purchase, credit purchase, everything together. Till the date of, very good. When I say till the date of fire, you should check if the goods received are recorded or if the goods which are not received but purchased are also recorded. If there are any goods which are not received, but purchased, if it is recorded, then we should eliminate it. If goods purchased and received are recorded, good. If it is not recorded, then we should include it. If the goods which are purchased but they are not received is not recorded, then we should, what did I tell? If goods are purchased and received and recorded, not good. If goods are purchased but not received, then no problem. If goods are not recorded, then recorded. Or rectification of error was simple. I'm thinking something else, telling something else. If the goods purchased are not included, include it. Include it. Got it? And if assets purchased are wrongly included in purchases, eliminate it because that's not goods purchased. Got it? For that, you would have to take separate policy. If the goods withdrawn for private use or used for sample purpose, advertisement purpose, they should be deducted no from purchase. If they have not been deducted, do it. This is basically rectification of errors. Entry transaction has happened, entry is not made. We'll make the entry, and we'll write direct expenses till the date of fire, whatever is incurred. This is based on cash book basis. If in case there are some outstanding expenses which has been incurred but not paid, you know it, you write it. You don't know it, it's okay. And only indirect expenses, sorry, only direct and only direct expenses should be written whether paid or not. If there is any indirect expenses written, eliminate it. Or if there is any non-cash expenditure forgotten to be written, please include it. So that's what we should be doing. Then comes our, this I told, check if any direct expense incurred is not recorded. If it's not recorded, do record it. Then comes our sales. Sales should be again recorded till the date of fire. Till the date of fire. So till the date of fire, cash sales, credit sale, whatever is there together, from cash records and debtors record, we write it together. If goods are sold but not dispatched, if the goods are sold but not dispatched, what do we do? We should not record it as sales because we're trying to find the value of the inventory in the godown as on the date of fire. If they've recorded as sales, that would decrease our closing stock, no? So we add it. Got it? Here what has happened, check if goods are sold but not dispatched or recorded. They've already recorded it as sales. We'll reduce it from sales. So that our sales will become, no, wait. If goods are sold but they are not dispatched, they've recorded as sales. They should not be recorded as sales. We'll reduce it from sales. No. Correct or not? So that our closing stock will become more. We'll add it to closing stock or reduce it from. Here we'll reduce it from sales so that our closing stock will become. Got that? And then if goods are sent on sale or return basis, it should not be part of our closing stock. Are you getting it? So it should not be part of our closing stock. So we'll reduce it from our sales. Or if it is already recorded, you can do two things. The stock is not there with us. It is sent to them. It is in their godown. It should not be part of our closing stock. Either include it in sales or you should write it outside the books of accounts for memorandum of trading. Point is the stock is with somebody else. If your stock catches fire, you will not get insurance claim on that. It should not be part of closing stock. It should be part of sales. If they've reversed it, then we will adjust it in such a way that it will not come to be part of sales. Clear? And again, consignment stock also. If the goods are sent on consignment, what do? We'll reduce such stock at purchase price, cost price from the stock, so that that stock will get included in the inventory at consignee's place and not in my memorandum trading accounts closing stock. If it gets included in my memorandum trading accounts closing stock, I will file a claim against such stock, which is not accepted because those goods didn't get burnt. No, those goods are with consignee in his godown. Why will I get a claim on the same? Get it? So once I write this, I'll basically apply GP percentage on the sales based on the past year trend. If there is any slight increase or slight decrease in the GP percentage, plus 1%, plus 2%, decrease by 2%, if there is some information, I would adjust that GP percentage on sales and then write it and ultimately find my closing stock as balancing figure. GP percentage, same as last year, might be subject to some changes if there is any fault trend. This closing stock is our answer. This closing stock is not the stock that I own. It is a stock that is there in my godown as on the date of file. Clear? And will I get claim for this stock? I can if I have taken 100% insurance. How do I take insurance? I take insurance by paying premium. Premium is the consideration what the insured will pay the insurer to cover the risk of loss. I have taken an insurance. I am a trader. I pay insurance premium to insurance company to cover the risk of loss against my account. And the insurance company, if in case the risk materializes, they pay me compensation. Such compensation what the insurance company will pay me is called as claim or policy amount or sum assured. And if in case I say I don't want the insurance policy and then give it back to them, on cancellation, some part of the premium they pay back to me, that is what we call as surrender value. And whenever I pay them premium, they accept the policy, they write, no, this much of the stock will be covered. That much of the stock what is covered is called as insurable amount, or whatever the stock that our godown can keep. On that, if we take policy, we call that as insurable amount. If in case the policy amount is less than the insurable amount, we call it under insurance. If in case the policy amount is much more than the insurable amount, we call it over insurance. Let's say my godown has capacity of 10,000 tons of goods. I've taken insurance policy only for 5,000. That is under insurance. That is, if in case my godown has capacity of 5,000, but I've taken insurance policy for 6,000, 7,000 tons, that will become over insurance. My insurance is much more than the policy amount. Insurable amount is much more. Are you getting this point? And this is very important because insurance company will not accept the entire loss unless there is 100% insurance. Let us say I told you my capacity is 10,000 tons. I've taken insurance policy only for 5,000 tons. In my godown, stock that was there is only 3,000. How much stock was there? 3,000. And when the entire 3,000 tons get burnt, 3,000 gets burnt, insurance company will not accept 3,000. Why? You will say 5,000 tons I took insurance, 3,000 is there. Give me insurance for 3. They say, boss, you took insurance for 50%. I'll give you 50% of the loss as claim, not the 100% of the loss as claim. Getting what I'm trying to tell? It is not like up to policy amount they give the claim, beyond that they don't give. No, this clause is called as average clause. You have taken insurance for 80% of your stock, I will give you claim for 80% of your stock. You have taken insurance for 100% of your stock, I will give you claim for 100% of the stock. If you take insurance for 120% of your stock, I will give you 100% claim, not more than that. By insurance, you cannot make profit. You can make good your loss. Got this? Very good. So then average clause in the event of risk materialization, if it is under insurance, only proportion of the loss will be accepted as claim, not the full amount. Loss is how much you lose. Claim is how much insurance company pays you. Got it? Then we have firefighting expenses. In order to save the company and decrease the loss, what the insured will do at times is he will fight against the fire. He'll call that fire engine. He'll use fire extinguishers. He'll put sand. He'll put water. To do all of this, they'll incur some expense. He can sit back, relax, and not do this. While sitting back, not relaxing, and not doing this, he will save some firefighting money. No, but by incurring these expenses, he will save some goods. To that extent, insurance company need not pay money. So insurance company will reimburse the insured for the expenses incurred to fight the fire. This is called firefighting expenses. So for that loss, proportionate loss, we add back firefighting expenses, and then this amount also will be given as part of claim. And lastly, we have scrap. Scrap is such goods which are basically sold after getting damaged also. To that extent, insurance company won't pay. Why? Those goods are slightly damaged, but you recovered some money. When you recover some money, to that extent, they'll reduce your. So how to compute this claim and all? It's very simple. We basically check whether there is under insurance or over insurance. We check our policy amount on comparison with insurable amount. If in case the sum that we have insured is lesser than the stock as on the date of fire. On the fire date, we have about 1 lakh rupees worth of stock. Our insurance policy is up to only 80,000. What do we call this? Under insurance. Why? We know that we'll maintain the stock of 1 lakh. We should have taken policy for minimum 1 lakh. Now, because only 80,000 worth of goods has been insured and 1 lakh worth of stock is there and it gets burned by fire, will insurance company accept the claim of 80,000 completely and then give? No. They're saying 80% insured, whatever loss that has happened to you in that 80%. 1 lakh worth of stock got burnt. In that 1 lakh, salvage value deduct. What gets is loss. On that loss, 80%. How do we compute it? Very simple. We'll take like this. Average clause will be computed as claim amount is equal to loss of stock multiplied by sum assured divided by insurable value. This is the formula. But I would strongly recommend you to not use formula anywhere. We'll do it logically. How do we do it logically? See, you write insurable amount, you write sum assured. Insurable amount is the extent to which you should have taken insurance. Sum assured is the extent to which insurance is taken. Now, if you write less salvage value, this is the stock that is there as on date of fire. Insurable value is the stock as on date of fire. Salvage is even after getting burnt. When you sell that goods, what value we get? Salvage. From the stock that is there on the date of fire, if you deduct salvage, what you get is loss of stock. What you get is loss of. You should have taken policy for this much. You taken policy for this much. Your loss is this much. How much will you get as claim? Loss of stock multiplied by sum assured divided by insurable value. ಇಷ್ಟಕ್ಕೆ ಇಷ್ಟಾದ್ರೆ ಇಷ್ಟಕ್ಕೆ ಎಷ್ಟು. We'll do loss of stock multiplied by sum assured divided by insurable value. We do loss of stock into sum assured divided by insurable value will be our claim amount. Everyone understood claim amount? Got this? In the case of over insurance, claim will be equal to loss because you've taken policy for an amount much more than loss, much more than the insurable value you've taken policy. So whatever is your loss fully will be accepted. Got this? And after we compute this, we'll add that firefighting expenses if there is any and then give it to the insured. Here we are acting as an agent between the insured and insurer in helping both of them understand what is the extent to which they need to settle money between them. Now based on this, we need to do a question. We'll do a question on loss of stock and then do loss of profit. Everyone, let's do a question on loss of stock. Energy ಎಲ್ಲ ಕಡಿಮೆ ಆಗ್ಬಿಟ್ಟಿದೆ. ಇವರು ನಿದ್ದೆ ಬರ್ತಿದೆ. Yes sir. So happy and proud people. Let's start with illustration number 6. This has two variants of inventories. This is a nice question. Can we do illustration number 6? Should I clear the answer and show it from the scratch or shall I show it from where we have left? From here? If in case they give us the previous year's closing stock and previous year's CP percentage, very good. If in case they don't tell us the previous year's CP percentage or previous year's closing stock, we might have to prepare trading account of previous year to determine the answer. In this question, GP percentage of previous year is not given. So to find out gross profit of previous year and GP percentage of previous year, we end up preparing trading account to find GP in this question. So this has two variants of goods also. I think we are good to start. Page number 160. Let's start with 160. First of April 2008, Sri Ramesh, the stock of Sri Ramesh was destroyed by fire, but sufficient records were saved from which the following particulars are ascertained. Stock as on 1st of January 2007. See, we are in 2008. 1st of April 2008, fire happened. We are assuming that the year ending is 31st of December, looking at the data that they are giving. So 2008 is current year. 2007 is last year. Last year, beginning date stock is 73,500. Last year, beginning date, the stock is 73,500. And then last year, closing date, the stock is 79,600. Shall I prepare last year trading account? In the last year's trading account, we will write opening stock of 73,500 and closing stock of 79,600. Then we have purchases. This is again in last year, 3,98,000. I'll write in the previous year purchases as 3,98,000. What do we have after that? Sales in the last year is 4,87,000. I'll write in my trading account sales as 4,87,000. After we write sales as 4,87,000, purchases is 1,62,000, sales is 231,200. But this is in the current year, from the beginning of the year till the date of fire. From the beginning of the year till the date of fire. So let's write this in the current year. Memorandum trading account. How much is purchases? 1,62,000. How much is sales? 2,31,000. Is that right? 231,200 and 1,62,000. I have written the details. In the valuing the stock for the balance sheet as at 31st December 2007. 31st December 2007 is last year. Previous year's closing stock 2,300 had been written off a certain stock which was poor selling line having a cost of 6,900. There's one item whose cost was 6,900. You brought it down by 2,300. So we've written it at 4,600. Cost is 6,900. NRV is 4,600. To bring the value of the inventory from cost to NRV, we written down by 2,300. That is good. AS2 is very, very happy. But as per memorandum trading account, you should record it at cost. So now what do? I should record it at 6,900. It is been recorded at 4,600. I'll add back 2,300. I'll add back 2,000. Very good. So if I add back 2,300, what would I get? What is previous year's closing stock? 79,600. If I add back 2,300, it comes to 81,900. Right? And here I would write it as 81,900. In that 81,900, that slow special item is 6,900. So what would be balance? 81 minus 6,900. Normal stock is 7,500. On normal stock, I'll make normal GP. On this abnormal item, I might not make normal profit. I might make loss. That's true. Then what do we have? A portion of these goods were sold in March 2008. March 2008 is current year, before fire. A portion of it is sold for 250. Original cost is 3,450. 3,450 worth of goods have been sold at 250 loss. So what is selling price? 3,450 minus 250. 3,200. So I will write here sales 3,200 is abnormal. On this 3,200 I made loss. How much loss? 250 loss. So 6,900 was there. 3,200 is the sales, 250 is loss. What will be closing balance? So 6,900 minus 3,200 minus 250. 3,450, that is closing stock of abnormal stock at cost. At cost. Now, what if they say this 3,450 was to be valued at 2,000? We don't value it at 2,000. We write 3,450 for insurance claim. Its value might be zero. We don't care. We'll still get insurance claim. So there might be some scenarios where selling goods is a bad option. Putting fire on it and claiming insurance is a much better option. Yeah. Then the remainder of this stock was now estimated to be worth its original cost. The value of the stock has come back to original cost. Subject to the above exception, gross profit had been remained uniform rate throughout the year. Except this special item, rest of the items gross profit ratio is same. Same means what? Whatever was there last year, same it is this year. Have they given last year's thing? We should find it. So what do? Come to last year's trading. Everything is there. You'll take the total year 568,900, write it and find GP as balancing figure 97,400. Once we find gross profit of 97,400 as balancing figure, this 97,400 on the sales of 4,87,000, how much will it be? GP will become 20%. They're telling GP percentage for current year is also like previous year. In the current year, we have our sales of abnormal items 3,200, total 231,200. Normal sales will be 231,200 minus 3,200, which is 2,28,000. On this, our GP will be 20%. How much is that? 20% of 2,28,000. 45,600, that is the total. And purchases, we know total is 1,62,000. They have not told anything. Because they have not told anything, I'll assume that entire purchases is normal items only at 1,62,000. Right? If I have everything here, can't I find this closing stock as balancing figure? I'll find this closing stock as balancing figure, also normal. But normal, abnormal doesn't matter. What is the stock as on the date of fire which caught fire? 58,050. This is not our loss. This is stock as on date of fire. We should have taken insurance to the extent of 58,050. But to what extent have we taken insurance? Value of the stock salvaged is 5,800. So 58,050 minus 5,800. That is loss of stock. How much is loss of stock? 58,500. Sorry, 58,050 minus 5,800. 52,000. 52,250 is loss of stock. But policy was taken only for 50,000. Will they give 50,000 claim? We should have taken policy for 58,050. We've taken policy for 50,000. How much percentage is the policy covering? How much percentage? Still no. 50,000 divided by 58,050. 86% is the policy coverage. On that 58,050 minus 5,800, whatever we get, on that you apply that 86%, what comes is loss. Sorry, claim. Did not understand, no? Very simple. Don't apply the formula. I'll teach it you differently. Observe. Stock as on rate of fire is 58,050. We just found it here. However, the policy amount is there to the extent of 50,000. So policy is for 50, stock is 5850. There is definitely under insurance. Am I right? Stock was 58,050. 5,800 is salvaged. So how much is the loss of stock? 52,250 is the loss of stock. How much is loss of stock? 52,250. And policy amount is to the extent of 50. Policy is there to what extent? 50. So 52,250 into 50 divided by 58,050 will give us claim amount of 45,000. This is the extent to which we'll get a claim. Getting it? You can apply that formula. No one is stopping you. But this would be much simpler to remember. Stock as on date of fire, less salvage, loss stock. Here policy amount, loss of stock multiplied by policy amount divided by stock as on date of fire is claim amount. We use a similar thing in our loss of profit also. We don't do anything new there. Got it? Should I repeat any part of the answer? If you did not understand. This is one of the questions with maximum difficulty. GP of last year has to be found. Abnormal loss is also there. And stock is valued at a price lesser than the. So all the three adjustments are here. My God, I thought only foundation people feel like this sentence sleepy. Inter students also sleep in class. Very surprising. Fine. Can we do that next topic? Loss of profit. Yeah. Let's discuss loss of profit. So the profit is lost. looks like an what do you call it? What do they call? What do they call when you disagree with the first part of the sentence in the second part of the sentence? Oxymoron. Oxymoron, no? Loss of profit. Yeah, exact approximate. Exact approximate to exact. You people are not in a position to appreciate anything in life, no? Exact approximate ಅಂದ್ರೆ ಗೊತ್ತಾಗ. Clearly confused on loss of stock. Loss of, ಅಂದ್ರೆ if fire had not happened, we would have earned profit. Because fire happened, we lost the profit. Profit we would have earned is now lost. You didn't do sale. Because you didn't do sale, you didn't make profit. So you're asking the insurance company to not just pay for the stock that is burnt. It is also for the profit that you could have made, but now it is burnt. Opportunity cost. Now this is a shop. The shop got burnt. If the shop was not burnt, it would have been normal. It would have been normal. I would have sold goods. If I would have sold goods, I would have made profit. Because it caught fire, I had to change the entire interiors. To change the entire interiors, 3 months I didn't make sales here. 3 months I lost sales. 3 months I lost sales. On that sales, I'll apply profit percentage. Whatever the profit percentage on that sales you get, no, that is the profit loss. Yeah. So this is a restaurant. So one fine day there was a chef there cooking, and then instead of putting the stove on fire, he put the entire restaurant on fire. So restaurant caught fire, and they had to stop the business. That stock loss, they found out the policy. But the owner of the restaurant told the business is burnt, not our hopes. We are starting sales tomorrow. But how can they sell food in that such a restaurant which is burnt? So they put one small cart outside, and they redefined that cart to look much better. And in that cart, they started selling. See, ಇಲ್ಲಿ ನೋಡಿ ಪಾನಿಪುರಿ ಎಲ್ಲ ಮಾಡ್ತಿದ್ದಾರೆ. This is an AI generated image. I told make one food stall, and I told make it look more Indian. My God, what is this guy doing? This guy is eating. And look at this chef. I got very fancy chef, okay? I told make him look more Indian. That GPT. And this is how it is made. Oh God. Wasn't this there when we did the chapter in the class? It was there. There. Huh? Oh, we changed the chef after that. He left. We got a new chef. So what is our objective in the chapter? Our objective in the chapter is to find out how much profit we would have made if there was no disruption, if there was no disturbance. How much is the profit that you would have made? It's like this: you are studying, your friend comes and then starts talking to you, and then you will also start enjoying the conversation, and then 2 3 hours over. After that, you sit and think, if in case your friend would have not come, or your friend would have not disturbed, how much you would have studied? Yeah, that's the part. Like how much you would have studied. Similarly, if there was no fire, how much profit you would have made. So profit that we lost, profit that we, because of disruption to business caused by fire break. Now, how do we find out profit that we lost? Why is there a decrease in profit? Because there is decrease in sales. Because there is decrease in. So can I say loss of profit is shortage in sales, or sales that we lost multiplied by profit percentage? Did you understand? Usually people learn this unit as step 1, step 2, step 3, step 4, step 5. No? We don't learn like that. Little more logic. Yeah. Profit is lost. Profit is lost because sales decrease. So how much sales did we decrease with by? Like for example, if there was no disruption, I would have made 1 lakh rupees sales. Last, how do you tell 1 lakh rupees? Last year, these 3 months, I made 1 lakh sales. Okay, so this year also 3 months, I would have made 1 lakh sales. What is your profit percentage? Last year, these 3 months, I made 20% margin. On 1 lakh, 20%, 20,000 you would have earned. Because there is fire, you didn't make 1 lakh sales, you didn't earn 20,000. So we do shortage in sales multiplied by profit percentage. How do we get this shortage in sales? Shortage in sales, we compute it based on the performance of the sales in the previous periods. But previous year period is just a basis. That cannot be this year's sales. This year's sales can be much more or much lesser than that. So what do? We see year on year. We don't just take random 3 month sale. We'll take last year corresponding to this period. For example, your sales is too huge in September, October, November. Am I right? So in this year, September, October, November, your business got disrupted. You don't take last year's January, February sales, or you don't take last year's full year sales divided by 12 into 3. No, you will take last year's sales during September, October, November, multiply, add some trend to it if in case you expect any trend. Like year on year, your sales is increasing by 10%. So in comparison to last year also, your sales would have increased by 10%. So what do you do? Decrease in sales. How do we get that shortage in sales? It is also called as short sales. Expected sales during claim period. That claim period, the period where the business got disrupted. What is the sales that you expected? Plus actual sales. What is actual sales? Your restaurant got closed, but you did business in that small cart. No? There you want some 20,000 rupees sales. So if in case there was no disruption, you would have made sales of 1 lakh. Now because of disruption, you made sales of 20. How much is the shortage in sales? 80,000. How much is the shortage in sales? And that is as per last year limits. Every year it is increasing by 10%. Then you'll add some trend also. You would have made 10% more, 5% more. If there is any basis, strong basis. This is the shortage in sales. Now on this, we compute multiply or we multiply that profit percentage to compute loss of profit. How do we get that profit percentage? This is again based on the previous year. This is again based on the previous year. We take previous year's profit, but this is slightly different. It is not our what to say GP. It is much different than that. So previous year's GP percentage is based on this. No, there is sales in the previous year. There is GP in previous year. And in the previous year, in P&L account, we write some expenses. Am I right? I am dividing those expenses into two categories. One, standing charges. Other one is not standing charges. Standing charges is fixed expense. Second one is variable. If in case you are doing that big restaurant, you would incur a lot of what to say fixed expenses. Maybe like valet parking. You getting what I'm trying to tell? Maybe like watchman, the one who opens the door and then says, "Yes, sir, please come." All that you had. No restaurant tail. Would you incur such expenses? No, you won't incur. Such expenses, percentage impact on the profit has to be eliminated. But rent you would have to still pay. Head chef is there. For him, salary you would have to continue to pay. So certain standard expenses you should continue to pay. So those are standing charges, are fixed charges. We take only those. We take only those. And in those, no, certain things will be insured, certain things will be uninsured. Insurance company will tell when you make the agreement. I will pay you for profit. I'll pay you for this rent. I'll pay you for this salary. I'll pay you for this one. I don't pay you for your interest on debentures. I won't pay. I will I pay. So they will tell certain items to be allowed, certain items not allowed. So whatever the insurance company is promising to reimburse in the event of loss, it's called as insured standing charges. Whatever insurance company is not willing to pay, it's called as uninsured standing charges. So from gross profit, if we adjust these items, we get net profit. Am I right? If we try to find the profit percentage, it is not this net profit divided by sales. You're not taking GP percentage. Hey, insurance company doesn't reimburse you only for GP. It will reimburse you for GP along with that some standing charges also. So how we compute is we take this net profit and we take the standing charges which are insured. So we compute GP percentage as net profit plus insured standing charges divided by sales of previous year. So insurance company, when it covers your loss, when it tries to compensate you, they won't pay just for GP. They'll pay you for GP plus, sorry, they'll pay you for net profit along with some insured standing charges. You're getting it? So this is how we compute the profit percentage. Sir, we never did this formula anywhere in trading account, P&L account. This is special purpose. Only for insurance claim we follow this formula. How do we compute profit percentage? Net profit plus insured standing charges divided by sales of previous year. This percentage, whatever we get, if you apply on sales, we get loss of profit. Get loss of insurance company will not pay that money completely. Along with that, they would have to pay some actual expense that you incurred during that period of sale. For example, that building caught fire. If it have kept quiet, no, sales would have been zero. Sales would have been last year during this corresponding period, you made sales of 1 lakh. So insurance company should pay you that 1 lakh into GP percentage. Now you took shortage in turnover. From that 1 lakh, you deducted 20. Why? You made sales in the current period, no 20,000. So to do that 20,000, that cart you set up, you incurred some expense. Who will pay that expense? Insurance company should pay. Why? If you don't set up that cart, your shortage in turnover will be more. Your loss will be more. Insurance company has to give you more claim. You getting it? So they would have to pay. But insurance company will say, I will tell you 3 items. Out of 3, whichever is less, no, only so much I will pay. What is it? First one is actual expense. I won't pay more than actual expense that you incur. But The expense that you incurred should not be more than the profit that you make. The expense that you incurred should not be more than the that building is caught fire, so you set up one small cart at the cost of 1 lakh rupees to do sales of 50,000 on the 20% is profit. To earn 10,000, will anyone incur 1 lakh rupees temporary expense which is not required? No. He will tell how much profit did you make in the 10,000, because of which your loss is reducing by 10. I'll pay you 10. He will say, I'll pay you to the extent you actually incur the expense or profit that you made, whichever is lesser. He will tell profit on the additional sales. Additional sales is the sales generated because of that additional expenditure. I'll give you that. Or I'll give you proportionate value of the insured expenses. This is what we call as proportionate expense. How do we find it? This is like this. We take actual expense multiplied by profit percentage on adjusted annual turnover divided by profit percentage on adjusted annual turnover plus uninsured standing charges. This is basically cross multiplication of what we do. See, profit percentage on the adjusted annual turnover, meaning in the period of 12 months exactly preceding the date of fire, how much sales we made on that profit percentage plus uninsured standing charges. Get this? No, profit plus uninsured standing charges. Rather than taking net profit and adding insured standing charges, can't we take gross profit and then add uninsured standing charges? Isn't this the same? So these two and actual expense, profit percentage on adjusted annual turnover. We'll find one. What to say? Cross multiplication. I'll take actual expense, whatever is incurred. See, profit percentage on adjusted annual turnover plus uninsured standing charges. Here, profit percentage on adjusted annual turnover is the profit that we'll earn. ಇಷ್ಟಕ್ಕೆ ಇಷ್ಟಕ್ಕೆ ಇಷ್ಟಾದ್ರೆ ಇಷ್ಟಕ್ಕೆ ಎಷ್ಟು ಬ್ಯಾಟರಿ ವೀಕ್ ಆಗಿದೆ. So I take actual expense multiplied by profit percentage on adjusted annual turnover divided by profit percentage on adjusted annual turnover plus uninsured standing. Just if I do, I'll get proportionate expense. This expense is incurred now. Actual expense that is not completely insured. It is not completely, to the extent it is insured, I'll give you. How do you find it? Cross multiplication. So to reduce the shortage in turnover, you incur some expense. That expense, they have put a clause saying that they'll pay least of three. One actual, to profit that you want. Third one, to the proportion it is insured. Whichever is least of these three. Whichever it is least of these three will be covered. So if you apply this, whatever you get, no, this much of actual expense should also be added to our profit loss. Shortage in turnover multiplied by profit percentage, whatever we get, to that we add this actual expense, and from this we deduct savings in standing charges if there is any. That's how we get the loss of profit. Are you getting it? How do we do it? Loss of profit plus that additional expenses. Whatever we do, multiplied by sum assured divided by insurable amount is claim. You don't understand this? Don't worry. We'll do it logically. Insurable amount is loss of profit that we just found. To this we add expense. What we get is the amount to the extent to which they should get claim. But their sum assured is much lesser. So we do cross multiplication. Loss of profit plus expense, that additional expense, multiplied by sum assured divided by insurable amount will give us the claim. My God, hard. Rather than step 1, step 2, step 3, this is much better. If you do question or two, you'll understand. But I somehow feel like everyone is, I am right and so confidently. I am sad to be right here. And in the case of over insurance, what do? We'll get full claim. Policy amount is more. Then what do we get? Claim amount is full loss of profit, full expense, full there. Got it? Yeah. I would. Do you want me to share these slides with you all later? I'll share these slides with you all at a later stage. Should we be doing a question on this, or will you continue sleeping? Okay, come on. Let's do a question on this. Oh God. Simple one, complex one. Okay. Okay. Your choice. Illustration number 14. This chapter, though, this was little faster. I do tell lot more stories in between to explain each part of it. If you would want, you can watch the complete chapter. Hey, how did you do this chapter till now then? You never did one. Why? Where were you? Class ಬಂದಿಲ್ವಾ? Probably ಬಂದಿಲ್ಲ. ನೆನ್ಪೇ ಇಲ್ಲ. My God. Oh my God. Okay, let's start. Fire occurred in the premises of Messrs. Bright on 25th of May 2017. As a result of fires, sales were adversely affected up to 30th of September 2017. So from 25th of May to 30th of September, how many days is that? May ಬಿಡಿ, June, July, August, September. 4 months plus 6 days in May. 4 months plus 6 days in May. The firm had taken loss of profit policy for 3,50,000 indemnity 5 months. So we've taken policy for 5 months. Our loss is 4 months, 6 days. So we'll get full 100% claim for the time period. This will never be a problem. Okay. Date of fire 25th of May. Fire period of disturbance 25th May to 30th September. Period of disturbance is 4 months, 6 days. Policy period is 5 months. So how much will we get claim for? 4 months, 6 days. Full period will get claim. And how do we find the loss? Profit lost is equal to short sales multiplied by GP percentage. How much is the sales lost? Don't know. We will find. There is an upward trend of 10% in sales. During this 25th May to 30th September of last year, 2016, we will find sales. To that, we'll add 10%. We'll find sales of 25th May 2016 to 30th September 2016. And to that, we add 10% to find how much is the expected sales during the current period. The firm incurred an additional expenditure of 30,000. Your favorite, that actual expense, additional expense into GP percentage, profit percentage on AAT plus GP percentage divided by profit percentage on AAT plus uninsured standing charges multiplied by additional expense you'll do to find whichever is less. No, only the 30,000 is starting point. Your favorite working note. There was savings of 5,000. This will deduct. This we will deduct savings. You have not incurred so much of standing charge. Actual turnover from 25th May 2017 to 30th September 2017 is 1,70,000. What is this? Actually sold in that Gadi. This is decreased sales. Actual turnover during that period. Turnover from 25th May 2016 to 30th September 2016. Last year, during this time, how much have you incurred? This year, how much you would have sold if there was no disturbance? 6 lakh plus 60%. So 6 lakh plus 60,000. Am I right? See, last year you earned 6 lakh. You made 6 lakh. Current year you would have made 10% trend, 60. If there was no fire, you would have earned how much sales? 6 lakh 60. But actually, how much sales did you make? 1 lakh 75. How much is your shortage in turnover? 4 lakh 85,000. 4 lakh. Now, on 4 lakh 85,000, how much is the profit that you lost? ಅದು ಕಂಡಿಡಿದೆ. That is, ಅಲ್ಲೇ ನೋಡ್ಕೊಂಡು ಹೇಳು. How do you find profit percentage? Net profit plus insured standing charges. Net profit which year? Last year. Insured standing charges divided by sales last financial year. So net profit 2 lakh. Insured standing charges of last year 1 lakh 75. And then sales of last financial year 15 lakh. Correct? 2 lakh plus 1 lakh 75 divided by 15 lakh. Have a look. 3,75,000 divided by 15 lakh into 100. What do we get? 25%. Sometimes this might not be the number that we should take. They've told no, sales are expected to increase by 10%. Similarly, sometimes in the question, they'll also tell that say GP percentage is expected to be increasing by 5%. They do mention like that. Now they have not mentioned. Now they haven't. So what will we be taking? 25. Need out? No, we will take 25%. Come on here, on this 4 lakh 85, apply 25%. What do we get? 1 lakh 21,250. 1 lakh 21,000. This is the extent to which profit is lost. This is the extent to which profit is. Everyone understood profit being lost to the extent of 1 lakh 21,250. This is the claim. This is for comparison. How much is policy amount? Policy. ಎಲ್ಲಿದೆ? Third line. Okay, oh, 3 lakh 50. They have taken policy for 3 lakh. How much is actually the loss? Oh my God. Over insurance, under insurance. Full amount will be claimed. Sir, then 1 lakh 28, 1 250 ashton. Illa, additional expense. Additional expense, three things. Actual or additional sales into GP percentage. Number three, proportionate. How do we find proportionate? Additional expense multiplied by GP percentage on adjusted annual turnover divided by GP percentage on adjusted annual turnover plus uninsured standing charges. ಫಸ್ಟ್ ಸ್ವಲ್ಪ ಕಷ್ಟ ಆಗುತ್ತೆ ಒಂದ್ ಎರಡು ಮೂರು ಸತಿ ಮಾಡಿ ಬಂದ್ಬಿಡುತ್ತೆ. Got it? Yes or no? Actual expense. ಎಷ್ಟಿದೆ actual expense they've given here? 30,000. How much is it? So I'll write here actual expense is 30. Then proportionate expenses. How much? Okay, fine. GP percentage marked. GP percentage is how much? 25% on the additional sales. How much is sales made during that period? During that period of disturbance, 175. So I'll do 175 into 25%. 43, 750. Now we'll do 30,000 is that actual expense multiplied by 25% on adjusted annual turnover. What is adjusted annual turnover? It is sales during the period of 12 months exactly preceding the date of fire. It is sales during the period of 12 months exactly preceding the date of fire. Yavaga 25th of May 2017. So this is 25th of May 2016 to 25th of, sorry, 24th of May 2017. So how do we find? Last full year sales they've given. Full year sales is how much last year? Like, where is it? Where is it? Adu alla. That is not the one. Last year full sales is year 15 lakh. ಎಲ್ಲಿದೆ? Oh, ಕೊಟ್ಟಿದ್ದಾರಾ 25th of May 2016 to 24th of May 2017. Yeah, they've given. ಕೊಟ್ಟಿಲ್ಲ ಅಂದ್ರೆ ನಾವು ಕಂಡುಹಿಡಿತೀವಿ. Last year full year sales you take 1st of January to 31st of December. In that 1st of January till that 25th May to 30th September they've given, no, that you eliminate. You know, last year after the date of fire till the year end. This year beginning of the year till the date of fire. ಅದೆರಡು ಆಡ್ ಮಾಡಿದ್ರೆ ಬರುತ್ತೆ. Current year portion when we take, no, it is fine. The last year portion when we take, no, should add trend because that would be how much it would have been if it was current year. Adjusted annual turnover is sales during the period of 12 months exactly preceding the date of fire. To the extent the sales is there of previous year, we add a trend to find the current year sales. Basically, it is the sales that we would have made in the year of fire if there was no fire. In the year of fire, if there was no fire. So till the date of fire will take the current year sales. After the date of fire till the year end, what we would have made in the last year plus trend. Did you get it? Now repeat. What is this adjusted annual turnover? For what period is this sales for? It is for the period of 12 months exactly preceding the date of fire. Exactly preceding the date of fire. Some period is there in current year. No. That current year is current year sales. No problem. Previous year sales is there. No. Certain months. That we take previous year, add trend. So if you add trend, it would become current year. So you're basically identifying what to say sales during the current year. You're basically identifying the sales during the, if there was no fire, for the full year, how much would have been made? That is our adjusted annual turnover. In that adjusted annual turnover, if I apply that percentage, I'll get profit. Correct? To that profit, if I add uninsured standing charges, if I add uninsured standing charges, I'll get the denominator. Numerator, I'll take as actual expenses multiplied by GP percentage on adjusted annual turnover. Meaning, if in case there was no fire in the current year, would have done the full year sales normally. Full year profit would have earned normally. In that some amount is insured, no? Correct or not? How much of it is insurable in that actual expense that we've incurred during this period of fire? That is what we're trying to find. Did you understand? If there was no fire, would have got no disturbance, would have done entire year sales. On that entire year sales, would have found profit. That profit plus uninsured standing charges denominator. we'll write only GP percentage on adjusted annual turnover. We'll get how much of the standing charges will be insured out of the total profit. That will multiplied by actual expenses incurred during the disturbed period. We'll understand how much of that expenses will be insured or how much is the insurance company's responsibility. You get it? That's what we're trying to do. Now adjusted annual turnover, they only told how much is it? 15 lakh kotidaralva. Sorry, 14 lakh is what they've given. In this, no, how much is it relating to previous year? We should do that adjusted annual turnover computation. To do that adjusted annual turnover computation. Sales during the period of 12 months exceedingly directly preceding the rate of fire is 14 lakh. In that, we add trend of 1 lakh 40, we arrive at 15 lakh 40. Last year, if it was 14 lakh, if we add trend, we get what is the expected sales during the current year if there was no fire. Got it? ಎಷ್ಟು ಬಂತು? 1540. In this 1540, we apply 25%. This is our GP percentage on AAT. Expense that is incurred is, sorry, this is what we're trying to find. Last year, mein GP percentage on AAT plus uninsured standing charges of 1,25,000 is 5,10,000. Actually, expense incurred is 30,000. If this is the amount to the extent of which profit is there and uninsured standing charges is there, this much is insured. Out of this 30,000, how much will be insured? 30 into 3,85,000 divided by 5,10,000 will end up with 22,640. Now you take this 22,647 here, whichever is least of this will be allowed. What is the least of this? 22,647. So I add this 22,647 to the loss here. How much is the loss here? 1,21,250. I'll add 1,21,250 plus the additional expenses of 22,647. I will deduct the savings in standing charges of 5,000. I'll get loss of 1,38,890. Got it? This is the total loss. What is the extent to which policy was taken? 3,50,000. What is the extent to which policy should have been taken? Current year expected sales is how much? 1540. On what is the expected profit percentage on that? 25%. If there was no fire, how much is the profit that you were expecting to make in the current year? 3,85,000 policy togobekalva. You've taken policy only for 3,50,000. So it is underinsured. It is. So then we apply that same thing. Profit that would have been earned in the current year, for which we should have taken policy, is 3,85,000. But policy has been taken for 3,50,000. But actual loss is 138,897. To do cross multiplication to find 126,270 as claim. If I have to summarize the entire thing to you in one shot, how much is the sales that we would have made if there was no fire, multiplied by profit percentage? How do we find profit percentage? Last year net profit, last year standing charges. Add them, divide by last year's sales. This profit percentage on the sales that we would have lost. Profit lost. To this, we should add additional expense. How do we add additional expense? Least of 3. Actual or additional sales into GP percentage or additional expense multiplied by GP percentage on AAT divided by GP percentage on AAT plus uninsured standing charge. Out of 3, whichever is less you take. This plus that is loss of profit. That is the extent to which insurance should be claimed. But how do we check if there is under insurance, over insurance? GP percentage on adjusted annual turnover will be compared with insured amount. Insured amount. If insured amount is more, very good. If insured amount is less, adalle irli. GP percentage on adjusted annual turnover, policy amount alle irli. Here you write loss of profit. Loss of profit multiplied by policy amount divided by GP percentage on adjusted annual turnover will give you claim amount. Are you getting it? You do 2-3 more problems, you will understand. I understand. I can feel it already that you people are like, oh my god, don't bit big exam again. It is doable. This is one of the very easy things. Unpredictable question in the examination will not be unpredictable. Some new adjustment cannot come. Are you getting it? Lot of chapters may a very new, different, unique adjustment what you have never seen in life can come. This chapter may standard format. Inge barutte, nothing new will come. To do 3-4 problems, what is there on this, you will be done. If in case you are happy with the explanation that we did just now, you feel like you understood something, look at these steps and try the problems at home. If you think you've not understood, loss of profit, I would say insurance claim videos have been uploaded on YouTube. The only loss of profit part and each question what is there in the SS material, what questions are shared with you, everything solution is there. You try 3 to 4 problems is there. If you do those 3 to 4, you will be definitely able to crack this question in the exam. Might sound very difficult because I've seen students over the years. I'll tell you, people find this chapter difficult in the class. People find this chapter very comfortable in the exam if they do. 10 marks per sir. Sometimes they ask loss of stock and don't ask loss of. That nobody can tell which will come and which will not. Nobody, I can't tell. I'm very sorry. But if I have to show you, I had shown you in the presentation also, no, in the beginning. Every attempt it has come, boys. Every attempt it's there. 10, 10, 10, 10, 10, 10, 10. 2 attempts it's come for 5 marks. That is both loss of stock and loss of profit together. ಎರಡರಲ್ಲಿ ಒಂದು ಕೇಳ್ತಾರೆ, ಎರಡು ಕೇಳಲ್ಲ. And it will not be that complex. Data what is required will all be there in the question. You just have to put it. The questions that we are doing in the class is the ones with maximum difficulty. The questions that we're doing in the class right now are the ones with the maximum possible difficulty. This is the maximum. There can't be more than this. Yes. Okay. Great. இப்போ என்ன பண்ணணும்? Yes sir. So we are done with insurance claims. Okay. Branch ಮಾಡಕ್ಕೆ? If you want me to do branch, I can, but it will become little. Investment? You wanted investment. Debenture? Debenture ಮಾಡಿ ಮುಗಿಸದಾ? If you want me to do debentures, I'll do debentures. Investment or debentures? How many of you want investments? How many of you want debentures? How many of you want branch? Let's do investment accounting. This is based on accounting standard 13. When we start with investment accounting, I have a separate presentation for investment. Investment accounting, chapter 9, 73 to 80. Yeah, it's come for 20 marks also once, or usually otherwise 10 marks is sure shot from the chapter of investments. So let's quickly start with the discussion on investments. This is done as per accounting standard 13. And as per accounting standard 13, we basically categorize or classify the investments into 2 categories: current investment and current investment and non-current investments, or short-term investments and long-term investments. So this is done based on the period of holding. So what is the period of holding which will make us decide whether it is short-term or long-term? 12 months. So it's like when you buy investment, it is current investments. First year, happy birthday over, then it will become non-current. Is it that way? Every investment was once a current investment. After its first year birthday, does it become non-current? Then it is ulta. Andre, every investment is non-current investments. Oh my God. Okay, fine. Let me tell you a little different. So you deciding an investment whether it is current or non-current is dependent upon the expected period of hold, not the actual period. It's dependent upon the you expect to dispose it within the period of 12 months, current. You intend to hold it for a period longer than 12 months, non-current. You're getting it? Valuation is different for current and non-current, and that is the reason we segregate the investments into current and non-current. Current investments are valued at cost price or market price, whichever is less. However, non-current investments will be valued at cost. Will be valued at cost. Unless such decrease in the value of the investments below cost is permanent in nature. It should be some big event that has happened because of which there is decrease in the value of the investments, which is permanent in nature. Only in that case will reduce. Otherwise, we'll continue to record the investments at cost. ಅಕಡೆ ಈ ಕಡೆ ಬಚ್ಚಿಟ್ಕೊಂಡು ತಿನ್ನಂಗಿಲ್ಲ. Yeah, so investments will be continued to be recorded at cost. No, new alva ಅದಕ್ಕೆ ಹೇಳಿದ್ದು. So let's get started after that. So for the purpose of solving, we categorize the investments into two categories. One is varied income bearing securities. Second one is fixed income bearing securities. Varied income means the income from that investments keeps changing. For example, now equity dividend received from equity shares. Because against the equity shares, the dividend rate is not fixed. It will be recommended by the board and then accepted by the shareholders. It can be same as last year, it can be less than last year, it can be more than last year. So because it keeps changing, we call it varied income bearing security. For fixed income bearing securities, example is debentures, preference shares, bonds, and several other things. So here the rate of interest is fixed, rate of dividend is fixed. It cannot be more, it cannot be less. The way we do accounting for these two, intention is same, but accounting looks slightly different the way we present. The reason is whenever we buy or sell an investment, we don't buy the sell on investment exactly on the date on which the dividend or interest is given. We can do that, but we don't wait for it. Let us say I am willing to sell an investment. You are willing to buy the investment. I will say I want to sell. You will say you want to buy. You will say sell. I will say not now. Then you will say when. I don't know. Then you will ask me, are you willing to sell? I'll say yes. I'll ask, are you willing to buy? I'll say, you say yes. Then you'll ask me to sell. I will say no. Then you'll ask me, what is my problem? I will say, I've been holding this for quite long time now. Get it? And I'm expecting interest on 31st of December. Let us say they give interest two times, 30th of June and 31st of December. So 31st of December, once they give, no, I'll take interest, then I'll give the debenture to you. That is what I'm trying to tell. Then you will be like, oh, is your problem only interest? Then I'll say yes. Then you'll say, I will sell it to you, you will buy it from me. You are promising that on 31st of December, when the interest is given, no, company will give 30th of June, the 30th September. July, August, September, September. 3 months interest company will give me. October, November, December, you will hold, no, because I will sell it to you. Company will give interest to you. Till the company see in the register of members till what date whose number is there, after what date who bought it. So give me 3 months interest and give you 3 months interest, because during this 6 months of June to December, I held the debenture for 3 months, you held the debenture for 3 months. Will the company do this? Not possible. There are days where morning somebody else is holding, afternoon somebody else is holding, and evening somebody else is holding. So much of share sale will happen, debenture sale will happen. Company cannot track all of this. Company will tell on the date on which company declares interest, like 31st of December. You hold it, you get debenture interest. Somebody else holds it, they'll get. Whoever holds it on the record date will get debenture. Are you getting it? So first you try to make fool of me by saying that company will give me 3 months, company will give you 3 months. I told, no, 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 I know company will not do that. Company will not do that. Then you are making a promise saying that on 31st of December, when you receive 6 months interest, you will give me 3 months interest. Can I trust you? What if that day you ask me who am I? So I will say, Adella, now give me money for debentures, also give me 3 months interest. Also give me what you will receive on my behalf later. You give me now. You give me 3 months interest. Company will give you 6 months interest. 3 months you gave me, no, that you deduct from that remaining 3 months money is yours. Logical. Now let's say you paid me 1,000 rupees for the debenture and you paid me some 300 rupees 3 months interest or 150 rupees 3 months interest. Now you paid me 1,150, but in your investments, can you write 1,150? Can you write 1,150? You can't write. Why? That 150 what you paid me is reimbursement. That is not part of your cost of investment. So 1,150 what you paid me is called as cumulative interest. What is it called? The price of the investments including interest. So you would have to eliminate the interest on that item. So you will write purchase price 1,150 less interest till what date? On the nominal value multiplied by interest multiplied by last date of interest to the date on which you purchased. That one you did. What you get is X interest. That X interest price is the price that you will write in your investment account as cost. Whatever that excess you paid for interest, it will be reimbursed to you when the company gives you interest. You understand? To you, that 3 months interest is expense. Later you get 6 months interest as income. Income 6 months, expense 3 months. If you net it off, 3 months interest will become profit. Get it? That's how you will record it. Now I have a couple of questions. Whether what they'll give in the question is X interest price or cum interest price. How do we get to know? They'll tell in the question. They will tell in the question. Okay, next. Whenever you buy, you might have to pay some stamp duty, you might have to pay some brokerage. Now that brokerage and stamp duty, will we compute that brokerage and stamp duty on the X interest price or cum interest price? Whatever is given in the question. Whatever is given in the question, if they give cum interest price to you, compute brokerage on cum interest. If they give X interest price in the question, compute brokerage on X interest price. Whatever is given in the question, on that you compute. On that you compute. That will be part of your cost. So we'll write whatever X interest price or cum interest price plus brokerage plus stamp duty. You add. From that you deduct interest. If the beginning is cum interest price, you get X interest. Got it? For me, sale consideration. Whatever they give, I'll write sale consideration. I'll write the sale consideration that I receive. To this sale consideration, I don't add brokerage and stamp duty if I have to pay. Brokerage can be both ways. The broker in between can charge the seller and can also charge the buyer. You getting it? But stamp duty will be incurred by the buyer. You need to register it in your name. I won't pay stamp duty. So if I paid brokerage, I won't add brokerage to sale consideration. I will deduct brokerage from sale consideration. From my sale value, I will deduct sale consideration. From that, I'll deduct brokerage. Whatever I get, if that price is cumulative, then I'll eliminate the interest to identify my X interest. So in the investment ledger account, which is asset, debit side will write opening balance and purchase, credit side will write sale and closing balance. Are you getting it? Every item, opening balance, purchase, sale value, closing balance, should always be at excluding interest price. What price should it be at? If they give excluding interest price, very good. If they don't give excluding interest price, if they give us cumulative of interest price, we eliminate the interest till the date of that such transaction and then write the X. Brokerage or stamp duty, whatever is given, should be computed and added. In the case of purchase, it should be computed and deducted from sale consideration. You all get this? On the date when you receive interest, it should not be added to the cost. It should not be adjusted against the cost. It should be written in the interest column. You prepare that investment account with 3 columns. Prepare that investment account with 3 columns. One for the nominal value or number of shares. I don't know. Some of you prepare nominal value column. Some of you prepare number of shares or number of debentures column. Then you'll prepare one amount column and interest column. Amount column is this investment account. Interest column is income account. Credit side is income received. Debit side is income expense paid. Whatever interest you pay when you purchase, no, in this question, when you purchase, no, 9 lakh worth of debentures, you paid 8,90,820 towards debentures and you paid 37,500 interest. This is expense. On this also you will collect interest income whenever you collect interest here. Are you getting it? Okay. This is possible with regard to debentures. Why? We know no 10%. We know the date on which we'll receive, we will definitely receive 10%. But when it comes to equity shares, dividend rate is not known. Dividend rate is what we receive will be cumulative of dividend price. And then that date I paid you more. Let's say I paid some amount to buy the shares of the company. I paid that amount, that includes the dividend price because dividend is due on that date for the year during which the profit is earned. I don't own the share. I bought the share in the month of okay, let's say September is too, October is too late. Let's say I bought the share in the month of May. Last year, April to March, the profit is earned. Then I am not holding the share. I bought the share in the month of May. June or July, they are going to declare final dividend. I am going to receive the money. When I receive that money, it is profit. It is this profit. Have I earned it? Who earned it? He earned it. So when he paid me, when he asked me to pay for the share, whatever price I've paid, no, that price includes the dividend, what he has earned. So when I receive dividend, it is pre-acquisition dividend. What is it? What do you mean by pre-acquisition dividend? This dividend belongs to the period which is before I acquired the share. This dividend belongs to the period before I acquired the share. It is received after I acquire, but for which year have they paid us dividend? For the previous year. So that is capital profit. That is, I will adjust it against the cost of investments. I'll adjust against the cost of in debentures. So I will do working note here. I will write if it is X interest price, very good. If it is cum interest price, what do I do? From the cum interest price, I will add my brokerage, I will deduct the interest, 40,000, and write it separately in the interest column. But for equity share, I can't do that because on the date when I bought, I don't know how much is dividend. So I would have written it already in the amount column. And after writing in the amount column, 3 months later, I understood dividend. Can I deduct it here from the amount column? I cannot. So pre-acquisition dividend is written on the credit side in the amount column to decrease the cost of investment. Pre-acquisition dividend is written on the credit side in the amount column to decrease the cost of investment. Did you understand the difference between our debentures and then equity share part? 2-3 more things are there. I'll tell it quickly. I understand we have less time, so I'm not showing the problem in detail in that. Later, if you want me to solve a problem when we come back next time Wednesday, I will still do it. So with regard to equity shares, there are 3 things that you should do. 1, bonus issue. 2, right issue. After that, closing value computation, I'll teach you. Bonus issue, right issue. Bonus issue, free share. Did you pay any consideration? So don't adjust anything in the amount column. Write the bonus value in the nominal value column. Write the bonus value in the, very good. Next thing, what about right issue? Right issue is nothing but purchase. Right issue is nothing but write the nominal value in the nominal value column, whatever money you pay in the amount column. But right issue, you have an option to sell the rights. If in case you sell the rights, it will not decrease the cost of investment. Entire sale consideration is profit. Entire sale consideration is put the entire right share sale consideration to P&L account credit side. Don't even write 1 rupee to investment account. It will not come anywhere in investment. You get it? Last point. How to find the closing value of investment. How to find the closing value of investment. There are 2 techniques. Number 1, first in, first out. Number 2, weighted average. Number 1, first in, first out. Number 2, weighted average. First in, first out. What do? We'll take the first 2 opening value of investments. And whenever the sale is made, it is made out of that. Second, I assume that this is over. This is over. Next, purchase whatever is there, from that the sale is made. So go on identifying like that. Let us say you had opening stock of 10,000 shares. Then you purchased 10,000 shares. You sold 5,000. So from the opening balance 10,000, 5,000 is sold. 5,000 from opening stock, 10,000 from second purchase is available. So whatever this value is there in the amount column divided by 10,000. Per share value we get 5,000 sold into 5 plus this value together will be closing. Or let us say opening stock is 10,000. Further you purchase 10,000. Total sales is 15,000. So opening is fully sold. Out of the purchase 5,000 sold. Balance 5 is remaining. So that amount is for 10 divided by 10 into 5. That will be closing. Find it that way. If it is weighted average, this is the easiest. Add all the amounts. Add all the amount columns. Deduct all the amount columns credit. Divided by this side value is there, no number of shares that you add. This side value is that you deduct. Divide it, you will get the answer. Weighted average is much easier comparison to first in first out method. Sir, which one to follow? Accounting Standard 13 gives option, but which one do we follow? Whatever they tell us in the question. Sir, if they don't tell anything, what do we do? You can follow either. You can follow either, but write it then whatever you follow. But you will follow weighted average method to find out the balancing figure in the amount column. So this is how the problems are done when it comes to investment accounting for fixed income bearing and variable income bearing. You get it? Okay. So there are some questions that you can practice. I put one question here, and if you want me to solve the question when we meet next time on Wednesday, I will surely solve it. Would you be wanting me to solve a question on investment when we meet next time on Wednesday? Okay, I will spend another 5 minutes and quickly make a plan for Wednesday. And once we make a plan, we'll wind up. Is that fine? So we are done with insurance claim and investments partly. Partly, yeah. Partly done. So now we're making a plan for our 11th.